My name is C.V. Sharma. I'm a practicing chartered accountant. I qualified CA in the year 1998. Since then, I'm in the field of teaching. I deal with auditing and assurance. Let us start the subject without wasting further time. I will start the subject with the help of a statement. You can say either yes or no for this. Every organization, whether it be a business organization or it be a non-business organization, when you sound joined, whether it be a business organization or it be a non-business organization, is compulsorily required to maintain some basic books of account. Do you agree with this statement or not? Every organization, whether it be a business organization or it be a non-business organization, is compulsorily required to maintain some basic books of account. Why an entity is required to maintain books of account? The logic is so simple to understand. Organizations do enter into voluminous transactions. If the number of transactions entered by the organization are limited, there is no need for you to maintain any books of account at all, for the simple reason that you will be able to remember the details of all such transactions. I repeat, when the number of transactions entered by the organization are limited, there is no need for you to maintain any books of account. You may be able to remember the details of the transactions. However, when the number of transactions are numerous, voluminous in nature, it is highly impracticable or impossible to remember the details of such transactions. When you are unable to remember the details of the transactions, the only way available for you is to record such transactions in books of account. When you record the details of the transaction into the books of account, books will act as a permanent record, and hence there is no need for you to remember the transactions. So by this, what you need to understand is that every organization is required to maintain basic books of account. Why should an entity maintain books of account? The logic is simple. Organizations do enter into voluminous transactions, and it is highly impossible or impracticable to remember the details of all such transactions. Hence, every entity is required to maintain some basic books of account, and as and when the organization enters into any transaction, the details or particulars of such transaction shall need to be recorded in such basic books of account. Now the question is, what are the books that are generally maintained by an entity? You know very well that every organization is expected to maintain a book called as a journal. What is the importance of journal? As and when an organization enters into a transaction, the details or particulars of such a transaction shall need to be entered in a book called as a journal. This is the reason why journal is also called as a book of prime entry or book of first entry or book of original entry. When you enter into a transaction, the details or particulars of such a transaction shall need to be recorded in a book called as journal. Since you are recording the transaction first in the journal, it is called as a book of first entry. First can also be called as prime, and hence it is also called as a book of prime entry. And originally the transactions details are being recorded in the journal, and hence it is technically called as a book of original entry. Once a transaction is recorded in the journal, later on the details or particulars of such a transaction shall need to be transferred to another book called as ledger. You know all these things very well. You are not listening to the subject for the first time. Journal, for example, if you make some payment of salaries, then that is nothing but a transaction that took place. The details of the transaction are required to be recorded in the journal, debiting salaries account and crediting cash or bank account, and you need to write some narration below the entry. This is sufficient because you have entered this details of the transaction into the books of account. There is no need for you to remember the details of the transaction, and the book will act as a permanent record. That is all about journal. So once an entry is made in the journal, the transaction is required to be transferred to another book called as ledger. At the end of the year, the ledgers are totaled. The balances of the ledgers are extracted and from such balances of the ledger, organization do prepare a trial balance. If the trial balance agrees, from such trial balance, organization will prepare financial statements. Generally speaking, the following will form part of financial statements. The first one is manufacturing account. The second one is trading account. The third one is profit and loss account. The fourth one is profit and loss appropriation account. The fifth one is balance sheet. In some cases, entities may be under obligation to prepare a statement called as cash flow statement, and in some other cases, the entity is also required to prepare a statement called as statement of changes in equity. Statement of changes in equity. So these are all generally considered as financial statements. Why I am explaining all these things to you is that you must be able to understand the flow of the transaction in the books of account. Initially, you have entered into the transaction, the details have been recorded into journal. Later on, the same have been transferred to ledger. At the end of the year, the ledgers are totaled. The balances of the ledgers have been extracted. From the balances of the ledger, you have prepared a trial balance. And if such trial balance agrees, from such trial balance, you are expected to prepare some financial statements. The following is the list of financial statements that are generally prepared by the entity. This is point number 1. Now, point number 2. So, at the end of every financial year, you know very well that financial year will start from 1st April and will end by 31st March. So, at the end of every financial year, every organization is required to prepare their financial statements. You know very well now that the source for preparation of financial statements is trial balance. The source for preparation of trial balance is nothing but ledger, and the source for preparation of ledger is nothing but journal. So from journal, you are preparing the financial statements, and such financial statements are required to be prepared at the end of every financial year. Now, let's have a discussion about who are the users of financial statements. The financial statements so prepared by an entity will be used by several persons for taking different types of decisions. This point is very important for you to understand what exactly is auditing. So financial statements so prepared by the entity at the end of the financial year will be used by several persons for taking different types of decisions. The primary user or first user of financial statements prepared by an entity would be its management. The question now is how management makes use of financial statements. If you were the management, you are keen in ascertaining whether your business is getting profit or is suffering with loss. Yes or no? When you are carrying out a business, you are keen to know whether your business is getting profit or is suffering with loss. In order to ascertain whether you are getting profit or suffering with a loss, what the management is expected to do? Management is required to go through the financial statements, particularly the profit and loss account. By going through the profit and loss account, management would be in a position to identify whether the business is getting profit or is suffering with loss. Let us assume that you are the management of an entity. Let us also assume that you are going through your profit and loss account and you find that your business is getting a good amount of profits. You started your business only 1 month back with a mere capital of 1 lakh rupees. You started your business only 1 month back with a mere capital of 1 lakh rupees. By going through the profit and loss account, you have identified that your business got a profit of 40 lakh rupees. Within a period of just 1 month, that too with a mere capital of 1 lakh, your business is able to get a profit of 40 lakh rupees. In that case, if you were the management, will you try to continue your business or will you try to shut your business down? Obviously, when you are getting very good amount of profits, you may decide to continue your business. So where you are getting some profits, you may try to continue your business. In order to ascertain whether you are getting profit or loss, the only way is to go through your financial statements, particularly the profit and loss account. Contrary to this, by going through the profit and loss account, you have identified that your business suffers with a loss of 40 lakh rupees. The only difference between the previous example and the present one is, in the previous case, your business earns a profit of 40 lakhs. Now, your business is suffering with a loss of 40 lakh rupees. The other facts are one and the same. So, you started your business only 1 month back with a mere capital of 1 lakh, but your business suffers with a loss of 40 lakh rupees. In such case, will you try to continue your business? Certainly, you may decide to shut down your business or to close your business operations. By going through this example, every one of you must be able to understand that even management is said to be the primary user. Management is said to be the primary user of financial statements prepared by the entity. And by making use of financial statements, management will take decisions such as whether to continue the business or to shut down the business. Not only management, but several other persons will make use of financial statements. Like the next set of users of financial statements are nothing but shareholders. Now the question is, how do shareholders make use of financial statements? You know very well that there may be two objectives behind purchasing shares in a company. Objective number one is to get some income in the form of dividend, whereas objective number two is capital appreciation. Dividend and capital appreciation. So generally, shares are purchased with an intention to get some income in the form of dividend, as well as with an intention to get some capital appreciation. Assume that you have invested some amount in a company called as A Limited in the financial year 2018-2019. In fact, that is the first year of operations for the company. You purchased 10,000 shares in the company, each share at 10 rupees. So your initial investment in purchasing shares of A Limited is say 1 lakh rupees. This has been done in the year 2018-2019, and that was the first year of operations for the company. At the end of the first year, the company has prepared the financial statements. Since you are the shareholder of the company, a copy of the financial statements has been provided to you. You have gone through the profit and loss account of the company, and by going through the profit and loss account, you find that for the first year of operations, the company in which you purchased shares suffers with a loss of 1 lakh rupees. Since the company suffered with a loss of 1 lakh rupees, the company is unable to declare any dividend. It has some negative impact in the market, and hence now the shares of the company in the market are trading at only 9 rupees. Remember, you purchased each and every share at 10 rupees, but because the company suffered with a loss in the initial year itself, the company's share price has been beaten to 9 rupees. But you are an optimist. You are of the opinion that this is the first year of operations of the company. Let us wait for one more year to take some decisions. So you waited for the next year. What is the next financial year? 2019-2020. For that year also, the company prepared financial statements. A copy of the same is provided to you. You have gone through the financial statements and you have identified that for the second year of operations, the company suffered with a loss of 50,000. In the first year, there was a loss of 1 lakh. In the second year, there was a loss of 50,000. Therefore, the company is unable to declare dividend even for the second year, and the company's share price is now trading at the market at 8 rupees per share. So the share price keep on falling. There is no capital appreciation at all. There is a capital depreciation. You are not getting any dividend from the company. The objective behind purchasing of investments are not met. Why you have invested your monies in the shares of a company? To get some income in the form of dividend. The company hasn't get any profit yet, and hence the company has not declared any dividend yet. Moreover, there is no capital appreciation. There is a fall in the share price of the company in the market, since the company is not getting profits and since the company is not declaring dividends. Now, as already said to you, you are an optimist. You started analyzing the profits of the company, and you find that for the first year of operations, the company suffered with a loss of 1 lakh, whereas for the second year of operations, it suffered with a loss of only 50,000. So you started anticipating that for the next year, the company would get profit, and hence you decided to hold the shares of the company. You don't want to sell the shares of the company. You want to hold the shares of the company for another 1 year. Meanwhile, the third year is also completed. The third financial year for the company is 2020-2021, and by going through the profit and loss account of that year, you find that the company has neither got a profit or nor suffered with a loss. The company is at a break-even point in the financial year 2020-2021. Therefore, again, you haven't received any dividend from the company, but now the share price of the company in the market is trading at 7 rupees 75 paise. If you were the shareholder, will you try to sell the shares of the company in the third year, or will you try to hold the shares of this company in the third year? If I were the shareholder, I will certainly hold the shares of the company. Why? Because the losses of the company are in the deteriorating trend. Probably the company may be able to get profit in the next year. Therefore, in the third year also, I decided to hold the shares of the company. And for the fourth year of operations, that is 21-22, company prepared P&L account. The copy of the same has been sent to you because you are the shareholder. You have gone through the financial statements, and you find that for the fourth year of operations, the company suffered with a loss of 10 lakh rupees. Contrary to your expectations. What is your expectation? Probably the company may get a profit in the fourth year, but contrary to your expectation, in the fourth year, the company suffered with a loss of 10 lakh rupees. In that case, if you were the because of that, now the share price of the company is trading at 4 rupees. You purchased it at 10 per share. Now the share price is trading at 4 rupees. The company keeps on getting losses. For the current year, the company got huge losses. In that case, if you were the shareholder of the company, will you still try to hold the shares of the company? Yes or no? No. Now you made your decision and you want to sell the shares of the company. By listening to this long example, you should be in a position to understand that even shareholders of the company will make use of financial statements prepared by the company for taking some decisions such as whether to hold the shares or to sell the shares. By this, you should understand that several persons may make use of the financial statements prepared by the company. The person who is making use of financial statements of the company may be technically called as user of financial statements. By using financial statements, they will make some decisions. Remember, all the persons are making use of the same set of financial statements, but they are taking different types of decisions. If you were the management, what type of decision would you take by using financial statements? If you were the management, what decisions will you make by using the financial statements? Decisions such as whether to continue the business or to shut down the business. If you were the shareholder, what type of decisions would you make by using financial statements? Decisions such as whether to hold the shares or to sell the shares. The third set of users of financial statements would be prospective investors. Who is a prospective investor? A person who had already invested his money in buying the shares of a company may be called as an investor or a shareholder. A person who has already invested his money in buying the shares of the company is technically called as an investor. A person who wants to invest his money in the shares of a company may be technically called as a prospective investor. If you want to purchase some shares in a company, what should you do? First of all, you need to select 3 to 4 companies. You need to collect some information relating to the company in which you want to make investment. What information do you require as a prospective investor to take a decision about whether to invest in the shares of a particular company or not to invest in the shares of a particular company? Are you able to follow me? if you were the prospective investor, if you want to make some investment in the shares of the company, what you are expected to do? You need to select 3 to 4 companies initially, and you should start collecting some information relating to such companies. All these things are being done by you to make a decision about whether to invest in the shares of the company or not to invest in the shares of the company. If you are that prospective investor, what type of information do you require? If you were the prospective investor, what type of information do you require? If I were the investor, prospective investor, I need information like what is the year of establishment of the company? What is the line of business of the company? Who are the directors of the company? What is their qualification? What is their experience? All these things will certainly matter while making an investment decision. So in order to make an investment decision, you need some information. What type of information is required for an investor? The information like year of establishment, the line of business of the company, who are the directors of the company, what is their qualification, what is their experience, and most importantly, whether the company is getting profits or is suffering with losses, whether the company has declared any dividend in the past or not, whether the company has issued any bonus shares in the past or not. These are all the things that are very much important for an investor, for a prospective investor to take some decisions like whether to invest or not to invest. If you want to collect this information in respect of a company, you need to go through, obviously you should go through the profit and loss account, particularly the annual report of the company. Most of the information that you require, like the line of business of the company, the directors of the company, qualifications of the directors, experience of the directors, whether the company is getting profits or losses, whether the company has declared any dividend in the past, whether the company has issued any bonus shares in the past, all these things are known to you only when you go through dash. All these things are known to you only when you go through dash financial statements. By this, you must understand that, okay, a prospective investor will go through financial statements prepared by the company. By going through the financial statements, prospective investor will try to collect some information regarding the company. And by making use of such information, prospective investor had to make some decisions like whether to invest or not to invest. Till now, we had a discussion about 3 types of users of financial statements. The first one is management, the second one is shareholders, the third one is prospective investors. How management makes use of financial statements for taking decisions such as whether to continue the business or to shut down the business. How shareholders will make use of financial statements for taking decisions such as whether to hold the shares or to sell the shares. How prospective investors makes use of financial statements for taking decisions such as whether to invest or not to invest. Remember, all these persons are making use of the same set of financial statements, but they are taking different types of decisions. Not only this, there are several other persons who makes use of financial statements prepared by the entity. The fourth set of users of financial statements are banks and financial institutions. You know very well that before taking a decision about whether to grant a loan or not to grant a loan to a particular applicant, what the bankers are expected to do. If you were a banker, if I made an application to you requesting you to grant me some loan, what the banker is required to do to take a decision about whether to grant loan or not to grant loan? You need to evaluate my repayment capability. You need to evaluate my repayment capability. This evaluation of repayment capability is also technically known as evaluation of credit worthiness. Both mean one and the same. I repeat, when a person makes an application to a banker requesting the banker to grant some loan, first of all, the banker is required to evaluate the repayment capability, otherwise called as the creditworthiness of the customer. When the banker satisfies about the repayment capability or creditworthiness, then the banker can decide whether to grant loan or not to grant loan. In order to evaluate the repayment capability or creditworthiness of the customers, what the bankers can do? The banker usually asks your financial statements. Supposing that you are a banker, supposing further that I made a loan application to you, I requested a loan of say 5 lakhs from you, and I said that I am carrying out a business. Then the banker asked me to provide my financial statements for the last 3 years. I provided my financial statements to the banker. Why the banker needs my financial statements? In order to evaluate my repayment capability, otherwise called as creditworthiness. I have given my financial statements to the banker. Remember, in the given example, I am asking for a loan of how much? 5 lakh rupees. Banker asked my financial statements. I provided all the 3 years financial statements to the banker. And by going through my financial statements, the banker identified that I am getting an average profit. I am getting an average profit of say 30,000 rupees per annum. I am getting an average profit of 30,000 rupees per annum. If you were the banker in the given situation, would you like to grant me a loan of 5 lakhs? Remember, I am getting an average profit of 30,000 rupees per annum. I am asking you a loan of 5 lakh rupees. In this scenario, if you were the banker, are you willing to provide loan of 5 lakh rupees to me? Yes or no? Yes or no? Certainly no. Why? Because generally banks will make an assumption that out of the profits that you are getting, 50% of the profits will be utilized for meeting your personal expenses. So out of 30,000 rupees per annum, I will use 50% of it for meeting my personal expenses. The remaining amount after meeting my personal expenses would be only 15,000. That means I am capable of making repayment of an amount of only 15,000 rupees per annum. Yes or no? What is the amount of loan that I require? 5 lakhs. Let us assume that the applicable rate of interest on this loan is say 18% per annum. What is the amount of interest that I need to pay if this loan is granted? It is around, it is 9,000 rupees. So 90,000. Okay. 90,000 rupees. So amount of interest payable per annum is 90,000 rupees, whereas I am capable of making a payment of only 15,000 rupees. In this case, if you grant me a loan of 5 lakhs, is it practically possible for me to make the repayment of the loan? Certainly not. That is the reason why the banker will make a decision in the given case that loan should not be granted. Contrary to this, if the banker has assessed my average profit at say 3 lakh rupees per annum, I am getting an average profit of 3 lakh rupees per annum. If you were the banker, are you willing now to provide me a loan of 5 lakhs? Certainly yes. Your answer should be yes. Why? Because as per the previous discussion, the banker will treat that I deem that I will make use of 50% of my profit for meeting my personal expenses. So out of 3 lakhs, I will use 1,50,000 for meeting my personal expenses. Remaining 1,50,000 can be used by me for making repayment of the loan. How much is the loan that I require from you? 5 lakhs. I am capable of making a repayment of how much per annum? 1,50,000 rupees. So if I keep on making payment for a period of 5 to 6 years, then it will be easier for me to make not only the repayment of the principal amount, but also the payment of interest. Now the banker satisfied that if a loan of 5 lakhs has been granted to the particular person, he is capable of making the repayment within a period of 4 to 5 years. When the banker satisfies your repayment capability, then the banker may decide to grant you a loan. When the banker has not satisfied with your repayment capability, the banker may decide not to grant a loan. How the bankers are assessing your repayment capability or creditworthiness? How the bankers are assessing the repayment capability or creditworthiness? by going through your financial statements. So everybody is making use of your financial statements for taking different types of decisions. That is what you need to understand from this discussion. The next one is even suppliers of goods. What is the next set of users of financial statements? Even suppliers of goods may make use of financial statements prepared by an entity, again for taking some decisions. Now the question is how suppliers make use of financial statements. I will try to explain this point very briefly because I know very well that you are having a very good knowledge of the concept of a ratio, and in fact the concept of analytical procedures, otherwise called as analytical review procedures. Do you know what is a gross profit ratio? How do you calculate a gross profit ratio? By applying a formula, gross profit divided by sales into 100. What is the formula to be used for calculating net profit ratio? Net profit divided by sales into 100. What is the formula to be used for calculation of current ratio? Current assets is to current liabilities, or current assets divided by current liabilities. What is the formula to be used for I am making an assumption that you are already having some knowledge of the subject, and I cannot explain the subject in a general way. Generally we do in ordinary batches. This is not an ordinary batch, this is a crash batch. So we are making an assumption that you are having some basic knowledge about the subject. Based on that only I am explaining all these things to you. So what is ROCE, return on capital employed? How do you calculate return on capital employed? By applying a formula. The formula is net profit divided by capital employed into 100. I have given you 4 examples. All 4 examples in the given case are unique in nature. In the first case, you are trying to establish a relationship between gross profit and sales. In the second case, you are trying to establish a relationship between net profit and sales. Gross profit is a debit item of trading account. Sale is a credit item of trading account. Net profit is a debit item of profit and loss account, whereas sale is a credit item of trading account. I repeat, for example, you calculated gross profit ratio at 10%. What is the meaning of that? What is the meaning of a gross profit ratio of 10%? If you make a sale of 1 rupee, you will get a gross profit of 10 paisa. If you make a sale of 100, you will get a gross profit of 10 rupees. If you make a sale of 1000, you will get a gross profit of 100. That means always your gross profit is 10% of your sales. Gross profit is an item that appears on the debit side of the trading account. Sale is an item that appears on the credit side of the trading account. They are independent from one another. That is the reason why one item is appearing on the debit side, the other item is appearing on the credit side. But still, you are capable of establishing a relationship between a debit item of trading account and a credit item of trading account. That relationship is technically called as a ratio. So ratio is nothing but a relationship. If you are able to establish some relationships between or among the elements of financial statements, if you are able to establish some relationships between or among the elements of financial statements, such relationships are to be technically called as ratios. In the given example, you are capable of establishing a relationship between a debit item of trading account and a credit item of trading account. That relationship is to be technically called as a ratio. Coming to the next one. What is the next ratio? Net profit ratio. How do you calculate net profit ratio? By applying a formula. What is the formula? Net profit divided by sales into 100. And assume that the net profit ratio is 1%. What does it mean? What does it mean? If you make a sale of 100, after meeting all the expenditure, you will get a net profit of 1 rupee. If you make a sale of 1 lakh, after meeting all the expenditure, you will get an amount of 1000 as net profit. This means always your net profit is 1% of your sales. Net profit is an item that appear on the debit side of the profit and loss account. Sale is an item that appear on the credit side of the trading account. They are different. They are appearing in different accounts. One item is appearing on the debit side, the other item is appearing on the credit side. Although they are independent of one another, now you are capable of establishing a relationship between a debit item of profit and loss account and a credit item of trading account. That relationship is also called as a ratio. What is the third one? Current ratio, which can be calculated by applying a formula: current assets is to current liabilities. Assuming the current assets at 5 lakh rupees, assuming current liabilities at 1 lakh rupees, the current ratio is 5:1. What is the meaning of a current ratio of 5:1? For every 1 rupee of current liability, you are having current assets worth rupees 5. That is the meaning of a current ratio of 5:1. That means your liability is 1 rupee, whereas you are having assets worth rupees 5. It will be very much easier for you to repay your liability of just 1 rupee with the assets you are having worth rupees 5. That is the meaning of a current ratio of 5:1. In that case also, you are trying to establish a relationship between an item of asset and an item of liability. They are not one and the same. One item is appearing on the asset side of the balance sheet, the other item is appearing on the liability side of the balance sheet. They are independent from one another, but still you are capable of establishing a relationship between them. That relationship is also technically called as a ratio. Unless you understand the importance of ratio, you cannot understand the concept called as analytical procedures in future, which is dealt with by standard on auditing 520. And the last one is return on capital employed, net profit divided by capital employed into 100, wherein you are trying to establish a relationship between a debit item of profit and loss account and an item of balance sheet. That is also technically called as a ratio. This is briefly about the importance of a ratio. At least by now, you should be in a position to specify what exactly is the meaning of a ratio. Can you give a one-word answer for the term, what is ratio? Ratio is nothing but a relationship. If you are able to establish a relationship between or among different items or different elements of financial statements, then such relationships are to be technically called as ratios. And suppliers of goods will also make use of your financial statements for taking some decisions. Let us assume that you are the supplier of raw material required by me. I approached you. I made a request to you to supply some goods to me on credit basis. I haven't entered into any business transaction with you earlier. I don't know you, but I'm asking you to supply some goods worth rupees 5 lakhs on credit basis. In that case, if you were the supplier, without knowing me, are you willing to supply goods to me on credit basis? Yes or no? There is no previous business relationship between us. I am asking you to supply raw material worth rupees 5 lakhs on credit basis. If you were the supplier, are you willing to supply the goods to me on credit basis? Certainly no. Before taking any decision about whether to supply goods to me on credit basis, otherwise called as whether to extend credit to me or not to extend credit to me, what the supplier wants to do. If you were the supplier, what you want to do before taking a decision about whether to extend credit to me or not to extend credit to me. What is meant by extending credit? Deciding that goods are to be supplied on credit basis. What is meant by non-extension of credit? Deciding not to supply goods on credit. So that is the decision that you need to make. In order to make that decision, what will you do? You will ask for my financial statements. I will provide you a copy of my financial statements. You will go through my balance sheet. We will try to calculate my current ratio, which stood at 5:1. Now I want to ask you a single question. If you were the supplier, if you identify my current ratio at 5:1, are you willing to supply goods to me on credit basis? Yes or no? Done. If my current ratio stood at 4:1, are you still willing to supply goods to me on credit basis? If it is 3 is to 1, if it is 2 is to 1, of course, because ideal current ratio is always 2 is to 1. If it is 1 is to 2 crores, yes, you heard it right. It is 1 is to 2 crores. My current liabilities are 2 crores and my current asset is only 1 rupee. In that case, if I require some goods from you on credit basis, are you willing to supply those goods to me on credit basis? Certainly not. Certainly not. So, what you need to understand from this is, even suppliers of goods will make use of financial statements prepared by an entity for taking decisions, such as whether to extend credit or not to extend credit. Last but not the least is even workers. Sometimes workers of the goods may make use of, workers of the entity may make use of financial statements prepared by the entity for taking decisions such as whether to agitate against the entity or not to agitate against the entity. Supposing that you are working in a particular organization for the last 10 years, supposing further that there is no increment in your salaries for the last 10 years, and you are having a plan to agitate against the entity for getting increased salaries. In that case, will you directly try to agitate against the entity, or should you go through the financial statements of the entity first? If I am asked to provide you an advice, I will give you an advice saying that first of all, before taking any decision about whether to agitate against the entity or not, you should go through the financial statements of the entity. Why? Because if the entity is getting very good amount of profits but is denying increase in your salaries, you may try to agitate against the entity. If the entity is not at all getting good amount of profits, how it is possible for the entity to increase or hike your salaries? So in order to take a decision about whether to agitate against the entity or not to agitate against the entity for increase in the salaries, what the employees or workers are expected to do? They are required to go through the financial statements. They are required to ascertain whether the entity is getting profits or is suffering with losses. If you observe that for the past 10 years, the entity in which you are working is getting very huge amount of profits, but the entity is denying increase in your salaries. In that case, if you were the workers, do you try to agitate against the entity or not? Yes or no? If you find that for the past 10 years, the entity in which you are working is suffering with huge losses, in that case, will you try to agitate against the entity? Certainly no. So, by this, what you need to even if you try to agitate, it's of no use. Why? Because the entity itself is suffering with losses. When the entity is suffering with huge losses, how it is possible for the entity to increase your salaries? That is the reason why, before taking any decision about whether to dash or to dash, whether to agitate against the entity or not to agitate against the entity, even workers will make use of financial statements. Not only this, even government authorities like income tax department, etc., will also make use of financial statements prepared by an SSE in order to ascertain whether income has been correctly reflected in the books of account and in the financial statements or not. These are all said to be the users of the financial statements. So, till now we had a discussion about 2 points. Point number 1, it is a necessity, it is a compulsion, it is an obligation on the part of every organization to maintain some basic books of account, because organizations do enter into voluminous transactions and because it is highly impossible or impracticable to remember the details of the transactions. And point number 2 is, at the end of every financial year, every organization is under obligation to prepare financial statements. The financial statements so prepared by the entity will be used by several persons for taking different types of decisions. This is point number 2. Now, point number 3. Let us assume that the financial statements have been wrongly prepared. Let us assume that an entity prepared their financial statements wrongly. Let us assume that the entity prepared their financial statements incorrectly. In that case, what may happen? if the entity prepares a wrong set of financial statements, incorrect financial statements, and if anybody makes use of such wrongly prepared or incorrectly prepared financial statements for taking some decisions, what may happen? The correctness or otherwise of the decisions taken by you will depend upon the correctness or otherwise of information that you make use of for taking decisions. Yes or no? The correctness or otherwise of decisions made by you would depend upon the correctness or otherwise of information that you make use of for taking decisions. If the information used by you is correct, decision made by you will become correct. If the information itself is wrong, your decision may become wrong. Simply speaking, the correctness or otherwise of any decision is dependent on the correctness or otherwise of information that you make use of for taking such decisions. Do you agree with this or not? Similar to that, there are, as discussed just now, there are several users of financial statements. By making use of financial statements, they do take different types of decisions. If these financial statements on the basis of which they are taking decisions were correctly prepared, then any decision taken using such correctly prepared financial statements would prove to be correct. If those financial statements are wrongly prepared or are incorrectly prepared, any decision taken using such wrongly prepared or incorrectly prepared financial statements would prove to be wrong. Yes or no? You need to provide some answers, otherwise I cannot go forward. The correctness or otherwise of decisions made by you is dependent upon the correctness or otherwise of information used by you for taking decisions. Yes or no? If information is correct, decisions would prove to be correct. If information is wrong, decisions will also prove to be wrong. Yes or no? Similarly, there are several users of financial statements. They make use of financial statements for taking different types of decisions. If those financial statements are correctly prepared, any decision taken using such correctly prepared financial statement would prove to be correct. If those financial statements are wrongly prepared or are incorrectly prepared, any decision taken using such wrongly prepared or incorrectly prepared financial statements will prove to be wrong. Yes or no? Done. Now the question is, why do entities prepare their financial statements wrongly? Or why entities may prepare their financial statements incorrectly? Generally, financial statements are correctly prepared. I am saying that sometimes the financial statements of the entity may be wrongly prepared or may be incorrectly prepared. In that case, if anybody makes use of such wrongly prepared or incorrectly prepared financial statements for taking any type of decisions, the decisions will also prove to be wrong. Now the question to understand is, why the financial statements of the entity may be wrongly prepared or may be incorrectly prepared. If you want to know the logic or rational, the reason behind this, you should have knowledge of two terms. The first one is the concept of fraud, and the second one is the concept of error. If you are having knowledge of the terms fraud and error, you can easily understand that, okay, because of these reasons, sometimes there is every chance that the financial statements of an entity may be wrongly or incorrectly prepared. In that case, if anybody makes use of such wrongly prepared or incorrectly prepared financial statements for taking any type of decisions, the decisions will also prove to be wrong. So to have a good understanding of this point, first of all, you must have an understanding of the terms fraud and error. What is fraud and what is error? First of all, let's have a discussion about the term fraud. Later on, we can focus on error. What is fraud? I will certainly try to explain you a small definition of fraud initially. Later on, while we are having a discussion on essay 240, we will deal with the original definition of fraud, which is given in essay 240. Or else, at the end of the introductory chapter, I will try to provide you the original definition of essay 240, fraud in essay 240. Fraud can be defined as intentional. Fraud can be defined as intentional, misstatements in financial statements. Fraud can be defined as intentional misstatements in financial statements. It is an easiest definition for fraud which anyone can understand. Because of this, I am sure you will get some conceptual knowledge about what is fraud and what is the impact of fraud on the financial statements. So what is fraud? Fraud can be defined as intentional misstatements in financial statements. Out of these three words, you know very well about the term financial statements. Just now I told you that the term financial statements includes manufacturing account, trading account, profit and loss account, profit and loss appropriation account, balance sheet, cash flow statement, statement of changes in equity, and so on. So the term financial statements is not new to you. Then you know very well about the general meaning of the term intentional. What is intentional? Deliberately, in order to deceive the other party. If you do any activity intentionally, or if you do any activity to deceive the other party, it is said that the thing done by you is intentional. If anybody includes some misstatements, if anybody includes some misstatements in the financial statements intentionally, then it is said that the person was involved in fraud. I repeat, fraud can be defined as intentional misstatements in financial statements. Intentional means deliberately, that is, in order to deceive the other party. The term definition of financial statements is well known to you. Now we need to focus on the term misstatements. On the term misstatements. This is a term that you need to understand and remember for your lifetime. Otherwise, you cannot understand the soul of auditing. So please try to focus on the term misstatement. Misstatement may be misstatement in the financial statements may be either the result of an omission, or a wrong statement. Misstatements may result either from omission or from a wrong statement. I repeat, misstatements are the results of either an omission or a wrong statement. Do you know what exactly is the difference between the terms omission and wrong statement? What is omission? What is the general meaning of omission? A transaction has taken place. When a transaction took place, it is the responsibility of the organization to record the details of the transaction immediately in a book called as journal. Yes or no? So you are under obligation to record the details of the transaction into some basic books of account as and when a transaction took place. But unfortunately, you decided to omit the transaction from the books of account. Transaction has taken place. It is required to be recorded in the books of account, but has not been so recorded in the books of account. You know very well that it is required to be recorded, but you haven't recorded the same in the books of account intentionally. That is called as dash omission. A transaction which is required to be recorded into the books of account, if not recorded into the books of account, it is technically called as omission.
Hello everyone, greetings of the day. Now you can purchase CA inter-auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have 3 exciting, convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views. And the material will be couriered to you, and at the same time, you can have PDF material on the screen. And option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Then what is a wrong statement? A transaction has taken place. The same has been recorded into books of account, but it has been recorded wrongly in the books of account. Have you understood the difference between the terms omission and wrong statement at least by now? So, if a transaction is completely omitted to be recorded from the books of account, it is called as a omission. If a transaction is incorrectly recorded in the books of account, it is called as a wrong statement. So, misstatements are the results of either an omission or a wrong statement. This is about the term misstatement. Now, you can easily understand what is the definition of fraud. Fraud can be defined as intentional misstatements in financial statements. Misstatement may be the result of either an omission or a wrong statement. Now, let us divide frauds into 2 broad categories. If you do not listen to this discussion carefully now, I won't give you any guarantee that you are going to understand SA 240 in future. Fraud and responsibilities of the auditor. It is a standard and it is a chapter in our syllabus as well. If you really want to understand SA 240, you must be very much careful to listen the concept of frauds which is being discussed now. So, you know very well about what is the meaning of fraud. And such frauds can be classified broadly into 2 categories. The first one is employee fraud. We can divide frauds into 2 categories. The first one is employee fraud and the second one is management fraud. What is employee fraud and what is management fraud? As the name implies, whenever any employees of the organization were involved in fraud, it is called as employee fraud. And whenever management itself involves in a fraud, it is called as management fraud. Now let's focus on employee fraud first. Generally, employees of the organization may involve in fraud, or employees may perpetrate fraud either through defalcation of cash, or through misappropriation, of assets. I repeat, what is fraud? Fraud can be defined as intentional misstatements in financial statements. Frauds can be classified broadly into 2 categories. The first one is employee fraud. The other one is management fraud. Whenever any employee of the organization was involved in fraud, it is called as employee fraud. When the management itself involves in a fraud, it is called as management fraud. Generally, employees of the organization do involve in fraud either through defalcation of cash or through misappropriation of assets. Now, how employees may defalcate cash? This discussion is very important. There are 4 ways through which an employee may defalcate cash. The first one is through suppression. of cash receipts. The first one is through suppression of cash receipts. The second one is through inflation of cash payments. First one is suppression of cash receipts. The second one is through inflation of cash payments. The third one is through including fictitious payments. payments. And the fourth one is by following or by adopting an approach called as teaming and ladding. Teaming and ladding. These four are the ways through which an employee of the entity may try to defalcate cash. What are the four ways? The first one is through suppression of cash receipts. The second one is through inflation of cash payments. The third one is through including fictitious payments. And the fourth one is by adopting a technique called as teaming and ladding. I will try to provide you an example for each and every method so that you may have a better understanding of how employee is able to defalcate cash by following such methods. The first one is suppression of cash receipts. Let us assume that you are the sole proprietor of a proprietary concern. Let us also assume that I am your employee. I am your employee. Now, you are not in the business establishment, you are not in the shop. I am the only person in the shop. Meanwhile, a customer came to the shop. Customer purchased goods worth rupees 100 from me. I am the employee. You are the sole proprietor. You are not in the establishment. I am the only person in the shop. Meanwhile, a customer came to the shop. Customer purchased goods worth rupees 100 from me. And immediately, customer started insisting me to issue a cash bill. Customer started insisting me to issue a cash bill. Actually, out of 100 rupees of sale that I made, I want to defalcate at least 50 out of it. The actual value of sale made by me is 100. Out of 100, I want to defalcate cash to the tune of 50. Unfortunately, the customer is insisting on the issuance of a cash bill. What happens if I issue a cash bill? You know very well that all important documents are required to be maintained by the organization in duplicate. Therefore, cash bills are also required to be maintained by the organization in duplicate. There will be a original cash bill, there will be a duplicate cash bill. In between original cash bill and duplicate cash bill, organization is required to insert a carbon paper. You need to write down the details of the sale on the original cash bill, and the impression of the same will be on the duplicate cash bill. Once cash bill is prepared, you need to tear off the original cash bill. It should be given or handed over to the customer, and a duplicate copy of the cash bill is retained by the organization for record purpose. Yes or no? So what has happened in the instant case? Proprietor is not there in the shop. Employee made a cash sale worth rupees 100. The customer started insisting the issuance of a cash bill. However, employee wants to defalcate at least 50 rupees out of 100 rupees. Cash bill is required to be prepared by the employee in duplicate. The first one is original, the other one is duplicate. Original is required to be teared off and given to the customer. Duplicate is required to be retained by the organization for record purpose. If you start writing cash bill, you will record the value of the sale as 100 on the original. Yes or no? If you record the value of the sale as 100 on the original, the impression of that will be there on the duplicate, and hence on the duplicate also an amount of 100 will appear as cash sale. Yes or no? In that case, is it really possible for the employee to defalcate an amount of 50 out of 100? Yes. How an employee can defalcate cash of 50 rupees out of 100 even where the customer is insisting on the issuance of a cash bill? The logic is so simple to understand. Without inserting a carbon paper, I will record the value of the sale made to the customer at 100 rupees on the original. It will be teared off and given to the customer. Later on, I put carbon paper on the duplicate. I will try to record the value of the sale not as 100 but as 50. So on the original, it was recorded as 100. On the duplicate, it has been recorded as 50. In this process, as an employee, I am able to defalcate cash to the tune of 50. Immediately, employee had to record an entry into books of account. If you were the employee who defalcated an amount of 50 rupees out of 100, what entry would you record in the books of account? Please mention the entry that you are going to record in the books of account, assuming that you misappropriated or defalcated an amount of 50 out of 100. What entry would you record? Cash account debtor. I do not require an entry. I need the amount that you are going to record. Cash account debtor 50 rupees to sales 50 rupees, being cash shall made to so and so, cash shall made wide cash bill number so and so. This is the entry that will be recorded by the employee in the books of account. Now I want to ask you two questions. What is the actual value of sale made? What is the actual value of sale made? The actual value of sale made is 100. What is the value recorded in the books of account? What is the value recorded in the books of account? 50. So actual value of sale made is 100. Value recorded in the books of account is only 50. In this process, the employee is able to defalcate cash to the tune of 50. Yes or no? So in the given case, it is said that through suppressing the cash received. How much is the actual cash received? 100. How much is the value recorded in the books of account? 50. So through suppressing the cash received from 100 to 50, employee is able to defalcate cash to the tune of 50. Since employee made some defalcation of cash in the given example, it is said that the employee of the organization was involved in fraud. At least now you should be able to understand this point in a detailed manner. Employees may involve in fraud either through defalcation of cash or through misappropriation of assets. Cash may be defalcated by the employee either through suppression of cash receipts or through inflation of cash payments or through including fictitious payments or by adopting a technique called as streaming and lading. What is about suppression of cash receipts, for which I have given you an example wherein the actual value of sale made by the employee is 100, but the value recorded by the employee in the books of account is only 50. That means employee suppressed the cash received from 100 to 50 and the same is recorded in the books of account. In that process, employee is able to defalcate an amount of 50 rupees. Now it is said that employee of the organization was involved in fraud. Yes or no? The most important question here is, what would be the impact? What would be the impact on the organization? What would be the impact on the organization whenever any employee of the organization involves in a fraud? In the given example, employee was involved in fraud. So what would be the impact on the organization when an employee of the organization involves in a fraud? There will be a twofold impact. There will be a twofold impact or a dual impact or a multiple impact on the organization whenever any employee of the organization involves in a fraud. Impact number one, organization will lose its valuable cash. Yes or no? Instead of handing over 100 rupees to the proprietor, employee will hand over only 50 rupees to the proprietor. In that case, what is the cash loss to the proprietor? What is the cash? I'm the employee. I made a cash sale of 100. It has been recorded in the books of account as 50. In the bill also, I recorded it as 50. I will hand over an amount of only 50 rupees to you. Actual value of sale made is 100. But the employee is giving only 50 rupees to the management. In that case, will there be any loss of cash to the management? Obviously, yes. So what is the first impact on the organization? Whenever any employee of the organization was involved in fraud, organization will lose its valuable cash. In the given example, the amount of cash lost by the organization is 50. 50 rupees is not a small amount. Out of 100, employee is able to defalcate an amount of 50. 50% of the receipt has been defalcated by the employee. And the most important impact on the organization is, the second impact is, the organization's financial statements will get adversely affected. In that case, the financial statements of such an organization will get adversely affected. This point is difficult to prove, difficult to understand. To prove it, I will give you an example. Listen to the example carefully. I am sure you will be able to understand the impact whenever any employee of the organization was involved in fraud on the financial statements. Let us assume that this is the only sale. This is the only sale made by that organization during that particular financial year. No other sale took place. Let us also assume that the organization is in the process of preparation of its trading account. How much amount will be reflected against the heading sales in the trading account of the organization when they start preparing their financial statements? 50. What is the actual value of sale? 100. What is the value recorded in the books of account? 50. What is the amount reflected in the trading account? 50. Can you now say that the trading account is correctly prepared? Of course, 50 rupees may be material amount. If it is 50,000, if it is 5 lakhs, if it is 50 lakhs, obviously it is said that the trading account is wrongly prepared. When trading account is incorrect, can you say that the P&L account is correctly prepared? Can you say that the balance sheet is correctly prepared? Can you say that the financial statements are correctly prepared? What happens if such wrongly prepared or incorrectly prepared financial statements have been used to take some decisions? The decisions taken by them will also prove to be wrong. By this, what you need to understand is, okay. Whenever any employee of the organization was involved in fraud, there will be a multiple impact on the organization. On one hand, the organization will lose its valuable cash. On the other hand, the financial statements of the organization are getting adversely affected. In that case, if it is said that financial statements are wrongly prepared or are incorrectly prepared, in that case, if anybody makes use of such wrongly prepared or incorrectly prepared financial statements for taking any type of decisions, the decisions taken by them will also prove to be wrong. This is the first point or first method through which dash can involve in dash. This is the first method, that is suppression of cash receipts, through which an employee of the organization may involve in defalcation of cash. So defalcation of cash will have a multiple impact. The first one is organization lose its valuable cash, and the second one is financial statements of such an organization are getting adversely affected. That is point number 1. Point number 2, inflation of cash payments. This is very easy to understand. Let us, I will try to explain that point also with the help of an example. Employee had expended an amount of 50 rupees. Employee incurred an expenditure of 50 rupees for meeting local conveyance. Employee has to travel between the organization and a bank, for which employee hired an auto, and he paid an amount of 50 rupees to the auto driver for traveling between the organization and the bank. That amount is technically known as local conveyance. So the actual expenditure incurred by the employee for meeting local conveyance expenses is 50, but it has been reported by the employee to the proprietor and not as 50 but as 100. Proprietor has given me an amount, given the employee an amount of 100. If you were the employee, what entry would you record in the books of account in that case? Local conveyance account debtor 100 rupees to cash 100 rupees. What is the actual amount incurred by the employee towards meeting local conveyance expenses? It is only 50. What is the amount reported by him to the proprietor? It is 100. What is the entry recorded in the books of account? Local conveyance has been debited with an amount of 100 and cash has been credited with an amount of 100. This is nothing but technically called as inflation of cash payment. Actual payment made is 50, but it has been reported as 100. Therefore, it is called as inflation of cash payment. Now, I want to ask you the same question again. What is the impact of this on the organization? In the given case also, employee was involved in fraud. What is the impact of this on the organization? Again, there will be a twofold impact on the organization. Organization lost an amount of 50 rupees, and let us assume that this is the only payment made towards local conveyance. Let us also assume that the entity is in the process of preparation of their financial statements. How much amount will be debited to the profit and loss account against the heading local conveyance in the financial statements? 100. What is the actual value incurred? 50. What is the amount recorded in the books of account? 100. What is the amount reflected in the financial statements? 100. Can you now say that P&L account is correctly prepared? Balance sheet is correctly prepared? Financial statements are correctly prepared? What happens if anybody makes use of such wrongly prepared or incorrectly prepared financial statements? The decisions taken by them will also prove to be wrong. Yes or no? Now I want to ask you some more questions. In the previous case, that is suppression of cash receipts, actual value of sale made by the employee is 100, but it has been recorded in the books of account as 50, and that is the entry that has been recorded by the employee in that case. I want to ask you one question. Is this entry recorded by the employee in the books of account a genuine entry, or is it a fraudulent entry? Can you say this entry recorded by the employee as a genuine entry or a fraudulent entry? Obviously, that is not genuine. Hence, it is called as a fraudulent entry. Whenever any employee of the organization involves in a fraud, the person who is involving in fraud will certainly try to conceal it. Yes or no? They don't want to reveal that they were involved in fraud. They will certainly try to conceal it. Yes or no? Now, in order to conceal, within 5 minutes, I am going to give you a break of 15 minutes. Right. In order to conceal the fraud perpetrated by the employee, what the employee did, employee tried to record a dash entry into books of account, a fraudulent entry into books of account. Yes or no? So, whenever any employee of the organization was involved in fraud, the employee will certainly try to conceal it. In order to conceal the fraud, the employee will record some fraudulent entries into books of account. That is point number 1. Now coming to the second method. What is the second method? Inflation of cash payments. So what is the entry recorded by the employee with respect to that? Local conveyance has been debited with 100, cash account has been credited with 100. I want to ask you the same question. Is this entry recorded in the books of account a genuine entry, or is it a fraudulent entry? Again, you can say that this entry is a fraudulent entry. By this, you should understand that, okay, whenever any employee involves in a fraud, he will try to conceal it. In order to conceal the fraud, employee may try to record some fraudulent entries into books of account. Now, the third way is including fictitious payments. Including fictitious payments. What is a fictitious payment? A payment which is not real is called as fictitious. Employee has not incurred any expenses relating to local conveyance. He had attended the bank by walk, but he has reported to the management that he used an auto for the sake of commuting between the entity and the bank, and he reported to the owner that he has incurred an amount of 100 rupees for meeting local conveyance, and owner gave him an amount of 100. Immediately, employee recorded an entry into the books of account debiting local conveyance with an amount of 100 and crediting cash with an amount of 100. These things may happen. Yes or no? Now, I want to ask you another question. The question is different from the previous two questions. In the previous two examples, I asked you whether the entry recorded by the employee is genuine or is fraudulent. Now the question going to be asked by me is different. Is this entry recorded by the employee a real entry or a fictitious entry? In the given case, it is said that the entry recorded by the employee is a fictitious entry. So you need to understand that, okay, whenever any employee involves in a fraud, he will certainly try to conceal it. In order to conceal the fraud, he will try to record either fraudulent entries or fictitious entries into books of account. So there is always a possibility. There is always a possibility that books may contain either fraudulent entries or fictitious entries because of the existence of employee fraud. Because of the existence of employee fraud, books may contain either fraudulent entries or fictitious entries. This is what you need to understand from this discussion. Okay. Now the time is 9:15. There is 2 more minutes left. I will try to explain you. I will try to explain you the concept of teaming and lading. Teaming and lading. Let us assume that the entity, a particular entity, is having 4 customers. The names of the customers are A, B, C, and D. Let us also assume that on a specific day, the organization made a credit sale of 1 lakh each to all their customers. And let us also assume that the entity has given a time of 2 months. The credit period granted by the entity for payment of this amount by the customer to the entity has been fixed at 2 months. Now, on a particular day, only a particular employee is there in the organization. The owner of the organization is not there. Only employee is there. Meanwhile, customer A came to the shop. Customer A had to pay an amount of 1 lakh to the organization, out of which he want to pay an amount of 80,000. Don't try to compare this with the income tax provisions that you know. Particularly section 40A3 of the Income Tax Act says that cash payment should not exceed 10,000. This is only for the sake of example I am taking. Out of 1 lakh rupees, A wants to make a cash payment of 80,000 rupees. Only the employee is there in the shop. Owner of the shop is not there. Immediately after receipt of this 80,000 rupees, employee decided to misappropriate or to defalcate at least 20,000 rupees out of that 80,000 rupees. Immediately after making payment of 80,000, customer A insists the employee to provide a cash receipt to him. So you are the employee, you want to defalcate an amount of 20,000 out of 80,000 received from a customer called as A. Customer is insisting you to give a cash receipt. Now in that case, if you were the employee, is it possible for you to defalcate an amount of 20,000 out of 80,000, particularly where the customer is insisting on the issuance of a cash receipt? Yes. Why not? Without inserting carbon paper, you will record the original as 80. Later on, by putting carbon paper, you will record the amount received from the customer not as 80 but as 60. Thereby, you will be able to defalcate cash to the tune of 20,000. And you made an entry into books of account. You have posted it to A account as well. Opened ledger and posted the same into A account. Now A account is appearing in the books of account of the entity as like this. 2 sales, 1 lakh, by cash 60,000. What is the actual amount received from the customer? 80,000. What is the amount accounted for? It is only 60,000. Now what is the balance appearing in A's account? 40,000. What should be the balance in A account? If the entire amount has been properly accounted for, what should be the balance in A account? 20,000. But what is the balance appearing in A account? It is 40,000. So the balance that is appearing in A account is wrong. Yes or no? Now the employee started thinking of how this amount of 20,000 is to be adjusted to A account. Meanwhile, after few days, B came to the organization. He has to pay an amount of 1 lakh, out of which he wants to repay an amount of 60,000. As usual, owner is not there in the shop. You are the only person in the shop. Now what will you do? This is most important to understand the concept of teaming and lading. How much is the amount received from B? 60,000. Without inserting carbon paper, you will prepare a cash receipt in the name of B for 40,000. On the original, you will record it as 60,000. On the duplicate, you will record it as 40,000. Then what about the remaining 20,000? You received 60. You prepared cash receipt only for 40. What about the remaining 20,000? For that remaining 20, don't try to defalcate that amount as well. Instead, you need to adjust that difference amount of 20,000 to A account. For that, the employee prepared another cash receipt in the name of dash. Amount is not received from A, amount is received from B. Some portion of amount received from B is adjusted to B account and the remaining portion has been adjusted to A account. So a cash receipt for an amount of 20,000 has been prepared on A and immediately the same is posted in A's account. Now, what is the balance that is appearing in A's account? 20,000. What should be the balance in A account? 20,000. So there is a difference in A account. The difference has been adjusted by employee. Yes or no? But there is a difference now in B account. What is the actual amount receivable from B? It is 60,000. It is 1 lakh. Out of which, how much is the actual amount paid by B? 60,000. What should be the balance in B account? 40,000. But what will be the balance in B account? The balance in B account shall appear at 60,000. Why? Because the entire amount received from B is not properly accounted for. Now, how to adjust the difference in B account? When you receive money from C, you will make some portion of it adjusted to B and remaining portion may be adjusted to C. This approach will be continuously followed by the employee. In that case, it is said that the employee was involved in a technique called as dash, teaming and lading. So we had a discussion about how employees of the organization may defalcate cash. There is another way through which employee may misappropriate or may involve in fraud. The other one is through misappropriation of assets. The best example for misappropriation of assets is nothing but stealing physical stocks by the employee. Employee may steal physical stock. That will be technically called as misappropriation of assets. Understanding misappropriation of assets is not difficult. But what is difficult is what happens when an employee misappropriates assets and how it affects the financial statements. Let us assume that an employee of the organization has stolen physical stock to the tune of say 360 items. Every day he used it to steal one stock item. As per stock register, the quantities of stock are being reflected at 1000 units or 1000 items. Every day the employee has stolen one item each. Therefore, a total of 360 items have been stolen by the employee during the year. Naturally, when an employee was involved in fraud through stealing physical stock, employee will not record anything in the stock register. So the quantities that are being reflected in the stock register are 1000, but the actual quantity of stock is say 640 units only. I repeat, the actual number of units of stock are 640, but they are being reflected as 1000 in the stock register. Let us assume that management has not made physical verification of its inventory at the end of the year. Management relied upon the stock quantities that are being reflected in the stock register. How much is the quantity being reflected in the stock register? 1000 units. Each and every unit has been valued at say 30 rupees, and hence the value of the stock has been arrived by the organization at 30,000 rupees. Whereas the actual value of stock held by the organization is not 30,000 rupees, but it is 19,200. but it is 19,200. So there is a difference of 10,800 rupees in the value of the stock. Stocks have been reflected in the financial statements at a higher amount worth rupees 10,800. In that case, it is said that the valuation of the closing stock done by the management is wrong. When valuation of closing stock becomes wrong, what accounts are getting affected? Trading account will get affected, P&L account gets affected, balance sheet gets affected. In other words, it is said that financial statements gets affected, and hence if anybody makes use of such wrongly prepared or incorrectly prepared financial statements for taking any decisions, the decisions will also prove to be wrong. By this, what I proved to you is, when an employee was involved in fraud through stealing of physical stock, otherwise called as misappropriation of assets, it has its impact, it has its negative impact on the entity's financial statements. In that case also, it is said that financial statements have been wrongly prepared or have been incorrectly prepared. This is all about employee fraud and the way in which employees involved in fraud and the impact of employee fraud on the organization's financial statements. That is what you need to understand. The most important thing in the entire discussion is the impact of employee fraud on the financial statements. Whenever employee involves in a fraud, financial statements gets adversely affected. That is what you need to understand from this discussion. Now, the other one is management fraud. You can understand why employees of the organization may involve in fraud, because the salary that is being paid to the employees may be very, very less, and employee may not be able to meet his personal needs out of that salary. In that case, employees may be forced to involve in fraud. So to some extent, we can understand the employee fraud. Now the question is, why management involves in fraud? Sometimes even management, otherwise sometimes called as those charged with governance, may also involve in fraud. Who are the persons, those charged with governance? Do you have any idea about the term those charged with governance? Usually the term those charged with governance is associated only with group companies. For example, there is a group called as Tata Group. Several companies are operating in Tata Group. Say TCS, Tata Consultancy Services, Tata Power, Tata Motors, Tata Steel, Tata Finance, and so on. For every company, for every individual company in the group, there will be some board of directors and managing director. Board of directors or managing director in respect of each and every company may be said to be the high authority in the organization. However, for all these group companies, there is a single person who is treated as responsible for everything. That person is technically called as those charged with governance. In our example, that person is Ratan Tata. Ratan Tata, the chairman of all the group companies, is said to be the person those charged with governance. No doubt, for every group company, there are board of directors. There is a managing director. They are said to be the highest authority in that company. But for all the group companies, only one person is there. That person is treated as highest authority for all the group companies. That person is called as those charged with governance. In the given case, Ratan Tata is said to be the person those charged with governance. Why the term those charged with governance has been used for that person? Because he is made responsible for taking strategic decisions. That person is made responsible for taking strategic decisions concerning the group companies. Strategic decisions are nothing but decisions like acquisitions, decisions like merger, demerger, continuation of a business, shutting down a business, entering into a new line of business. These are all technically called as strategic decisions. regular day-to-day decisions can be taken by the board of directors of each and every individual company. But these strategic decisions like acquisitions, mergers, demergers, entering into a new line of business, shutting down an existing business, these are all called as strategic decisions. They are expected to be taken not by board of directors of independent companies or individual companies in the group, but by a person called as those charged with governance. So sometimes in case of a single company, board of directors may be said to be both dash as well as dash. In case the company is single, it is not part of a group company, then the board of directors of that company will be called both as management of the company as well as those charged with governance. This is the concept of those charged with governance. So sometimes even management or those charged with governance may involve in fraud. Now the question, in that case, it is technically called as management fraud. Now the question is, why do management involves in fraud, and how management generally involves in fraud, and what is the impact on the financial statements when the management involves in a fraud? These three are the areas that we need to discuss elaboratively under the heading management fraud. What is the first one? Why management do involve in fraud? Generally, management of the organization involves in a fraud in order to achieve some desired objectives. Management will try to involve in fraud in order to achieve some desired objectives. The best example for the term desired objectives is to reduce the tax liability. To reduce the tax liability. For example, the entity is a sole proprietary concern. The entity under your audit is a sole proprietary concern. In the last year, he got a net profit of only 1 lakh rupees. Therefore, his tax liability in the previous year is 0. But for the current year, the proprietor got a profit of 10 lakhs. Since the net profit of the proprietor is more than the basic exemption limit, in the current year, the proprietor is required to pay some tax towards income tax. Proprietor do not want to make the payment of income tax, despite of the fact that he got a profit of 10 lakhs as against a profit of 1 lakh in the previous year. Now, what the proprietor can do to evade tax? What the proprietor can do to evade tax? If you were the proprietor, if you want to evade tax, if you do not want to make payment of tax even for the current year, although you got a profit of 10 lakhs, how do you do that? How do you do that? You know very well that you got a profit of 10 lakhs, but instead of reporting a profit of 10 lakh rupees, if you are able to report a profit of only 1 lakh rupee, will there be any tax liability on the part of the proprietor? Yes or no? What is previous year's profit? 1 lakh. What is previous year's tax liability? 0. What is current year's profit? 10 lakh. Is there any tax liability on the organization for the current year? Yes. What the proprietor wants to do? The proprietor wants to evade tax. If you were the proprietor, what will you do to evade tax? Although you got a profit of 10 lakhs for the current year, you will try to report it only as 1 lakh. Now the question is, how do you do that? The first point is completed. Why the management may try to involve in fraud? In order to achieve desired objective. What is the answer for the desired objective in the given example? Reducing the tax liability is the desired objective to the management. In order to achieve that objective, management was involved in fraud. That is the answer for the question why. Now, how do they involve in fraud? Generally, employees of the organization may try to involve in fraud either through defalcation of cash or through misappropriation of assets. Whereas management do involve in fraud not through defalcation of cash or not through misappropriation of assets, but through fraudulent financial reporting. they do involve in fraud through fraudulent financial reporting. What is meant by fraudulent financial reporting? I will try to explain this with the help of an example. Continuing the previous example, how much is the actual profit for the current year? 10 lakhs. How much is the profit that the management wants to reflect in its profit and loss account? 1 lakh. What are the ways available for the management to report a profit of just 1 lakh as against a profit of 10 lakhs? You can increase the expenses debited to profit and loss account. That is one way through which you can reduce your profitability, or you can provide excessive amount of depreciation, or you can create excessive provisions like provision for pending lawsuits, etc. You can treat a capital expenditure as revenue expenditure. There are several ways through which management can reduce its profits. In the instant case, the management decides to inflate the salaries. The management decides to inflate salaries. By inflating salaries which are debited to profit and loss account, management can reduce their profit from 10 lakh rupees to 1 lakh rupees. How much is the amount of salary that should be inflated to reduce profits from 10 lakhs to 1 lakh? Actual profit that you got is 10 lakhs. You want to reflect it as 1 lakh. How much should be the reduction in the profitability? 9 lakhs. If you want to reduce your profit by 9 lakhs, you need to inflate your salaries by how much? By 9 lakhs. Therefore, management made an entry. Management decided to inflate salaries, and to support that, management made an entry as on 31st March of the relevant financial year like this: debiting salaries with an amount of 9 lakh rupees and crediting outstanding salaries with an amount of 9 lakhs. You cannot write it either as cash or bank because cash balance may not be available. That is the reason why an amount of 9 lakhs has been debited to salaries account and the same is credited to outstanding salaries account. By writing this entry in the books of account, the management is able to achieve its objective. What was the original profit? 10 lakhs. What is the increase in the salaries amount? 9 lakhs. Now the profit of the company, of the entity, is reflected at only 1 lakh. So here the management had achieved its desired objective of reducing tax liability by reducing profits. For that purpose, management has recorded a dash entry into books of account. A dash entry into books of account. Fictitious entry. Oh, if the employees were involved in fraud, employee will try to conceal it either by recording a fraudulent entry or by recording a fictitious entry. If the management itself was involved in fraud, again management will also try to conceal it. In order to conceal that fraud, management may also record either fraudulent entries or, in most of the cases, fictitious entries. By this, you must understand that there is always a possibility. There is always a possibility that the books maintained by the company may include either fraudulent entries or fictitious entries. Books may include either fraudulent entries or fictitious entries, either because of the existence of employee fraud or because of the existence of management fraud. Who will write fraudulent entries and fictitious entries? Either employees or management will try to record either fraudulent entries or fictitious entries. Why should they record such entries in the books of account? In order to conceal the fraud. So there is always a possibility that the books may contain either fraudulent entries or fictitious entries, either because of the existence of employee fraud or because of the existence of management fraud. In that case, what may happen? If books contains either fraudulent entries or fictitious entries, trial balance is required to be prepared from such books. In that case, trial balance is said to be wrongly prepared. If the trial balance is wrong, financial statements are required to be prepared on the basis of trial balance. Then financial statements may also said to be wrongly prepared. What happens if a person If any person makes use of such wrongly prepared or incorrectly prepared financial statements, the decisions taken by them will also prove to be wrong. So in this discussion, I proved to you that because of the existence of dash, because of the existence of fraud, financial statements of the organization are getting affected. That fraud may be either an employee fraud or even a management fraud. That is all about the concept of fraud. So fraud can be defined as intentional misstatements in the financial statements. Misstatement may be the result of either an omission or a wrong statement. Frauds can be classified broadly into two categories, employee and management. When employees were involved in fraud, it is called as employee fraud. When management itself involves in a fraud, it is called as management fraud. Generally, employees of the organization may perpetrate fraud either through defalcation of cash or through misappropriation of assets. Defalcation of cash can be done by the employee by following any one of the following four ways: suppression of cash receipts, inflation of cash payments, including fictitious payments, and by adopting a technique called as streaming and lading. In every case, the employee who was involved in fraud will try to conceal it. In order to conceal the fraud, the employee may record either fraudulent entries or fictitious entries in the books of account. Similarly, sometimes even management of the entity may try to involve in fraud. Management has its own reasons to involve in fraud. In order to achieve some objectives, management would try to involve in fraud. When either employee or management tries to involve in fraud, they will try to conceal it. In order to conceal the fraud perpetrated by them, they will try to record some fraudulent or fictitious entries into books of account. So there is every possibility that books may contain either dash entries or dash entries, either fraudulent entries or fictitious entries, which are the results of either fraud or error. Because of the existence of such fraudulent or fictitious entries, it is said that books are not properly prepared. When the books are not properly prepared, it is said that financial statements are also not properly prepared, because the base for preparation of financial statements is nothing but books, and books are not properly prepared. If anybody makes use of such financial statements for the purpose of taking any decision, the decision taken by them will prove to be wrong. Now, the only point that we need to discuss under this heading is about error. You know very well about what is error and what is the major difference between fraud and error. Error can be defined as an unintentional mistake. Error can be defined as an unintentional mistake in the financial statements. An unintentional mistake in the financial statements. So the only difference between fraud and error is intention. If you do it intentionally, it is called as fraud. If you do it unintentionally, it is called as error. Though the only difference, the distinguishing line between fraud and error is very, very thin. If you do it intentionally, it is called as fraud. If you do it unintentionally, it is called as error. But unfortunately, both will have the same impact on the financial statements. Whether you do it intentionally or do it unintentionally, they both fraud and error will have the same impact on the financial statements. What is meant by same impact on the financial statements? When there is a fraud, financial statements gets affected. Similar to that, when there is an error, again financial statements will get affected. Now the question is, how financial statements gets affected? How financial statements gets affected because of the existence of an error. Previously, I proved that financial statements gets affected because of the existence of fraud. Now, I am going to prove that financial statements may even get affected because of the existence of dash, error. This point is somewhat difficult to understand. Please try to listen to this point carefully. You are the accountant of a particular organization. In page number 91 of the ledger, stationery account is appearing. Stationery account is appearing in page number 91 of the ledger. You are the accountant of the organization. Page number 91 is completed, but the financial year is not yet completed. Page is completed, year is not completed. In that case, what should you do? You need to carry out, you need to carry out the total of the page, and the total of the page is required to be carried forwarded. The total of the page is required to be carried forwarded to the next page. You are 91st page. The total of 91st page is required to be carried forwarded to 92nd page. You have totaled stationery account appearing in the 91st page. The total of stationery account is say 976. However, while carrying forward this total of 976 to the next page, that is 92nd page, by mistake the accountant carried forward it not as 976 but as 967. So amount to be carried forward is 976. Amount that is actually carried forwarded is 967. What is the difference? 9. So it may be either 9 rupees, sometimes it may be 90 lakhs, sometimes it may be 9 crores as well. In the given example, it is only 9. So the amount to be carried forward is 976. Amount actually carried forwarded is 967. The difference is 9. Now, at the end of the year is completed. At the end of the year, accountant started preparing trial balance. Unfortunately, trial balance has not agreed. Why? Because there is a mistake. There is a mistake in carrying forward the total of stationery account from one page to another page. Remember, this was not done intentionally. Yes or no? There is no intention on the part of the accountant to carry forward the balance incorrectly. That is purely done by mistake, by overlook. It has been done. Therefore, this cannot be called as a fraud. This can be called only as error. Now, trial balance hasn't agreed. Therefore, what the accountant did is the difference of amount of 9 rupees has been adjusted by the accountant in say sales account or in say rent account. Difference is in respect of which account? Stationery account. But the difference has been adjusted by the accountant in which account? Sales account or rent account. Then accountant prepared financial statements on the basis of such trial balance. In such case, can you say that those financial statements are reliable? Can you say that those financial statements are correctly prepared? Certainly not. Of course, in the given example, the difference is only 9. So, since the difference is immaterial, some of you people may say that although there is a difference of 9 rupees, since it is immaterial, you can ignore it. If the difference is 90 lakh rupees, if the difference is 9 crore rupees, can you now say that financial statements are correctly prepared? Can you rely on such financial statements for taking any decisions? Why? Because there occurs an error. So even if there is an error, dash are getting affected. Financial statements are getting affected. So financial statements may get affected either because of the existence of dash or because of the existence of dash. Either because of the existence of fraud or because of the existence of error. Are you following? Done. So this is about the concept of fraud and error in detail. Why we had a discussion about fraud and error? Because I said to you that several persons are taking different types of decisions by making use of financial statements. If those financial statements are correctly prepared, any decision taken using such correctly prepared financial statements would prove to be correct. If financial statements are wrongly prepared, any decision taken using such wrongly prepared financial statements will prove to be wrong. Then why financial statements are wrongly prepared? Either because of the existence of fraud or because of the existence of error. I proved that financial statements gets affected because of the existence of fraud or because of the existence of error. So there is always a possibility that financial statements may be wrong, may be incorrectly prepared. So users cannot rely. Users cannot rely on the financial statements prepared by the management. Say yes or no. I will try to give you another example so that you may have better understanding of this point. let us assume that there is a company called as A Limited. You are all the shareholders of that company. You are all the shareholders of the company. I am the management of the company. Just now, the management of the company prepared their financial statements, and a copy of the financial statements has been provided by the management to the shareholders. Now, after receipt of copy of the financial statements, what the shareholders could do? How shareholders could make use of the financial statements for taking some decisions. And shareholders knows very well that the decisions that they are going to make by using financial statements prepared by the management would depend upon the correctness or otherwise of the decisions they are going to be taken based on financial statements would depend upon the correctness or otherwise with which such financial statements are prepared. This point is very, very important. Be careful while listening to it. If you are unable to understand it, although there is a waste of time, I will try to repeat it. What is the example? You were the auditor of you were the shareholder of a company called as A Limited. I am the management of the company. Just now I have prepared my financial statements. A copy of the same is provided to you. You want to make use of financial statements for the purpose of taking some decisions. You know very well that the correctness or otherwise of the decisions to be taken by you is dependent upon the correctness or otherwise of the financial statements. Therefore, to ascertain whether financial statements have been correctly prepared or not, shareholder had asked the management like this: have you prepared these financial statements correctly? Have you prepared these financial statements correctly? Was the question posed by dash to dash? Was the question posed by the shareholders to the management? I am the management of the entity. I was involved in preparing financial statements. I was involved in fraud. And I know very well that financial statements prepared by me are wrong. I know very well that the financial statements prepared by me are incorrect. You are asking me about whether financial statements are correctly prepared or not. In that case, if you were the management, will you say that financial statements are correctly prepared, or will you say that financial statements are wrongly prepared? Although you know that financial statements are wrongly prepared, you will always say that financial statements are correctly prepared. Yes or no? So in the given example, management was involved in fraud. Management knows very well that the financial statements prepared by them are wrong. But still, when asked, management is giving a reply saying that they have been correctly prepared, although they are wrongly prepared, although they are incorrectly prepared. This is scenario number 1. Scenario number 2. Management is very much honest. Management was very much honest. Management was not involved in fraud. Management has not resorted to fraudulent financial reporting. But unfortunately, several of the employees of the organization were involved in fraud, and unfortunately, management do not know that some of their employees were involved in fraud. In that case, when the shareholder raised a question like this, have you prepared the financial statements correctly? What answer could the management provide to the shareholders? Management will think of itself. We were not involved in fraud while preparing financial statements. We don't know that the employees of the organization were also involved in fraud. Therefore, nobody was involved in fraud. So probably financial statements prepared by us may be fair, and hence management will provide a reply to the users that the financial statements are properly prepared, although they were improperly prepared. By this, what you need to understand is, management will always provide a single answer. What is the answer provided by the management? That financial statements are correctly prepared, although they were incorrectly prepared, either because of the existence of dash or because of the existence of dash. Either because of the existence of employee fraud or because of the existence of management fraud, existence of employee or management fraud, financial statements could have been wrongly prepared. But management will always say that financial statements are correctly prepared. Therefore, the words of the management are not reliable. The words of the management are not reliable to the users of the financial statements. Words are not reliable to the users. Hence, generally, users cannot rely on the words of the management. Therefore, generally, users do insist the management to appoint. Users do insist the management to appoint an independent person. Users do insist the management to appoint an independent person. That independent person should have an expert knowledge. Should have an expert knowledge of that independent person should have an expert knowledge of accounting and auditing. I repeat, always management will say that financial statements are correctly prepared, although they are incorrectly prepared or wrongly prepared. Hence, words of the management are not reliable to the users of the financial statements. Therefore, users will insist the management to appoint an independent person. That independent person should have an expert knowledge in accounting and auditing. That independent person to be appointed is technically called as auditor. By appointing an independent person called as auditor, management had to provide the financial statements prepared by them to the auditor. Since that auditor is having an expert knowledge of accounting and auditing, he will thoroughly check or verify financial statements. He will try to form an opinion about whether such financial statements are correctly prepared or not. I am not still using the term true and fair view. I am just using the term whether they are correctly prepared or not, and the opinion so formed shall be expressed. The opinion so formed shall be expressed to whom? Expressed to the users of financial statements. I repeat, the words of the management are not reliable to the users of the financial statements. Sometimes management itself may have involved in fraud. Sometimes employees of the organization may be involved in fraud which is not known to the management. In both the cases, management will say that financial statements are correctly prepared, although they are wrongly or incorrectly prepared. Hence, the words of the management are not reliable to the users of the financial statements. Hence, users of the financial statements insist management to appoint an independent person having an expert knowledge of accounting and auditing. Such an independent person should be technically called as auditor. Once an auditor is appointed, entity is required to provide financial statements prepared by them to that auditor. That auditor will thoroughly verify financial statements, will form an opinion about whether such financial statements have been correctly prepared or not. And once an opinion is formed, he is supposed to express such opinion to the users of the financial statements. Since an expert has checked the financial statements, since an expert has given an opinion that financial statements have been correctly prepared, instead of management, they can safely rely more on the words of dash than the words of dash. Users of the financial statements can rely more on the words of the auditor rather than the words of the management. This is where there arises a need of conducting an audit. The person who is conducting an audit of financial statements to form an opinion and to express an opinion about whether such financial statements are correctly prepared or not is being technically called as auditor. He is having competence to perform the audit. He is having knowledge to perform the audit. Since a knowledgeable person performed the audit, since a knowledgeable person has given an opinion thereon, the opinion given by that knowledgeable person is more reliable to the users than the opinion given by the management. That is the reason why there arises a concept called as auditing. This is about the concept of auditing wherein management's words are not reliable. Hence, users generally insist management to appoint a person called as auditor. Words of the auditor are more reliable to the users than the words of the management. Hence, there arises a concept called as auditing. Now, if you were appointed as the auditor of an entity, you have been appointed as the auditor of an entity. Let us assume when you go for an audit, you have been provided with the financial statements prepared by the entity. If you were the auditor, what would be your duty now? You have been appointed as the auditor of an entity. When you go for the audit, financial statements have been provided to you by the entity. Now, as an auditor, what will you do? What is your responsibility as an auditor? You need to verify the financial statements. You need to form an opinion about such financial statements, whether they are properly prepared or not. Yes or no? How do you know whether these financial statements are properly prepared or not? For this purpose, first of all, you must be able to recollect what we discussed in the previous session. I said to you that first of all, the organization will enter into a transaction. Later, the details or particulars of the transaction shall be recorded in a book called as a journal. Later, the same will be transferred to another book called as a ledger. At the end of the year, the ledgers are totaled, the balances of the ledger will be extracted, and from such balances of the ledger, entity will prepare trial balance. If such trial balance agrees, from such trial balance, entity will prepare financial statements. Now you are the auditor, you have been provided with these financial statements. You are required to form an opinion on these financial statements, and you need to express such opinion to the users of the financial statements. You know very well that what is the immediate source for preparation of these financial statements? From where financial statements are prepared? What is the immediate source for preparation of financial statements? Trial balance. So obviously, correctness or otherwise of financial statements would depend upon the correctness or otherwise of trial balance. Yes or no? So in order to check whether financial statements are correctly prepared or not, you need to check whether a trial balance is correctly prepared or not. What is the immediate source for preparation of trial balance? Ledger. So correctness or otherwise of trial balance would depend upon the correctness or otherwise of ledger. What is the immediate source for preparation of ledger? Journal. So correctness or otherwise of ledger would depend upon the correctness or otherwise of journal. Again, you have been provided with financial statements. Correctness or otherwise of financial statements would depend upon correctness or otherwise of trial balance. Correctness or otherwise of trial balance would depend upon the correctness or otherwise of ledger. Correctness or otherwise of ledger would depend upon the correctness or otherwise of journal. Therefore, if you were appointed as an auditor and if you have been provided with the financial statements, ask the entity to provide all the books and other related records that have maintained along with the trial balance. Financial statements alone are not sufficient. Financial statements alone are not sufficient for the auditor to form and to express an opinion on such financial statements. You need to insist the management to provide books and other related records. Then management will provide such books to you. Now what the auditor should do? Auditor should start performing his work from the journal. Why? Because ultimately, financial statements are prepared from those books of account. If those books are found to be correct, financial statements may be said to be properly prepared. Therefore, you need to focus not on financial statements. You need to focus on the books of account. The very first book maintained by the entity is journal. Therefore, first of all, you need to verify the correctness of journal. How do you do that? How do you do that? Journal contains several entries, thousands and thousands of entries. If all the entries that are recorded in the journal were found to be correct, you can say that journal is correctly prepared. Yes or no? If all the entries that were recorded in the journal were found to be correct, you can say that journal is properly prepared. So in order to check whether journal is properly prepared or not, auditor should verify each and every entry in the journal with the help of supporting documentary evidences. with the help of supporting documentary evidence. That process of examination of each and every entry in the journal with the help of supporting documentary evidences is technically called as watching. Is technically called as watching. So what is watching? Watching is nothing but checking an entry in the journal with the help of, or examination of an entry in the journal with the help of supporting documentary evidences. Yes or no? Sometimes only one documentary evidence may be available. Sometimes more than one documentary evidence may be available. With the help of supporting documentary evidence is nothing but proof. Evidence is nothing but proof. In layman's language, evidence is nothing but a proof which proves that the transaction had really taken place. Which proves that the transaction had really taken place. I repeat, correctness of financial statements depend on journal, and hence first of all you need to focus on the correctness of the journal. Journal may contain several entries. If all the entries recorded in the journal were correct, you can say that journal is properly prepared. Therefore, you need to verify the correctness of each and every entry in the journal with the help of supporting documentary evidences. That process of examination of an entry in the journal with the help of supporting documentary evidences is technically called as dash. Is technically called as watching. Why do we conduct watching? Watching is documentary evidence is nothing but a proof of the transaction. Whether transaction has really taken place or not can be checked by you with the help of a proof. That is being called by me as watcher. And what do you do is technically called as watching. Checking a voucher is called as watching. Why you are checking a voucher? To verify whether transactions recorded in the journal are correct or not. You know very well that sometimes employees of the organization may involve in fraud. Sometimes management may also involve in fraud. You know very well that when a person was involved in fraud, he will try to conceal it. In order to conceal the frauds, they may record either fraudulent entries or fictitious entries into journal. So there is always a possibility that dash may contain either dash or dash, either due to dash or due to dash. There is always a possibility that journal may contain either fraudulent entries or fictitious entries, which is because of the existence of either employee fraud or management fraud. We cannot rely on the entries recorded in the journal. Therefore, being an auditor, it is our responsibility to verify the correctness of each and every entry in the journal with the help of proofs, if any available. That proof is being called in auditing as supporting documentary evidence. That process of examining whether each and every transaction in the journal is correct or not with the help of proof is technically called as watching. So you need to check each and every entry in the journal. You need to identify whether entry in the journal is genuine or is fraudulent. You need to check whether entry in the journal is real or fictitious. Every entry has to be checked like this by the auditor. Genuine or fraudulent, real or fictitious. That you can do with the help of supporting documentary evidences. That process is technically called as watching. And you have completed watching. And you have satisfied that each and every entry recorded in the journal is correct. There are no fraudulent entries in the journal. There are no fictitious entries in the journal. This is the conclusion the auditor reached by performing a technique called as watching. Now, if you were the auditor, can you say that financial statements are correctly prepared? Yes or no? No. Why? Because financial statements are not prepared directly from a journal. So first of all, you need to verify the correctness of journal. If you satisfy about the correctness of the journal, then you need to focus on the correctness of ledger.
Hello everyone, greetings of the day. Now you can purchase CA inter-auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have three exciting convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views, and the material will be couriered to you, and at the same time you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Yes or no? How do you check the correctness of ledger? How do you check the correctness of ledger? Checking the correctness of ledger is nothing but verifying whether an entry recorded in the journal, has correctly been transferred. As I am not still using the term posting, I am using the term just transferring. Yes, it is technically called as posting. You need to verify whether entry in the journal has correctly been transferred to ledger. That process of checking whether each and every entry in the journal has correctly been transferred to ledger is technically called as posting. You need to check postings also. What is meant by posting? Checking postings. By checking postings, the auditor should satisfy that the amount is transferred to correct head. The amount or entry is transferred to correct head, correct side, and correct amount. Correct head, correct side, and correct amount. What is meant by correct head, correct side, and correct amount? The first entry that is being reflected in the journal is like this: stationery account debtor to cash 100. This is the first entry that is recorded in the journal. Now you need to verify whether this entry is genuine or fraudulent, real or fictitious. For this, the auditor verified this entry with the help of cash bill. That cash bill is nothing but technically called as supporting documentary evidence, and auditor satisfied that this entry is a genuine and a real entry, and it is not a fraudulent or fictitious entry. So auditor satisfied about journal. Then what the auditor should do? You need to verify whether this entry in the journal has correctly been posted to ledger or correctly been transferred to ledger. What is meant by correct transfer from journal to ledger? To ensure that amounts in the journal have correctly been transferred to ledger, you need to check three things: whether it is correctly transferred to correct head, correct side, and correct amount. Simply speaking, you need to check whether that entry has been transferred to stationery account. If it is transferred to stationery account, then you can say that it is transferred to correct head. You need to verify whether that amount is debited whether that amount is debited to stationery account. When it is debited, you can say that it is correct side, it is transferred to the correct side. And when the amount appearing in the ledger is also 100, you can say that amount appearing in the journal is 100, amount appearing in the ledger is also 100. Therefore, the amount in the journal has correctly been transferred to ledger. So once you satisfy about correct head, correct side, and correct amount, you can say that entry in the journal has correctly been transferred to ledger. That process is technically called as dash postings. So initially you focused on the correctness of journal. Later on you focused on the correctness of ledger. Now the auditor concluded that each and every entry in the journal has correctly been posted to ledger. Now, as an auditor, can you say that the financial statements are reflecting, the financial statements are correctly prepared? Yes or no? No. Why? Because you need to focus not only on the correctness of journal and ledger, but you should also focus on the correctness of the totals of the ledger. You need to verify the correctness of the totals of the ledger. That is technically called as verifying arithmetical accuracy. That is also called as recalculation. That is also called as recalculation under Standard on Auditing 500. There are several audit procedures that are available for the auditor under SA 500 to obtain sufficient appropriate audit evidence. The following are some of the audit procedures: inquiry, inspection, observation, recalculation, reperformance, etc. So recalculation is nothing but checking the arithmetical accuracy. So you need to verify the correctness of the totals of the ledger. That checking of correctness of the totals of the ledgers is technically known as casting. Casting is nothing but technically called as totaling. In law, it is having a different meaning. In auditing, casting means totaling the ledger. Why you are totaling the ledger? To ascertain its arithmetical accuracy. The auditor also satisfied that the ledger is arithmetically accurate. Then you need to check the correctness of balancing in the ledger. Whether ledger balances are correctly extracted or not is also required to be seen by you. What is meant by balances are correctly extracted? Deducting debit balance from credit balance, or deducting credit balance from debit balance and arriving at the balance of the ledger is called as balancing of ledger. Once you satisfy that balancing is also correctly done, then you can say that trial balance is correctly prepared. Once you satisfy that trial balance is correctly prepared, you can say that financial statements, you can form an opinion that financial statements are correctly prepared. Hence, in that case, the auditor shall express his opinion. The auditor shall express his opinion to the users of the financial statements that the financial statements are reflecting a true and fair view. If you satisfy that financial statements are correctly prepared, you can say that financial statements are reflecting a true and fair view. 6 conditions were mentioned in Standard on Auditing 700. After we complete a discussion on SA 700, you will have better understanding of the term true and fair view. Do you know standards on auditing? CA Institute issued 2 types of standards. The first one is accounting standards. The second one is engagement standards. No. The second one is engagement standards. The first one is accounting standards. The second one is engagement standards. These engagement standards issued by CA Institute were classified broadly into 5 headings. The first one is standards on quality control. The second one is standards on auditing. The third one is standards on review engagements. The fourth one is standards on assurance engagements, and the fifth one is standards on related services. So engagement standards issued by ICAI have been classified into 5 broad categories. The first one is standards on quality control. The second one is standards on the second one is standards on auditing. The third one is standards on review engagements. The fourth one is standards on assurance engagements. And the fifth one is standards on related services. Previously, all these types of standards were there in the CA final syllabus. But in the recent past, CA Institute has removed the last three even from CA final syllabus. So you are required to learn only about standards on quality control and standards on auditing even at CA final level. Standards on quality control is only one in number, whereas there are almost 45 standards on auditing issued by the CA Institute. Every auditor, while conducting every type of audit, is under obligation to follow what is mentioned in standards on auditing. You are under obligation to follow standards on auditing. Immediately you may get a doubt. What happens if a CA fails to follow standards on auditing? Where it is proved that a chartered accountant failed to follow standards on auditing while carrying out his audit, that chartered accountant shall be deemed to be guilty. That chartered accountant is deemed to be guilty of professional misconduct, and he shall be punished by the CA Institute accordingly. So if you fail to follow standards on auditing, you will be deemed to be guilty. You will be deemed to be guilty of professional misconduct. You will be treated as a person who has misconducted professionally, and then you will be punished by the CA Institute. That punishment to be given by the CA Institute to the erring chartered accountant may be ranging from cancellation of certificate of practice. Cancellation of certificate of practice for a minimum period of 3 months. Sometimes it may extend to 5 years, and in some extreme cases, the name of the member may be removed by the CA Institute permanently from the register of members. When the name of a chartered accountant has been removed permanently from the register of the members, that person shall no longer be treated as a chartered accountant, and he cannot have his name entered in such a register in his lifetime. That is the severity of punishment given by the CA Institute to an erring chartered accountant. So at least by now you should be able to understand that it is a compulsion. It is a compulsion on the part of every auditor while conducting every type of audit to compulsorily follow all standards on auditing. If you fail to follow standards on auditing, you will be deemed to be guilty of professional misconduct, and CA Institute will punish you accordingly. So following standards on auditing is nothing but a compulsion on the part of every auditor. That is what you need to understand from this discussion. Coming back to our original discussion. So one such standard that we are going to, such standards that we are going to discuss in near future is about standard on auditing 700. 6 conditions were given in SA 700. If you are conversant with those 6 conditions, then you can understand what is the exact meaning of the term true and fair view, when the auditor can say that financial statements are reflecting a true and fair view. Till then, you need to satisfy that. Okay, if as an auditor, if we conclude that financial statements are correctly prepared, you can say that the financial statements are reflecting a true and fair view. So, if anybody asks you about what is the primary responsibility of the auditor, if anybody asks you about what is the primary responsibility of the auditor, or what is the basic objective behind appointment of the auditor, what do you say? What is the basic objective behind appointment of the auditor? What do you say? What answer will you provide to them? The basic objective or primary objective behind appointment of the auditor is to form. The basic objective or primary objective behind appointment of the auditor is to form and to express. First of all, you need to form, and then you need to express an opinion. basic objective or primary objective behind appointment of the auditor is to form and to express an opinion on the financial statements, whether they are reflecting a true and not or and a fair view or not. Yadi may repeat change, please repeat it. What is the basic objective behind appointment of the auditor, or what is the primary objective behind appointment of the auditor? The basic or primary objective behind appointment of the auditor is to form and to express an opinion on the financial statements, whether they are reflecting a true and fair view or not. And the secondary objective, the primary objective is forming an opinion and expressing an opinion on the financial statements. The secondary objective behind appointment of the auditor is said to be detection of frauds. Detection of frauds and errors. Some of the people may not agree with this, but I'm sure I'll be able to prove that the secondary objective behind appointment of the auditor is detection of frauds and errors, which is mentioned in Essay 240 indirectly while having a discussion on Essay 240, which exclusively deals with the responsibilities of the auditor in relation to frauds. I will prove it. So, as of now, you can understand like this. The secondary objective behind appointment of the auditor is detection of frauds and errors. Remember, auditor is not made responsible for preventing frauds and errors. He is made responsible only for detection of frauds and errors. I want to ask you one single question, because you are having some knowledge, already having some knowledge of the subject. Please try to provide an answer for this. You were appointed as the auditor of an entity and you failed to detect frauds and errors. Then what would be the impact in that case? You have been appointed as the auditor of an entity. You have carried out the audit, but you failed to detect frauds and errors. That means there are several frauds and errors that took place in the organization. What happens when fraud or error took place in the organization? What happens when fraud or error took place in the organization? The books of account may contain either fraudulent entries or fictitious entries. When books contains fraudulent and fictitious entries, when financial statements are prepared from such books of account which contains fraudulent and fictitious entries, can you say that financial statements are correctly prepared or not? No, not correctly prepared. But unfortunately, the auditor failed to detect frauds and errors. Frauds and errors have taken place. Auditor failed to detect frauds and errors. In such case, as an auditor, what conclusion would you reach? There are no frauds. There are no errors. Since there are no frauds, there are no errors, there are no misstatements. There are misstatements are the results of either dash or dash. Misstatements or mistakes are the results of fraud or error. You concluded that there are no frauds, there are no errors. So you will conclude that there are no misstatements. Therefore, you conclude that financial statements are reflecting a true and fair view. But the reality is different. What is the reality? There are several frauds. There are several errors, because of which there are several mistakes or misstatements in the financial statements. Auditor failed to detect those mistakes or misstatements. Financial statements are not at all reflecting a true and fair view, but the auditor had given an opinion that they are reflecting a true and fair view. Are you following? If you need, I will repeat it again. Frauds have taken place, errors have taken place. Because of the existence of fraud or error, financial statements contain some mistakes or misstatements. Unfortunately, auditor failed to detect frauds and errors. Hence, auditor failed to detect misstatements in the financial statements. Hence, the auditor is of the opinion that financial statements do not contain any material misstatements. And hence, the auditor has given an opinion that they are reflecting a true and fair view. Actually, in practice, they are not reflecting a true and fair view. Financial statements are not reflecting a true and fair view, but the auditor had given an opinion that they are in fact reflecting a true and fair view. In that case, can you say that the opinion given by the auditor as a correct opinion? Why the auditor has given a wrong opinion? Why in the given case, in the instant case, the auditor has given a wrong opinion? Because the auditor failed. Because the auditor failed in detecting frauds and errors. Had the auditor detected frauds and errors, the auditor could have given a correct opinion. By this, you need to understand that, okay, if we are able to detect frauds and errors, we are going to give a correct opinion. If you fail to detect frauds and errors, the opinion given by us also will become wrong. So if you were the auditor, if you want to express a correct opinion, what the auditor should do? The auditor should be able to detect frauds. That is the reason why you must have knowledge of what is fraud and what is error. Without having knowledge of what is fraud and what is error, without having how they happen, without having what would be the impact of such frauds and errors on the financial statements, as an auditor, you cannot detect frauds and errors. That is the reason why the concept of fraud and error has been explained to you, and that is the reason why I am going to explain essay 240 also in near future. Then you will understand that, okay, this is fraud, this is error, this is the way in which frauds may take place, this is the way in which error may take place, this is the impact of fraud on the financial statements, this is the impact of error on the financial statements. These are all the reasons why frauds may take place. These are all the reasons why errors may take place. This is the impact of fraud on the financial statements. This is the impact of error on the financial statements. These are the procedures that we need to follow to detect frauds and errors. All these things are known, will be known to you once we complete a discussion on essay 240. So it is your secondary responsibility as an auditor to detect frauds and errors. So auditor is not made responsible for prevention, but he is made responsible for detection. When somebody is made secondarily responsible, some other person should be made primarily responsible. Yes or no? When I say that I came second in a running race, somebody should have got a first place. Yes or no? So it is my responsibility, it is my secondary responsibility as an auditor to detect frauds and errors. When auditor is made secondarily responsible, somebody should have been made primarily responsible for that. Who is made primarily responsible? Management is made primarily responsible, not only for detection, but also for prevention of frauds and errors. So management of an entity is made primarily responsible both for a dash as well as for a dash, both for prevention as well as for detection of frauds and errors, both for prevention as well as detection of frauds and errors. Remember, auditor's responsibility is limited only to dash, detection, whereas management responsibility extends even to prevention. Then how management can discharge, how management can discharge its primary responsibility of prevention and detection of frauds and errors. There is only one way, there is only one alternative available. There is only one alternative available for the management to discharge their primary responsibility of prevention and detection of frauds and errors. The only alternative available for the management is to introduce some internal controls. Is to introduce some internal controls. If you really want to understand essay 315 in future, the name of the essay 315 is like this: identifying and assessing the risks of material misstatements in the financial statements through understanding the entity and the environment, including internal controls. So if you really want to understand essay 315, you must listen to this point carefully. There is a chapter called as risk assessment and internal control. Unless you understand the concept of internal control, it will be very difficult for you to understand that chapter. So be careful. These are all the points that you are going to learn elaboratively in future in different chapters. So now the question is, what is internal control? And how, what is internal control, and how management can discharge its primary responsibility of prevention and detection of frauds and errors through introduction of internal controls. Through introduction of internal controls. I will try to give you several examples to have an understanding of the term internal control, which is very, very important. It will be there with you throughout your life, till your last breath. So everybody of you must be able to understand the term internal controls. What is internal control? There will be several phases. There will be several phases in a single transaction. There will be several phases in a single transaction. First of all,
Recording in progress.
there will be several phases in a single transaction. First of all, I will try to prove that there will be several phases in a single transaction. Later on, we can focus on the other aspect of this. What is phase of a transaction? Let us assume that I am working as a purchase manager. I am working as a purchase manager in an organization. Let us also assume that the following are my responsibilities as the purchase manager. The following are my responsibilities as the purchase manager. Duty number 1, I am made responsible to decide. I am made responsible to decide about whether to purchase raw material or not to purchase raw material. I repeat, as a purchase manager, I am made responsible to take a decision about whether to purchase raw material or not to purchase raw material. That is my first duty. Taking a decision about whether to purchase or not to purchase is my first duty as the purchase manager. Duty number 2, I am also made responsible to take a decision about the quantity of raw material to be purchased. First decision to be made by me is whether to purchase or not to purchase. Second decision to be made by me is about the quantity of purchase. I am also made responsible to take a decision about the supplier. About the supplier from whom these purchases are to be made. About the supplier from whom these purchases are to be made. Duty number 4, I am also made responsible to decide I am also made responsible to check the quantity of the goods as well as the quality of the goods after their receipt. And finally, I am made responsible to make the payment to the customer. To the supplier. To make the payment to the supplier. Please read all those 5 points. If you are able to understand these things, it will become easier for me to explain you the concept of internal control. What I said to you, there are several phases in a single transaction. To prove that there will be several phases in a single transaction, I provided you with an example. In that example, I am working as a purchase manager and I am made responsible for 5 things. The first one is taking a decision about whether to purchase or not to purchase. The second one is taking a decision about the quantity of material to be purchased. Third one, taking a decision about the supplier from whom purchases are to be made. The fourth one, I need to check the quantity as well as the quality of the material after their receipt. And finally, I am made responsible to make the payment to the supplier. In the given case, how many activities are being performed by purchase manager? Only one activity. The activity being performed by the purchase manager in the given case is purchase. Purchase is an activity being carried out by the purchase manager. All those things that I discussed with you till now are nothing but the phases of a purchase transaction. If you complete all those phases, it is said that you completed a single transaction called as a purchase. So in the given example, although it seems that purchase manager is carrying out several activities, no, purchase manager is not carrying out several activities. He is just carrying out a single activity. But there are several phases in that single activity. Is how it is possible for the management to create fear in the mind of the employee. How it is possible for the management to create fear in the mind of the employee. This point is also very important to understand the concept of internal controls in detail. Continuing the same example, I returned back to the shop after 10 days, and after some period of time, again I need to attend a family function. I cannot open the shop for a period of 10 days. I don't want to shut my shop for a period of 10 days. Therefore, I want to delegate my responsibilities again to the employees. But this time, I don't want to repeat the mistake that I have done earlier. Now, this time, I made my employees responsible for the following things. Please listen to the example carefully. This is a very good example and maybe somewhat difficult to understand. If you focus, you'll be able to understand this example. In the previous case, I made only one of my employees responsible. Now I want to make all my employees responsible for carrying out a transaction called as a sale transaction, and I divided the responsibilities between or among my employees in the following way. Employee A is made responsible to take a decision about whether to make sale or not to make sale. There ends the duty of employee A. He is not made responsible for anything else. He is just made responsible only to take a decision about whether to make sale or not to make sale. Employee B is made responsible for preparing a cash bill. Employee C is made responsible to collect cash, and employee D is made responsible to deliver the goods as well as to record the transaction into books of account. These are all the activities, or these are all the phases of sale activity which were performed by only one person in the previous example. Now those phases have been divided between or among different employees. Employee A is made responsible only for taking decision. Employee B is made responsible for preparing a cash bill. Employee C is responsible for collecting cash, and employee D is responsible for delivering the goods and recording the same into books of account. I divided the phases of a sale transaction in this manner. What advantage will I get by doing this? Please listen to it. A made a decision to sell a particular item at only 40 rupees, whereas the usual sale price of that item is 100 rupees. That means A wanted to involve in fraud by selling the item at a lower price. There ends the duty of A. A made a decision to sell item at 40 rupees per item. Now, who is made responsible for preparing and issuing a cash bill? B is made responsible for that. If you are B, if you are made responsible to prepare a cash bill for a particular item, while preparing the cash bill, would you like to verify whether what is the price at which the item is sold, and what is the usual? Would you like to compare what is the price at which the item is usually sold and what is the price at which the item is being sold now? Certainly yes. The person who is preparing the cash bill would obviously verify what is the usual price at which the item is sold and what is the price at which the item is being sold. What is the usual price at which this item is sold? 100 rupees. What is the price at which the item is sold now? It is only 40. So B, employee B, identified a huge difference between the usual selling price of that particular item and the selling price decided by A. Suspecting something wrong, B will immediately report the matter to the management. Like that, what is the responsibility of C? So, in the given example, the work carried out by dash has been verified by dash. the work carried out by employee A has been verified by employee B. They don't know that they are checking the work carried out by the previous person, but the phases have been arranged in such a way that work carried out by one person is automatically verified by another person. So what is the responsibility of C? He need to collect cash. While collecting the cash, obviously C will verify what is the amount for which bill is prepared. C will also verify what is the value of the bill. What is the usual price of sale price of that item? What is the price at which the item is being sold? That will be verified even by C. That means the work carried out by B as well as work carried out by A is being checked by whom? Is being checked by C. And finally, for D, what are the responsibilities of D? D is made responsible for dispatch or delivery of the goods, and he is also made responsible for recording the value of the sale into books of account. While recording the value of the sale into books of account, what D should do? D had to verify the cash bill. D had to check what is the price at which the sale is made and what is the usual price at which the sale is to be made. That means work carried out by A and B are again being checked by D. In this fashion, I arranged staff functions. Or I have divided the responsibilities. I have segregated the duties between or among more than one person in such a manner that the work done by one person is automatically verified by another person. I divided the responsibilities in such a manner that the work done by one person is automatically verified by another person. In the given example, work carried out by A is being checked by B. Work carried out by A and B is being checked by C. And the work carried out by all these persons is being checked by D. Every person knows very well that the work carried out by him will be checked by another person at a later point of time. So if you involve in fraud, somebody is going to verify it. If you involve in fraud, somebody is going to verify it and somebody is going to identify your fraud. If somebody identifies your fraud, immediately it will be reported to the top level management and the top level management will take severe action on you. It creates a fear in the mind of the employee. It creates a moral check on the employee. So the possibility of occurrence of frauds will naturally come down. This is the way through which you can either prevent the occurrence of fraud. When there is a moral check on the employee, some employees hesitate in involving in fraud. When an employee hesitates in involving in fraud, then it is said that you are able to prevent the occurrence of fraud. If somebody was already involved in fraud, somebody is going to verify that and may be able to identify that, may be able to report the same to the management. In that case, the occurred fraud has been detected. That means you are doing two things by segregating the duties or dividing the responsibilities. One is you are trying to prevent the occurrence of frauds. If they happen, you are trying to detect them. So this segregation of duties or division of responsibilities. This segregation of duties or division of responsibilities between or more than one person in such a manner that the work done by one person is automatically verified by another person is technically called as internal controls. So internal control is nothing but segregation of duties or division of responsibilities between or among more than one person in such a manner that the work done by one person is automatically verified by another person. That creates moral check on the employee. So the possibility of occurrence of frauds will come down. If frauds have taken place, obviously it will be detected. In that way, management is able to either to prevent or to detect frauds and errors. In fact, the starting point of our discussion is that management is made primarily responsible for what? Management is made primarily responsible for what? For both prevention as well as detection of frauds and errors. In order to prevent or detect frauds and errors, what is the only alternative available for the management? Establishment of internal controls. They are technically called as DIM. D means designing internal controls. I means implementation of internal controls, and M means maintenance of internal controls. All these things, for all these things, dash is made primarily responsible. Management is made primarily responsible for designing proper internal controls. Management is also made responsible for implementation of the designed internal controls, and management is responsible for maintenance, otherwise called as monitoring, otherwise called as supervising. They mean one and the same. Either you call it as maintenance of internal controls, or you call it as monitoring of internal controls, or you can call it as supervising internal controls. So DIM, management is made responsible for DIM, design, implementation, and maintenance. Maintenance can also be called as monitoring or supervision. That is the way in which management will always try to prevent or detect frauds and errors. Now, even if the management introduce internal controls, the possibility of occurrence of frauds and errors can be reduced, but the possibility of occurrence of frauds and errors cannot be eliminated. You know very well that because of the existence of internal controls, the possibility of occurrence of frauds and errors will get reduced, but you cannot eliminate the possibility of occurrence of frauds and errors. Why? Even by introducing internal controls, you cannot eliminate the possibility of occurrence of frauds. I will try to explain this point as well with the help of the same example. In the previous example, what the proprietor did, in the second case, the proprietor divided the responsibilities between or among more than one person in such a way that the work done by one person is automatically verified by another person, and now the proprietor feels secure. He knows very well that the work carried out by one person will be checked by another person. It will act as a moral check on the employee. So the proprietor is thinking that the possibility of occurrence of fraud is nil. What the proprietor is thinking is wrong. You may be able to reduce the possibility of occurrence of frauds, but you cannot eliminate the possibility of occurrence of frauds. Why? Why? Because let us assume that all the employees in the organization colluded with one another. There is a collusion between or among all the employees, which is not known to the management or to the proprietor. Now, one employee says to the other employee that the work carried out by you will not be verified by me. Work carried out by me should not be verified by some other person. All the employees colludes and they were involved in fraud, which cannot be detected or which cannot be prevented, because the person who is made responsible to check the work carried out by other person has not done it. In that case, obviously frauds could take place. So that is the reason why I am saying that if you introduce internal controls, it certainly reduces the possibility of occurrence of frauds, but it cannot eliminate the existence of or occurrence of frauds and errors. When there is a collusion, between or among employees, any type of internal control system can be defeated. When there is a collusion between or among the employees, any type of internal control system can be defeated. That is the reason why I am saying that even after establishment of internal controls, there is no guarantee that frauds will not take place. The possibility of occurrence of frauds gets reduced. It cannot be eliminated. This risk is technically called as control risk. If anybody knows very well about audit risk and its components, audit risk has three components. The first one is inherent risk, the second one is control risk, and the third one is detection risk. That control risk is having a link with the point that I just now discussed. Even if there are some internal controls, there is every possibility that frauds would have taken place because of collusion between or among the employees. In that case, the controls that you established won't work. In that case, there will be a risk of fraud. Hence, there will be a risk of misstatement in the financial statements. When there is a fraud, there is a risk of misstatement. That I have proved in the previous session. So, if there is a fraud, there will be a mistake or misstatement in the financial statements. So, possibility of occurrence of fraud can be reduced, but it cannot be eliminated. That risk is called as control risk that I will explain you in future, right? And I want to explain you some other point which is related to internal controls that will help you a lot, as well as that also helps me in explaining the subject in a better way in the near future. Therefore, I want to explain some more points relating to internal controls. The next point is establishment of internal controls. Establishment of internal controls is nothing but establishment of, this point is a key point to you, and you may have not listened this point earlier, and this is a very important point. Be careful. Establishment of internal controls is nothing but establishment of certain procedures. Establishment of certain procedures. That means if you are able to establish some procedures, it is said that you have established internal controls. I don't want to give a statement. I will try to prove it as well. So what is the statement? Establishment of internal controls is nothing but establishment of certain procedures. The literal meaning of that sentence is, if you establish some procedures, they are technically called as internal controls. And I will prove this with the help of an example. There is a sales manager in my organization. I am the management, and there is a sales manager in my organization. The management of the entity had established the following procedures. The management of the entity had established the following procedures in relation to their sales department. In relation to sales department. I repeat, I am the management of an entity. I am having a sales manager in my sales department. I established some procedures in relation to sales department. The following are the procedures that were established by the management. After explaining this point, I am going to ask you a question. Be ready for that and be ready to provide answer for that. If you are unable to answer, I will provide you the answer, no problem at all. But if you think of it and if you are able to provide an answer for that, it will give you immense satisfaction that you are able to understand the concept of internal control in detail. So, the following are the procedures that were established by the management in relation to the sales manager. Whenever the sales manager receives any sale order, do you know what is a sale order? A customer of the organization wants to purchase some goods. For that, he had to write the details of the goods that he wants to purchase from the organization. That paper written by our customer is technically called by him as purchase order. For the purchaser, it is called as purchase order. For the seller, it is called as sale order. So, whenever you receive any sale order from our customer, don't try to accept the sale order immediately. It is after receipt of the sale order, it is the responsibility of the head of the sales department to communicate with the head of the stores department. I am asking my sales manager to communicate with whom? With the head of stores department immediately after receipt of sale order. Why sales department manager is required to communicate with the stores department head after receipt of the sale order? Stores department head had to check. The stores department head had to check whether the item in question is readily available or not. When sales department head, when stores department or stock department head communicates with the sales head saying that the item in stock is readily available, then only the sales manager is expected to accept that order. Otherwise, sales manager should not accept that order. This is the first procedure This is the first procedure established by dash in relation to dash. This is the first procedure established by management in relation to their sales department. What is the procedure? Before acceptance of the sale order by the sales department head, he had to communicate with the stock department head to ascertain whether the goods in question, are readily available or not. The goods in question are readily available or not. So section 138 to section 148 of the Companies Act contains provisions relating to appointment of auditors and other allied matters, and hence the name of the chapter is Company Audit. How to appoint auditors of a company and other allied matters have been discussed in a chapter called as Company Audit, wherein we are going to have a discussion about 11 sections under Company Audit, that is from section 138 to section 148 of the Companies Act. Now let us start our discussion with section 143 subsection 1 of the Companies Act. 143 of the Companies Act, particularly section 143 subsection 1 of the Companies Act. Section 143 subsection 1 of the Companies Act contains both the rights of the auditor as well as the duties of the auditor. This section is a unique section in the sense that it contains both the rights of the auditor as well as the duties of the auditor. Whenever you are appointed as the auditor of a company, what are the rights that you will get from the Act and what are your duties? Everything about auditor's rights and auditor's duties under Companies Act have been given under section 143 subsection 1 of the Companies Act. Previously, the auditors of the company were called as statutory auditors. Previously, the auditor of a company were called as statutory auditor, but now the auditor of the company is being called as company auditor. They both are one and the same. In most of the cases, I use the term statutory auditor. Whenever I use the term statutory auditor, it means nothing but a company auditor. So what are the rights given by the Companies Act under section 143 subsection 1 of the Companies Act? Right number 1 is right of access. Right of access to books, vouchers and other relevant records. Other relevant records. This is right number 1 given to the company's auditor. Right of access to books, vouchers and other relevant records. First of all, try to understand why these rights are given to the auditor of the company. You know very well that as an auditor, you need to form and to express an opinion on the financial statements. In order to express an opinion, first of all, you need to check the correctness of the trial balance. Then you need to check, in order to ascertain the correctness of the trial balance, it is dependent upon the correctness of ledger. Correctness of ledger is dependent upon the correctness of a journal. So unless you verify journal, ledgers, subsidiary books, etc., it is not at all possible for you as an auditor to form an opinion about the truthness and fairness of the financial statements. Therefore, if you want to express an opinion, you should be given a right of access to books, vouchers and other relevant records. Thereby, you can check the books and other related records. You can form an opinion. The opinion so formed can be expressed to the users. So, auditor can discharge his primary responsibility of forming and expressing an opinion only when he has been given a right of access to books. That is the reason why the very first right that is given to the auditor of a company under the Companies Act is right of access to books, vouchers and other relevant records at all times. At all times. Here the term all times implies only during working days, that too during business hours. Only during working days, that too during business hours, the auditor can have an access to all the books, vouchers and other relevant records maintained by the company. As already said to you, Section 128 of the Companies Act deals with maintenance of provisions relating to maintenance of books of account and other related records, wherein I told you that company is required to maintain its books and other related records at its registered office. So during working days, that too during business hours, as the statutory auditor or company auditor, you are always having a right of access to books, vouchers and other relevant records. So at all times here implies only during business hours. Let us assume that the business hours of the company is from 9 a.m. to 6 p.m. So in between 9 a.m. to 6 p.m. you can have an access to books, vouchers and other relevant records anytime during the period of 9 a.m. to 6 p.m. that too only in working days. That is the meaning of the term at all times. Now let us focus on books, later on vouchers. What is book? The term books maintained by a company can be classified broadly. The term books maintained by a company can be classified broadly into three categories. The first one is statutory books. The second one is statistical books. The first one is statutory books. The second one is statistical books. And the third one is memoranda records. Repeat. Books that are generally maintained by a company can be classified broadly into three categories. The first one is statutory books. The second one is statistical books. The third one is memoranda records. What are statutory books? As statute, a law can also be called as a statute. Law can also be called as statute, and hence any book maintained as per the provisions of any law, any book maintained as per the provisions of any law for the time being in force can be technically called as a statutory book. Any statutory book maintained by a company can be verified by you as the auditor of that company. As already said to you, without giving a right of verifying the books, how it is possible for you as an auditor to form an opinion? When you are unable to form an opinion, how it is possible for you as an auditor to express an opinion? So in order to discharge your primary responsibility, you should be given a right of access to books. That is the reason why right of access to books is given. What are books? Books are of three types. The first one is statutory books. Second one is statistical books. The third one is memoranda records. What are statutory books? Any book maintained by the company under your audit, under any law for the time being in force, can be technically called as a statutory book. I will give you some examples of statutory books that are generally maintained. Statutory books that are generally maintained under the provisions of the Companies Act. The first one is Register of Shareholders, otherwise called as Register of Members. The second one is Register of Debenture Holders. The third one is Register of Charges. And the fourth one is Minutes Book. These are all said to be the best examples of the statutory books that are required to be maintained by every company. I know very well that you are having good knowledge about the terms Register of Members, Register of Debenture Holders, Register of Charges, Minutes Book, etc. These are all may have been learnt by you under corporate and other laws. So any book maintained by the company as per any law for the time being in force can be accessed by you as an auditor. That is point number one. The most important one here is Minutes Book. Why? Because you will come to know about the activities of the company only when you have been given a right of access to Minutes Book. The minutes may be of the minutes of the board of directors or even the minutes of the shareholders. In other words, minutes of the meetings of the board of directors as well as minutes of the meetings of the shareholders can be reviewed by you as an auditor. You can have an access you can have an access to the minutes book maintained either in respect of board meetings or even in respect of general meetings. You know very well that general meetings of a company general meetings are nothing but meetings of the shareholders. They are divided broadly into two categories. The first one is annual general meeting. The second one is extraordinary general meeting. So whatever be the meeting, whether it be the meeting of the board of directors or it be the meetings of the shareholders, the auditor of a company is having a right of access to minutes of both the board of directors as well as the shareholders. In future, we will come across some audit procedures wherein the auditor is required to review the minutes of the meetings of the board of directors or minutes of the meetings of the shareholders. If you want to review the minutes of the meetings of the board or shareholders, first of all, you should be given a right to have an access to such minutes. That is the reason why I am clearly specifying you that minutes includes both the minutes of the meetings of the board of directors as well as the shareholders. So, now you know very well about what are statutory books and why the auditor of the company has been given a right of access to such statutory books. So what is the first right? Right of access to books, vouchers and other relevant records at all times. At all times here implies only working days, that too during business hours. For example, Sunday is a holiday to the company. It is not a working day to the company. In that case, as an auditor, you cannot insist the company to provide books and other related records to you because it is not a working day. For some types of companies, even Sunday may be a working day. The best example is a chit fund company. A chit fund company will operate its transactions on Sunday, but Monday is a holiday to a chit fund company. If you were the auditor of a chit fund company, when Sunday is a working day, you can obviously verify the books and other related records on a Sunday because it is a working day and is not a holiday to the company. This is about at all times. Then we started having a discussion about what are books. Books are of three types: statutory, statistical, memorandum. Statutory books, the following are the best examples of statutory books. First one is register of members, otherwise called as register of shareholders. The second one is register of debenture holders. The third one is register of charges, and the fourth one is minutes book. Minutes may be of the minutes of the board of directors or even of the shareholders. It may be minutes of either annual general meeting or an extraordinary general meeting. Being an auditor of a company, you are always having a right of reviewing, verifying, accessing the minutes of either board of directors or the shareholders. This is all about the term statutory books. Although the term statistical books is used, it was nowhere defined in the Companies Act. You can just leave it. And the third one is memoranda records. The term memoranda records includes stock records as well as cost accounting records. The term memoranda records includes stock records as well as cost accounting records. You know very well that every organization, including a company, may maintain a separate register to have a control over the quantities of stock held by them. That register is technically called as dash register, stock register, which will contain the quantities of stock. Therefore, when an entity under your audit, including a company, is maintaining a stock register, being an auditor, you are not only having a right to verify books of account as mentioned under section 2 subsection 13 of the Companies Act. What were the books that were mentioned under section 2 subsection 13 of the Companies Act? In the previous session, I explained you the definition of books of account as given under Companies Act 2013. Under section 2 subsection 13 of the Companies Act, what is the definition that I have given for the term books of account? The term books of account includes every company is under obligation to maintain such books of account which should contain details relating to all sums of money received and expended, all purchase and sales, all liabilities and assets, and where it was directed by central government to maintain cost accounting records. then such cost accounting records, if any maintained by the company, shall also form part of books of account. That is the reason why I said that. So the books that are being maintained by the company under section 2 subsection 13 of the Companies Act can be accessed by the auditor. Apart from that, any other statutory book maintained by the company, and the term memoranda records includes stock records as well as cost accounting records. I already explained to you that according to section 148 subsection 1 of the Companies Act, sometimes central government may direct a company to maintain cost accounting records apart from maintaining financial records. In that case, the company is under obligation to maintain both financial records as well as cost accounting records. So where the company under your audit maintains cost accounting records, although you are the financial auditor, although you are not the cost auditor of the company, you are the financial auditor of the company, but still as a financial auditor of the company, you are always having a right of access to the cost accounting records maintained by the company. When you were the financial auditor of the company, why you have been given a right of access to the cost accounting records? There is a logic behind this. You know very well about CARO, Companies Auditors Report Order 2020. According to that, as an auditor, you need to verify and report on 21 matters. You need to make an inquiry about 21 matters under CARO, then you need to make a report. One such matters to be inquired by the auditor under CARO 2020 is about cost accounting records. According to CARO 2020, if you were the financial auditor of a company, and if the company under your audit is required to maintain cost accounting records, I repeat, if you were the financial auditor of a company and the company under your audit is required to maintain cost accounting records also. When a company is required to maintain cost accounting records, if it was so directed by central government under section 148 subsection 1 of the Companies Act, are you able to follow me? What section 148 subsection 1 says? What section 148 subsection 1 says? According to section 148 subsection 1 of the Companies Act, sometimes central government may direct a company or companies operating under a specific industry to make and maintain cost accounting records also, apart from maintaining financial records. Financial records are compulsorily required to be maintained. Apart from maintaining financial records, the company may be made responsible to maintain some more records called as cost accounting records. When central government so directs, it becomes an obligation. When central government so directs, it becomes an obligation on the part of the company to make and maintain cost accounting records. That is point number 1. Point number 2, under CARO 2020, as an auditor of a company, you are supposed to check 21 points mentioned under CARO. Out of those 21 points, 1 point reads like this: where the company under your audit, where the company under your audit, you are the auditor of the company, and the company under your audit is under obligation to maintain cost accounting records, because it was so directed by dash. It was so directed by dash central government under section dash 148 subsection 1 of the Companies Act. So where the company under your audit has been directed by central government under section 148 subsection 1 of the Companies Act to make and maintain cost accounting records, it becomes an obligation. It becomes an obligation on the part of the company to maintain cost accounting records. It is the duty of you as an auditor of the company to verify whether the company under your audit is maintaining, whether the company is under your audit is maintaining cost accounting records in accordance with the directions given by central government. So what is your duty as the statutory auditor, otherwise called as company auditor, otherwise called as financial auditor under CARO? I repeat, what is your duty as a statutory auditor or company auditor or financial auditor under CARO, where the company under your audit has been directed by central government to make and maintain cost accounting records. It is your duty as an auditor to check whether the company maintained cost accounting records in accordance with the directions given by central government. In order to check whether the company maintained cost accounting records or not, you need to be given a right of access to cost accounting records. Without giving that right, is it possible for you to go through cost accounting records? Without going through cost accounting records, is it possible for you to make a comment whether the company is following the directions given by central government under section 148 subsection 1? No. That is the reason why, although you are the dash auditor, although you are the statutory auditor or company auditor or financial auditor, you have been given a right of access even to the cost accounting records maintained by the company. But remember, you are not expected to carry out a full-fledged audit of cost accounting records. You are not responsible for conducting audit of such cost accounting records. You have been given a right of access to cost accounting records to ascertain whether the company under your audit is actually following the guidelines given by is actually following the directions given by central government in respect of maintenance of cost accounting records. To make a comment on that, you need to go through cost accounting records. To go through cost accounting records, you have been given a right of access to cost accounting records. You are not expected to carry out a full-fledged audit or in-depth audit of cost accounting records. This is all about right of dash in respect of dash. Right of the statutory auditor in respect of access of cost accounting records maintained by the company. You have been appointed as the auditor of A Limited. Let us assume A Limited has been directed by the central government to make and maintain cost accounting records. During the course of performance of audit, you want to have an access to the cost accounting records maintained by A Limited. A Limited refused to provide access of cost accounting records to you on the ground that you are merely a financial auditor and not a cost auditor. Do you agree with the contention of A Limited? Should I repeat my question? You have been appointed as the auditor of dash A Limited. You are the financial auditor or company auditor or statutory auditor of A Limited. During the course of performance of your audit, you came to know that A Limited has been directed by central government to make and maintain cost accounting records. In such case, what is your duty? You need to check whether the company had really maintained cost accounting records in accordance with the directions given by central government. For that, you need to go through cost accounting records. In order to go through the cost accounting records, you asked the company to provide access to cost accounting records. The company denied access of cost accounting records to the auditor on the ground that you are not the cost auditor of the company, you are just after all financial auditors. Therefore, we do not want to provide access of cost accounting records to you. That was the answer given by the company to the auditor concerned. If you were the auditor, do you agree with the contention of the company? That is my question. Have you understood my question? Good, very good. Do you accept the contention of the company? No. Once you were appointed as the statutory auditor, once the company is maintaining cost accounting records in accordance with the directions given by the central government, you are always having a right of access to such cost accounting records to make a comment under CARO. That is the reason why, although you are a dash auditor, you have been given access to dash. Although you are the financial auditor, you have been given access to cost accounting records. This is case number 1. Case number 2, you were the auditor of A Limited. During the course of audit, you came to know that the company has been directed by central government to make and maintain cost accounting records. Now, the auditor of A Limited wanted the company to provide cost accounting records to them, but the company denied access of cost accounting records to the auditor on the ground that some other person has been appointed by the company as the cost auditor of the company, as the cost auditor of the company under section 148 subsection 2 of the Companies Act. So company appointed you as the financial auditor. Company appointed some other person as the cost auditor. What is the objective behind appointment of the cost auditor? For conducting audit of cost accounting records. You were appointed for conducting audit of financial records. That person has been appointed for conducting audit of cost accounting records. During the course of performance of audit, you want to have an access to the cost accounting records. The company denied access of cost accounting records to you on the ground that some other person has already been appointed as the cost auditor. He will verify the cost accounting records. Therefore, we could not provide access of cost accounting records to you. That was the response given by the company to you as an auditor. Do you agree with the contention of the company? No. Although a separate auditor has been appointed as the cost auditor, it is your duty to make a comment under CARO. In order to make a comment under CARO, you must have to go through the cost accounting records. In order to go through the cost accounting records, you must have been given a right of access to the cost accounting records. So in every case, when the company is maintaining cost accounting records in accordance with the directions given by the central government, the company cannot deny access of cost accounting records to the financial auditor. The company must have to provide access of cost accounting records even to the financial auditor. Now I want to ask you one more question. You were appointed as the auditor, as the cost auditor of a company, not as the financial auditor. You have been appointed as the cost auditor of the company. During the course of performance of his audit, the cost auditor wants to have an access to the financial records maintained by the company. Now, should the company provide access of financial records to the cost auditor? The answer is yes. Why? Because being a cost auditor, sometimes you may be forced to prepare a statement called as a reconciliation statement, reconciling costing profit with financial profit. In order to prepare a reconciliation statement between costing profit and financial profit, you must be in a position to identify the reasons why there is a difference between the profit as appearing in the costing profit and loss account and as appearing in the financial statements. For that, you need to go through the financial records to identify what was the treatment given in the financial records and what is the treatment given in the cost accounting records. Therefore, this right is reciprocal in nature. Financial auditor can have an access to the cost accounting records, and cost auditor can also have an access to the financial records for the reasons already explained to you. This is about point number 1. So what is the first right given to the company's auditor under section 143 subsection 1 of the Companies Act? Right of access to books, vouchers and other relevant records at all times. The term books includes statutory books, statistical books, memoranda records. The term memoranda records includes stock records and cost accounting records. Apart from books, any voucher maintained by the company. You know very well about what is a voucher. Voucher is nothing but any supporting documentary evidence available in any form. It is called in a written form is called as a voucher. So as an auditor, you can go through all the books and other related records maintained by the company. You can go through the vouchers and other relevant records, if any, maintained by the company to form and to express an opinion on the financial statements. This is about right number 1. Now let us have a discussion on right number 2. This is somewhat time taking. If you are conversant with AS 13, it will be very much easier for me to explain right number 2. If not, it may be difficult for me, time consuming for me to explain you right number 2. So first of all, I will try to explain you what is mentioned in AS 13 so that it will be easier for us to complete point number 2. You know very well that valuation of investment is dependent upon classification of investment. Yes or no? You know very well that classification of investment is dependent upon the objective behind purchase of investment. Yes or no? Objective behind purchase of investment may be either a long-term objective or a short-term objective. If the objective behind purchase of investment is a long-term objective, then such investments shall be classified as long-term investments. If the objective behind purchase of investment was a short-term objective, then such investments shall be classified as current investments. So classification is dependent upon the objective. Then if the investments were classified as long-term investments, they are required to be valued at cost. If investments were classified as current investments, they are required to be valued either at cost or at fair market value, whichever is lower. You know these things very well, and I'm sure everyone is having good knowledge about this. Right. I repeat, valuation of investment is dependent upon classification. Classification is dependent upon objective. Objective may be either a long-term objective or a short-term objective. If the objective was a long-term objective, you need to classify such investments as long-term investments. If the objective is a short-term objective, then investments are required to be classified as current investments. If you classify your investments as long-term investments, they are required to be valued at cost. If you classify your investment as current investments, they are required to be valued either at cost or at fair market value, whichever is lower. Supposing that you have been appointed as the auditor of a company. Supposing further that financial statements have been provided to you. You have gone through the balance sheet of the company. There you find that the company is having some investments. Some value is also reflected in the balance sheet against the term or against the heading investments. So the company under your audit is having some investments. Those investments are being reflected in the balance sheet of the company at some value. What is your duty as an auditor in respect of such investments? You need to check whether value that is being reflected in the balance sheet. You need to check whether the value that is being reflected in the balance sheet is correct or not. So auditor need to check the correctness of valuation of investment. As already discussed, valuation of investment is dependent upon what? Classification. So in order to check the correctness of valuation, first of all, auditor should identify the classification. In order to verify whether classification is correctly done or not, first of all, the auditor should try to ascertain objective. I repeat, correctness or otherwise of valuation is dependent upon classification. Correctness or otherwise of classification is dependent upon the objective. So in order to check whether investments valuation is correct or not, first of all, you need to ascertain the objective behind purchase of investments. How do you identify or ascertain the objective behind purchase of investment? Objective will nowhere be recorded on any paper or in books. Objective will be in the mind of the management. So you need to ask the management. As an auditor, you need to ask the management about what is your objective behind purchase of these investments. Then the management will provide you a reply saying that our objective behind purchase of investment is a long-term objective, or else they could say that our objective behind purchase of investment was a short-term objective. So objectives will not be written in the books. Objective will not be written on a paper. Only entry relating to purchase will be written in the books. So even if you go through books, even if you go through all the books and other related records, as an auditor, you may not be in a position to identify what exactly was the objective behind purchase of investments. Are you able to follow me or not?
Hello everyone, greetings of the day. Now you can purchase CA inter-auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA inter-auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA inter-auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have three exciting, convenient options to buy this course. Option 1, You will have 175 hours of videos for 6 months at 2 views, and the material will be couriered to you, and at the same time you can have PDF material on the screen. And option 1 is available for 5,000 rupees, and option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3 for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
143 subsection 1 clause A. Under this heading, the auditor is required to focus on loans and advances. You are required to focus on loans and advances, where the company under your audit has granted any loans, where the company under your audit has granted any loans. So where the company under your audit has sanctioned or granted any loans on the basis of security, that means if the company under your audit has granted some secure loans, where the company under your audit has granted some secured loans, then it is your responsibility as an auditor to focus on 2 things. The first one is you need to verify whether such loans granted by the company are properly secured or not. And the second one is you should also verify whether the terms and conditions, on the basis of which such loans were granted, were prejudicial either to the interests of the company or to the interests of its members. Again, I repeat the points. Under this heading, there are 2 duties to you as an auditor. The first duty is to verify whether the loans granted by the company are properly secured or not. The second duty is to focus on the terms and conditions on the basis of which such loans have been granted. Let us first focus on duty number 1 of the auditor. What is duty number 1? You need to check whether the loans so granted on the basis of security were properly secured or not. Every company will have a policy while taking or while accepting any security. For example, if the policy of the company is to take 125% of loan amount as security, if the policy of the company is to take 125% of the loan amount as security, and if the company took that 125% of the value of the loan as security, then as an auditor, you can satisfy that the loans granted by the company on the basis of security were properly secured. If you are unable to understand also, there would not be any problem. I will try to dilute the point further so that you will be certainly able to understand it. For example, the amount of loan granted by the company is say 1 lakh rupees. And let us also assume that the value of the security taken by the company is say 80,000 rupees. The amount of loan granted by the company is 1 lakh. The value of the security taken by the company is 80,000. If you were the auditor of the company, can you say that the loan granted by the company is properly secured? Yes or no? No. Because the value of the loan is more than the value of the security, you cannot say in the given case that the loans granted by the company are properly secured. As already said to you, it is the policy of the company to take 125% of the loan amount as the security value. Say the loan amount granted by the company is 1 lakh and the value of the security taken by the company is say 1,25,000. If you were the auditor, now can you satisfy that the loans granted by the company are properly secured? Yes or no? So where the auditor is satisfied that the loans granted by the company are properly secured, there is no further reporting responsibility on the part of the auditor. You checked and satisfied that, okay, this company has granted loans on the basis of security. That means the company under my audit has granted some secured loans and the value of the security taken by the company is adequate. The value of the security taken by the company is adequate. That is the reason why, as an auditor, you have satisfied that the loan is properly secured. When the loan is properly secured, when everything is going on well, there is no need to make any report. Therefore, this aspect is not required to be reported by the auditor to the shareholders. If the auditor satisfies that the loans granted by the company are properly secured. Now, I am sure you may be having an understanding of duty number 1 to the auditor under section 143, subsection 1, clause A, where the company under your audit has granted any loans on the basis of security. That means where the company under your audit has granted secure loans, it is the responsibility of the auditor to focus on two important aspects. The first one is you need to check whether the loans are properly secured or not. In order to verify whether the loan is properly secured or not, it is necessary for the auditor to compare the amount of the loan with the value of the security. If the value of the security is higher than the amount of the loan and as per the policy being followed by the company, you can satisfy that the loan is properly secured. When the loan is properly secured, there is no problem either to the company or to the shareholders of the company. When there is no problem either to the company or to the shareholders of the company, it is said that everything is going on well. When everything is going on well, as per that rule under section 143 subsection 1, there is no need for you to make any report to the shareholders. So where the auditor satisfies that the loan is properly secured, there is no need to report. However, if the auditor finds that the loan granted by the company is not properly secured. First case, what is the first case? Amount of loan granted by the company is 1 lakh. Value of the security taken by the company is 80,000. That means auditor finds that the loan is not properly secured. What happens if the loan granted by the company is not properly secured? What happens if the loan granted by the company is not properly secured? If the borrower fails to make the repayment, what the company should do? The company had to sell off the security. If the company sells off the security, how much amount will the company fetch by selling the security? 80,000. Amount of loan granted by you is 1 lakh, whereas the value that you will receive on sale of security is only 80,000. In that case, the company will be put to a loss. When it is a loss to the company, it is a loss even to the shareholders. So you are expecting that because of this, there would be a loss both for the company as well as for the shareholders. In that case, it is our responsibility as an auditor to make a report to the shareholders. I repeat again, the first duty of the auditor under this heading is to verify whether the loans granted by the company are properly secured or not. Where the auditor satisfies that the loans are properly secured, there is no further reporting responsibility. Where the auditor finds that the loans are not properly secured, the same should have to be reported by the auditor. This is duty number 1 of the auditor under section 143 subsection 1 clause A. There is another duty on the part of the auditor under the same clause. The second duty is you need to focus on the terms and conditions of such loans. You need to focus on the terms and conditions of such loans. Where do you find the terms and conditions of a loan? Where do you find the terms and conditions of a loan? By going through the loan agreement. So where the company under your audit has granted loans, it is necessary for you to go through the loan agreement. By going through the loan agreement, the auditor can find the terms and conditions of loan agreement. Important terms of loan agreements may be like this: date of loan, amount of loan, rate of interest, period of repayment, mode of repayment, description about the security, value of the security. These are all generally termed as terms and conditions of the loan. What are considered as terms and conditions of the loan? Date of the loan, amount of the loan, most importantly, rate of interest, period of repayment. This is also important. Mode of repayment, then the details of the security taken, the value of the security taken, everything will be mentioned in the loan agreement. So if you were the auditor, if you want to ascertain the terms and conditions of the loan, you need to go through the loan agreement. By going through the loan agreement and by going through the terms and conditions on the basis of which such loans have been granted by the company, auditor shall try to evaluate. The auditor shall try to evaluate whether such terms and conditions are prejudicial. Whether such terms and conditions are prejudicial either to the interests of the company or to the interests of its members. Prejudicial here implies against the interests of the company. You need to assess whether terms of the loan are against either to the interests of the company or to the interests of its members. For example, the company has granted a loan of 1 crore rupees to a particular party. The then prevailing market rate of interest is say 24%. You know very well about the meaning of the term market rate of interest. If the market rate of interest is say 24%, what does it mean? If anybody wants to take any loan, he has to pay a rate of interest of 25%. If anybody wants to give any loan, he will charge a rate of interest of 24%. That is said to be the market rate of interest. But in the given case, the company under your audit has granted a secured loan worth rupees 1 crore. The auditor had gone through the loan agreement and finds that the rate of interest charged by the company on that loan is only 2%. So the market rate of interest is 24%. The company is charging a rate of interest of only 2% on a loan amount of 1 crore. Now my question is this term of the loan prejudicial either to the interests of the company or to the interests of its members or not? If the company had given this loan at a rate of interest of 24% per annum, how much is the amount of interest that the company will get on that loan? 24 lakhs. But unfortunately, the company has given this loan at a rate of interest of how much? Only 2%. That means the company is getting an interest of only 2 lakh rupees per annum. How much is the loss to the company because of grant of this loan at a rate of interest of just 2%? 22 lakhs per annum is the loss to the company because the company has given a loan at a meager rate of interest of 2% against the market rate of interest of 24% per annum. Is this a loss to the company or not? Is this a loss to the shareholders or not? So to that extent, the dividend to the shareholders will be denied. To that extent, the profits of the company will fall. So it is detrimental. It is prejudicial both to the interests of the company as well as to the interests of the shareholders. As already said to you, if everything is going on well, there is no need to report. If something is going on wrong, there is a need to report. In the given case, you determined that the terms of the loan are prejudicial to the interests of the company or to the interests of its members. Hence, it is required to be reported by the auditor. However, where the auditor satisfies that the terms are not prejudicial. If they are prejudicial, make a report. If they are not prejudicial, when the auditor satisfies that the terms of the loan are not prejudicial, either to the interests of the company or to the interests of its members, everything is going on well. In that case, there is no need to make a report. Let us assume, continuing the previous example, assume that the market rate of interest is 24% per annum. The company under your audit has granted a secured loan. It is charging a rate of interest of 24% per annum. In that case, is the term of the loan detrimental either to the interests of the company or to the interests of its members? No, nothing. So where the auditor satisfies that the term of the loan is not detrimental either to the interests of the company or to the interests of its members, keep quiet. If you find that they are detrimental to the interests of the company, you need to make a report to the shareholders. This is about duty number 2. If you are still unable to understand, I will repeat it and then I will conclude it. After conclusion, I am sure every one of you would be able to understand this point. I know very well that most of the lecturers will skip explaining this point at intermediate level. I know it very well. Most of you people do not know the meaning of these points. That is the reason why it is taking some time for you to understand these points. So, what are the duties of the auditor under 143 subsection 1 clause A of the Companies Act? There are two duties. Duty number 1, you need to check whether the loans granted by the company are properly secured or not. If you satisfy that the loans are properly secured, leave it. If you find that the loans are not properly secured, make a report to the shareholders. Duty number 2, you need to go through the terms and conditions on the basis of which such loans have been granted by the company. If the auditor satisfies that the terms are not prejudicial, if the auditor satisfies that the terms are not prejudicial, either to the interest of the company or to the interest of its members, keep quiet. If the auditor finds that the terms are prejudicial, either to the interest of the company or to the interest of its members, make a report to the shareholders. This is the duty of you as an auditor under section 143 subsection 1 clause A, which deals with the concept of loans and advances. Now 143 subsection 1 clause B. This is somewhat difficult to understand. 143 subsection 1 clause B. Do you know the meaning of the term transactions represented merely by book entries? Transactions represented merely by book entries. Can you please explain me the literal meaning of this term? Transactions represented merely by book entries. What is meant by merely? Merely means only. There are some entries in the books of account. There are some entries in the books of account. Since an entry is made in the books of account, we are of the opinion that transaction has taken place. But unfortunately, transaction has not taken place. Although transaction has not taken place, an entry in the books of account could have been recorded by the company. Such type of transactions which have not taken place but have been recorded in the books of account are technically called by us as dash transactions. Very good, very good. Fictitious transactions are fictitious entries. What we call as fictitious entries are being called in the Companies Act in a different manner. The Companies Act is calling fictitious entries as dash transactions represented merely by book entries. You know very well that the base for recording an entry into the books of account is actual occurrence of the transaction. Say yes or no. The base for recording an entry into the books of account is the actual occurrence of the transaction. If the transaction really took place, then you need to record the details of the transaction in the books of account. If the transaction has not taken place, there is no need to record anything in the books of account. However, what has been done in the given case, transaction has not really taken place, but the entity may have recorded an entry in the books of account saying that transaction in fact had taken place. Such type of entries are being called by us as dash fictitious entries. What happens if there are some fictitious entries in the books of account of the entity? Will there be prejudicial either to the interest of the company or to the interest of its members? Yes or no? What happens if books contains some fictitious entries, otherwise called as transactions represented only or merely by book entries? Only book entry is there. Transaction has not taken place. That means the transaction is not a real transaction. It is a fictitious transaction. A fictitious entry has been recorded in the books of account. If books of account contains fictitious entries, will they be prejudicial? Will they be prejudicial either to the interest of the company or to the interest of its members? Yes or no? Yes. For example, the management of the entity was involved in fraud. In order to reduce the profit from 10 lakh rupees to 1 lakh rupee, management has recorded a fictitious entry into books of account, debiting salaries with an amount of 9 lakhs and crediting outstanding salaries with an amount of 9 lakhs. At least you should agree that this entry in the given example is a fictitious entry. Yes or no? Salaries account to outstanding salaries is an entry which is not a real entry. It was a fictitious entry. It has been recorded by the management of the company to reduce profits from 10 lakhs to 1 lakh, thereby to reduce the tax liability. Yes or no? Because of the existence of this fictitious entry in the books of account, will it be prejudicial to the interest of the shareholders or not? Obviously, yes, to that extent. To that extent, the profits of the entity will get reduced. When the profits of the entity gets reduced, the tax liability will also get reduced. That is beneficial to the management. But to that extent, the shareholders will be denied a dividend. Yes or no? To that extent, shareholders will be denied a dividend. That means when fictitious entries are there in the books of account, profit to that extent will get reduced. Because of that, shareholders will be denied dividend to that extent. So when there are fictitious entries into the books of account, you can say that they are certainly prejudicial to dash. You need to fill in the blanks. Then only I can understand whether you are following my discussion or not. When there are fictitious entries, they are certainly detrimental to the interests of either the company or the shareholders. Say yes or no. Yes. So when you find some fictitious entries into the books of account, then obviously they are detrimental to the interests of the company or to the interests of its members. Hence, the same are required to be reported by you as an auditor to the shareholders. However, if the auditor satisfies that there are no fictitious entries, or there are no transactions represented merely by book entries. When there are no fictitious entries, it is not detrimental either to the interests of the company or to the interests of its members. When it is not detrimental, there is no need to report. So what is your reporting responsibility as an auditor under section 143 subsection 1 clause B, where the auditor satisfied that there are no transactions written in the books of account which are represented merely by book entries. In other words, where the auditor satisfies that there are no fictitious entries recorded in the books of account, then there is no need on the part of the auditor to make any report to the shareholders. However, where the auditor identifies that books contains some fictitious entries, obviously they are detrimental to the interest of the shareholders. In that case, it is our responsibility as an auditor to make a report to the shareholders. Now, a big question for consideration is, if you were the auditor, how do you know whether books contain fictitious entries or transactions represented merely by book entries? If you were the auditor, how do you know whether books of account of the company contains fictitious entries or transactions represented merely by book entries? Do you understand my question? You are the auditor. You need to identify whether there are any fictitious entries into books of account. If there are fictitious entries, the same that will be detrimental to the interests of the shareholders. The same should be reported to the shareholders. If you satisfy that there are no fictitious entries, you need to keep quiet. For that, first of all, you should be able to identify fictitious entries. How do you identify fictitious entries as an auditor? By carrying out a technique called as watching. By carrying out a technique called as watching. I said to you that there is every possibility that journal may contain either fraudulent entries or fictitious entries, either because of the existence of employee fraud or because of the existence of management fraud. Whenever any employee of the organization was involved in fraud, whenever management itself is involved in fraud, the persons who are involved in fraud will certainly try to the persons who are involved in fraud will certainly try to hide the fraud. In that case, they will try to record either fraudulent entries or fictitious entries into books of account. So there is always a possibility that books may contain either fraudulent entries or fictitious entries, either because of the existence of employee fraud or because of the existence of management fraud. It is our responsibility as an auditor to check whether each and every entry recorded in the books of account is genuine or is fraudulent, is real or is fictitious. For that, you are expected to verify each and every entry in the books of account with the help of supporting documentary evidence or evidences. That process is technically known as watching. So by carrying out a technique called as watching, auditor will come to know whether books contains dash or are free from dash, whether books contains fictitious entries, otherwise called as transactions represented merely by book entries, or are free from that. Based on that, you need to make a report. This is about the duty of the auditor under section 143 subsection 1 clause B. So to sum up, what is the only duty of the auditor under section 143 subsection 1 clause B? Where the auditor satisfies that there are no transactions represented merely by book entries. In other words, where the auditor satisfies that there are no fictitious entries in the books of account of the entity under your audit, there is no need to report. If you identify some fictitious entries, they are certainly detrimental to the interests of the company and its shareholders, and the same are required to be reported. So 143 subsection 1 clause A deals with dash, loans and advances. 143 subsection 1 clause B deals with dash, transactions represented merely by book entries. Are you able to follow me or not? Appointment of auditors, companies can be classified broadly into two categories. The first one is government companies and the second one is other than government companies. You can call it as non-government companies. In case of government companies, how to appoint first auditor of a government company and how to appoint subsequent auditor, otherwise called as regular auditor of a government company. Provisions relating to appointment of first auditor of a government company were contained under section 139 subsection 7 of the Companies Act, whereas provisions relating to appointment of subsequent auditor of a government company were contained in section 139 subsection 5 of the Companies Act. Now we are having a discussion on section 139 subsection 7. This is 139 subsection 7. First auditor of a government company, as said earlier, the first auditor of a government company shall have to be appointed by Comptroller and Auditor General within 60 days from the date of registration of the company. If the date of registration here implies date of incorporation. Where C&AG fails to appoint the first auditor within the period of 60 days stipulated, the same must be informed. Then the board of directors of the company had the authority to appoint the first auditor within next 30 days. Sometimes even board of directors of the company may fail to appoint the auditor within the given time. In that case, it is the responsibility of the board of directors to inform the same to the shareholders. Thereupon, the shareholders of the company shall appoint the auditor in an extraordinary general meeting, and that should be done by the shareholders within 60 days. Here, Act is not clear about from which point these 60 days are required to be calculated. ICSI Institute had given a clarification on this. ICSI, Institute of Company Secretaries of India, said that after giving intimation or information about failure, on giving intimation or information about the failure of the board of directors, shareholders will have a time period of 60 days within which an extraordinary general meeting is required to be conducted. In that extraordinary general meeting, shareholders of the company had to appoint the auditors. Now, what is section 139 subsection 7? Section 139 subsection 7 of the Companies Act contains provisions relating to appointment of the first auditor of a government company. According to that section, the first auditors of a government company shall have to be appointed by Comptroller and Auditor general within 60 days from the date of registration of the company. Here date of registration is date of incorporation. Where the comptroller and auditor general fails to appoint the first auditor, then the board of directors of the company had the authority to appoint the first auditor within next 30 days. Where board also fails to appoint the first auditor, then it is the responsibility on the part of the board of directors to intimate about their failure to appoint the first auditor to the shareholders. Thereupon the shareholders of the company shall have to appoint the first auditor in an extraordinary general meeting within 60 days. 60, 30, 60. That's it. Now, the question is, what is the tenure of office? What is the tenure of office of the first auditor appointed either by C&AG or by board of directors or by shareholders? Whatever be the appointing authority, whether the first auditors were appointed by C&AG or by board of directors or even by shareholders, the tenure of office of such first auditor shall be till the conclusion of the first annual general meeting. Shall be till the conclusion of the first annual general meeting. You know very well about the meaning of the term annual general meeting and rules relating to AGM. Can you please provide the rules that are required to be followed by a company to hold an annual general meeting? Rules relating to AGM were contained in section 96 of the Companies Act. According to section 96 of the Companies Act, by attending to annual general meeting, the shareholders of the company had to take 4 types of decisions. You can call them as ADDA, ADDA. A means adoption of annual accounts. D means declaration of dividend. D means director's appointment. A means auditor's appointment. So, the first one is adoption of annual accounts. The second one is appointment of declaration of dividend. The third one is appointment of directors. And the fourth one is appointment of auditors. These 4 are the business to be transacted by the shareholders in an annual general meeting. And section 96 of the Companies Act says that this AGM is required to be held by a company within 6 months. Within 6 months from the end of the relevant financial year. Usually financial year will end by 31st March. If you calculate 6 months from 31st March, it is 30th September. So generally speaking, 30th September is said to be the cutoff date. Generally speaking, 30th September is said to be the cutoff date within which a company is required to hold its annual general meeting. However, different rules were given in respect of holding the first annual general meeting. Do you know them? What is the rule to be followed by the company in respect of holding its first AGM? Regular any meeting other than first AGM. Any annual general meeting other than first annual general meeting is required to be held by the company within 6 months from the end of the relevant financial year. However, the first annual general meeting of the company can be held by the company within 9 months. Within 9 months from the end of relevant financial year. From the end of relevant financial year. This is the provision in the Companies Act relating to holding the first annual general meeting. So if the company holds its first annual general meeting, and if that first annual general meeting concludes, till the conclusion of that first annual general meeting, such first auditors will be treated as the auditors of the company. So whether the first auditors are appointed by dash or dash or dash, whether the first auditors were appointed either by comptroller and auditor general or by board of directors or even by shareholders in an extraordinary general meeting, shall hold office till the conclusion of the first annual general meeting. Till the conclusion of first annual general meeting. Most of the students do not understand the importance of the term conclusion, for which I will give you an example. Okay, a company started registered as on say 1st April 2020. The date of registration of the company or date of incorporation of the company has been assumed as 1/4/2020. That means this company started its business in the financial year 2020-2021. Let us assume that this company is a government company. By incorporation itself, the company is a government company, because we are having a discussion about the provisions relating to appointment of first auditor of a government company. I made an assumption that by its incorporation itself, the company is a government company. On 10th April 2020, Mr. X has been appointed as the first auditor. Mr. X has been appointed as the first auditor by Comptroller and Auditor General. You know very well that C&D is having an authority to appoint the first auditor within 60 days. In the given example, within 10 days, C&D appointed Mr. X as the first auditor of the government company. Now, what is the ending date of the relevant financial year in the given example? 31st March 2021 is the ending date. Now the question is, what is the term of office of this auditor, or what is the tenure of office of this first auditor? As already said to you, whether the first auditors are appointed by C&AG or by board of directors or even by shareholders, first auditor so appointed shall hold office till the conclusion of the first annual general meeting. What is the ending date of the relevant financial year? 31st March. What is the date within which this company is required to hold its first annual general meeting? Usually, any meeting other than first AGM is required to be held by the company within 6 months, whereas a time of 9 months is given for holding first AGM. So 9 months means, let us assume that on 31st December 2021, on 31st December 2021 is called as dash date for holding its first AGM by the company. Cut-off date or last date for holding first AGM by the company. Let us assume that the company held the meeting on 31st December 2021. Let us also assume that the meeting has been concluded. The meeting has been concluded on that date. 31st December is the date on which first AGM is held. 31st December is the date on which first AGM is concluded. Now my question to you is, what is the tenure of office of this first auditor appointed by Comptroller and Auditor General? What is the date up to which X is considered as the auditor of the company? Till dash date, till the conclusion of the first annual general meeting. In the given example, the first annual general meeting was concluded on 31st December 2021. So this auditor is appointed on 10/4/2020 and he will continue to be the auditor till the conclusion of the first AGM. First AGM is concluded on 31st December 2021. So X is considered as the auditor of the company till 31st December 2021. Now I am making an assumption that first AGM was held on 31st December 2021. Unfortunately, the AGM has been adjourned or postponed to a later date, and the postponed meeting is held on 31st January 2022. Let us assume the postponed meeting was held and concluded on 31st January 2022. Now my question is, what is the date up to which X shall be treated as the auditor? Is it 31st December 2021 or is it 31st January 2022? Is it 31st December 2021 or 31st January 2022? It should be 31st January 2022. Why? Because the Act clearly mentions that the tenure of office of the first auditor will end by the conclusion of the first annual general meeting. In the given example, what is the date on which the AGM is concluded in the second example? It is on 31st January 2022. Therefore, X will continue as the auditor of the company till 31st January 2022. Followed or not? So, this is all about the provisions relating to appointment of first auditor. Provisions relating to provisions relating to appointment of first auditor of a government company. Now, let's have a discussion on section 139 subsection 5 of the Companies Act. What is section 139 subsection 5? Appointment of subsequent auditor of a government company. That is section 139 subsection 5. The subsequent auditor of a government company shall be appointed only by Comptroller and Auditor General. Three options are given in case of appointment of first auditor of a government company. Only one option is given in case of appointment of subsequent auditor of a government company. What were the options given in case of appointment of the first auditor of a government company? The first auditor of a government company may be appointed either by C&AG or by board of directors or even by shareholders in an extraordinary general meeting. Whereas the subsequent auditor of a government company shall have to be appointed only by Comptroller and Auditor General. Comptroller and Auditor General should not fail in appointing the subsequent auditor. If C&AG fails, there is no provision in the Companies Act. C&AG must have to appoint the subsequent auditor of a government company, and that should be done by C&AG within 180 days. Within 180 days from the date of commencement of the relevant financial year. From the date of commencement of relevant financial year. This point is not that much easy to understand. So I will try to provide an example for this. This is the example. You can just go through this flowchart appearing on the screen. According to section 139 subsection 5 of the Companies Act, subsequent auditor of a government company shall have to be appointed only by Comptroller and Auditor General within 180 days from the date of commencement of the relevant financial year. There is no example for this. I will give you an example for this. Be careful while listening to this. Assume that a government company has been registered in the financial year 2020, 2021. I will try to continue the same example that has been given previously. So what is the date on which the company has registered under the Companies Act on 1/4/2020? What is the relevant financial year in which the company started its business? 2020-2021. Who is the first auditor of the company? X was appointed as the first auditor of the company. Who appointed the first auditor? By Comptroller and Auditor General. Now, what is the next financial year for the company? The first financial year for the company is 2020-2021 in our example. What is and who is the auditor for that financial year? Who is the auditor for the first financial year? Are you able to follow me? What is the first year in which the company has been incorporated? The first year of the company is 2020-21. Who has been appointed as the first auditor? Mr. X has been appointed as the first auditor. So X is made responsible for conducting audit of financial statements for the year 2020-2021. What is the next year? The next financial year is 2021-2022. Yes or no? So who should appoint the auditor for the next financial year? That is 2021-2022. only Comptroller and Auditor General can appoint the subsequent auditor. First auditor has already been appointed. Now the subsequent auditor can be appointed only by Comptroller and Auditor General. Within how many days? Within 180 days. Within 180 days from the date of commencement of the relevant financial year. In the given example, the relevant financial year is 2021-2022. What is the date of commencement of the year 2021-22? What is the date of commencement of the year 2021-22? It is 1st April 2021. You need to calculate 180 days from 1st April 2021. 180 days means almost 6 months. That means the subsequent auditor is required to be appointed by dash by 30th September 2021. So year starts on 1/4/2021. Within 180 days, subsequent auditor is required to be appointed. That means the cutoff date for appointment of the subsequent auditor is 30th September 2021. What is the year ending date? 31st March 2022. So within 180 days, the Comptroller and Auditor General appointed Mr. Y as its subsequent auditor. This Y is made responsible for conducting audit of the financial statements for the year 2021-2022. This Y is made responsible for conducting audit of financial statements for the year 2021 to 2022. If you are still having any doubts about this, I will try to explain the entire example once again. It may take another 2 minutes or so. A government company has been established in the financial year 2020-2021. Mr. X has been appointed as the first auditor of such government company by Comptroller and Auditor General. The next financial year for that company is 2021-2022. Subsequent auditor is required to be appointed only by Comptroller and Auditor General. Within how many days? Within 180 days from the date of commencement of the relevant financial year. In our example, the relevant financial year is 21-22. For 2021, X has already been appointed as the auditor. We are having a discussion about appointment of the auditor for the year 21-22. What is the date of commencement of the year 21-22? It is 1st April 2021. Within how many days? Within how many days the subsequent auditor is to be appointed by Comptroller and Auditor General? Within 180 days. If you calculate 180 days from 1st April 2021, it is around 30th September 2021. This is the cutoff date within which subsequent auditor is to be appointed. Assume that Y has been appointed as the subsequent auditor of this company within this cutoff date of 30th September 2021. What is the cutoff date or what is the ending date of the relevant financial year? What is the ending date of the relevant financial year? 31st March 2022. So Y is made responsible for conducting audit of the financial statements of the year dash. X is made responsible for conducting audit of the financial statements for the year 2021. Y is made responsible for conducting audit of financial statements for the year 2021-2022. Right? Now, what is the tenure of office? What is the tenure of office of that subsequent auditor appointed by Comptroller and Auditor General? You can, any one of you can provide an answer for this question. Next AGM. What is that? Till the conclusion of AGM. The term next has not been used in the Companies Act. The term till AGM has been used. Till AGM has been used. Generally in the books, it will be given as next AGM. But in the original act, it is said that the tenure of office of such subsequent auditor will be till the conclusion of AGM issued by the CA Institute. That is Clause 11 of Part-1, Clause 11 of Part-1 of First Schedule to the Chartered Accountants Act. Clause 11 of Part-1 of First Schedule to the Chartered Accountants Act. That clause says that a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he engages in any other business, if he engages in any other business or occupation, if he engages in any other business or occupation other than the profession of chartered accountancy, other than the profession of chartered accountancy. I repeat, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if that chartered accountant engages himself in any other business or occupation other than the profession of chartered accountancy. What is the literal meaning of this point? If you are holding a valid certificate of practice, you are expected to carry out only that practice. You are not expected, you are not allowed to carry out some other business or some other occupation other than the profession of chartered accountancy. You are required to carry out only the profession of chartered accountancy. You are not permitted to carry out any other business or any other occupation in addition to CA practice. So if you are holding COP, you need to practice the profession of chartered accountancy. That's it. You cannot involve yourself in the business, in any other business or occupation. If you do like that, you will be deemed to be guilty of professional misconduct. Now you may get a doubt. You said that you are a practicing chartered accountant and you are also taking classes in masterminds. That means you are doing some other business or occupation other than the profession of chartered accountancy. It means you have violated the provisions of clause 11 of Part 1 of First Schedule to the Chartered Accountants Act. We want to make a report on you to the CA Institute. Do that. No problem. Why? Because I haven't explained you the entire sentence, entire class. Now I will try to complete the class. According to clause 11 of Part 1 of First Schedule to the Chartered Accountants Act, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he engages in any other business or occupation other than the profession of chartered accountancy unless permitted by the council. Unless permitted by the council so to engage. Unless permitted by the council so to engage. What is the meaning of this? In the first sentence, rule is explained. In the second sentence, the exemption is given. What is the rule? If you are a chartered accountant in practice, you cannot carry out any other business or occupation other than the profession of chartered accountancy. That is the rule. Then what is the exception? If you are permitted by the council of the CA Institute to engage in some other business or occupation other than the profession of chartered accountancy, then you can do any other business or occupation while you are holding a valid certificate of practice. While you are holding a valid certificate of practice. Are you able to follow me? Now you may start thinking that probably I would have taken permission from the CA Institute to take classes. Unfortunately, I haven't got any permission from the CA Institute. In fact, I haven't made any application to the CA Institute asking the Institute, requesting the Institute to allow me to involve in this. In that case, again you can start making a report to the CA Institute against me saying that so and so person is involved in so and so activity while holding a valid certificate of practice. You can do that. Why? Because after introduction of this class, several chartered accountants started writing letters to the CA Institute requesting the CA Institute to allow them to involve in some other business or occupation other than the profession of chartered accountancy. They want to hold certificate of practice on one hand. They want to involve in some other business or occupation other than the profession of chartered accountancy on the other hand by taking dash from dash. By taking permission from the CA Institute, and it becomes very difficult for the CA Institute to grant permission or not to grant permission to thousands of chartered accountants. Therefore, the CA Institute had came up with a notification on this class CA on this class, CA Institute came up with a notification. In that notification, CA Institute divided permissions into two broad categories. CA Institute divided the permissions to be given by them to the practicing chartered accountants into two categories. The first one is permissions granted generally. What is that? Permissions granted generally. And the second one is permissions to be granted specifically. Permissions granted generally and permissions to be granted specifically. What is meant by permissions granted generally? 14 activities were mentioned by the CA Institute under the heading permissions granted generally. 14 activities. And the CA Institute said that if you are holding a valid certificate of practice on one hand, and if you want to involve yourself in carrying out any one or all of the activities that were mentioned under the heading permissions granted generally, you are not required to take any permission at all from the CA Institute. That means on one hand, you can hold a valid certificate of practice. On the other hand, you can involve in one or more of the activities that were mentioned by the CA Institute under the heading permissions granted generally, for which there is no need for you to take any permission at all from the CA Institute. On one hand, you can practice. On the other hand, you can carry out any one of these 14 activities or all of these 14 activities. The very first point under that heading is private tutorship. What is that? Taking classes, tutorship, private tutorship. I am not an employee. I am taking these classes privately, private tutorship. Therefore, that is an activity which is allowed to a practicing chartered accountant. Therefore, that is the reason why I haven't taken any permission from the CA Institute. Nothing wrong in it. Okay. And another point is you can act as a director of a company. You can act as a director of a company. That is another activity for which the CA Institute has given a general permission. So on one hand, you can hold a valid certificate of practice. On the other hand, you can become a director in a company. On the other hand, you can become a director in a company. So both are allowed. You can practice the profession of chartered accountancy on one hand, and you can become a director in a company. Nothing wrong in it. It has not been prohibited by the CA Institute. In fact, it has been allowed by the CA Institute. In that case, you will not be deemed that you are carrying out some other business or profession other than the profession of chartered accountancy. You are not deemed to be carrying on some other business or profession other than the profession of chartered accountancy when you are acting as a dash of dash. Acting as a director of a company, right? However, there are some activities which were mentioned under the heading permissions to be granted specifically. If you want to carry out any one of those activities which falls under the category permissions to be granted specifically or more than one activity, you need to take prior and specific permission from the CA Institute. They both are different in meaning. You need to take prior permission from the institute. That means before undertaking that activity, you have to write a letter to the CA Institute. If the CA Institute permits, then only you need to take up that activity along with the certificate of practice. Otherwise, you cannot do that. So prior permission is required to be taken and specific permission is required to be taken. For example, the following are the activities that were listed by the CA Institute under the heading permissions to be granted specifically. The first one is becoming a part-time employee or a full-time employee in a business concern. Becoming a part-time employee or a full-time employee, part-time employee or full-time employee in a business concern. So on one hand, you want to hold the valid certificate of practice. That means on one hand, you want to practice the profession of chartered accountancy. Apart from that, you want to become either a part-time employee. Apart from practice, you want to become either a part-time employee or a full-time employee in a business concern. That is not permitted. If you want to become either a part-time employee or a full-time employee in a business concern while holding a valid certificate of practice, you must have to take prior and specific permission from the CA Institute. If the CA Institute allowed you, then you can carry out both. What is meant by both? On one hand, you can practice the profession of chartered accountancy. On the other hand, you can become a part-time employee or a full-time employee in a business concern. Now, if you want to become a part-time employee or a full-time employee in a non-business concern, that means the only difference between point number 1 and 2 is under point number 1, you want to become either a part-time employee or a full-time employee in a business concern. In the second case, you want to become a part-time employee or a full-time employee in a non-business concern while holding a valid certificate of practice. If you are not holding a valid certificate of practice, there is no point in taking permission from the CA Institute. You are free, you are at liberty to accept either a part-time employment or a full-time employment as you wish. Since you are already holding a valid certificate of practice, hold a valid certificate of practice, and since you want to engage in some other business or occupation, you need to take prior permission from the CA Institute. So if you want to involve either as a part-time employee, to become either as a part-time employee or a full-time employee, either in a business concern or in a non-business concern, while holding a valid certificate of practice, you need to take prior permission from the CA Institute. The next one is, if you want to become either a whole-time director or a managing director. If you want to become either a whole-time director or a managing director in a company, just you can compare these 2 points, then you can easily understand why I am telling you all these things. By holding a valid certificate of practice, you are allowed to become dash, for which you are not required to take any permission at all from the CA Institute. But while holding a valid certificate of practice, if you want to become either a dash or a dash in a company, if you want to become either a whole-time director or a managing director in a company, you need to take prior and specific permission from the CA Institute, without which you cannot do that. If you do that, you will be deemed to be guilty of professional misconduct. And it is at the discretion of the CA Institute. CA Institute may decide either to allow the chartered accountant to take up such business or profession other than the profession of chartered accountancy, or they may not allow the chartered accountant to do all these activities. It all depends upon the discretion of the CA Institute. They may either allow you or may not allow you. If CA Institute allows, if the CA Institute allows a chartered accountant to involve in any one of these activities, like accepting part-time employment or full-time employment in a business concern or non-business concern, or becoming whole-time director or managing director, several other activities were listed under that heading. If they allow, then the CA Institute will impose a condition. This is very important. While allowing a chartered accountant to hold COP on one hand and to involve in any one of these activities on the other hand, CA Institute may allow you, but CA Institute will impose a condition. This condition is very difficult to understand. CA Institute will impose a condition. In fact, it is called as a precondition for giving permission by the CA Institute. The condition is, you are not allowed in that case to carry out your attest function. You are not allowed to carry out your attest function in that case. What is meant by? Do you understand this point? On one hand, you want to practice the profession of chartered accountancy. On the other hand, you want to become a managing director in a company. That you cannot do on your own. You need to take prior permission from the CA Institute. Fortunately, you got permission from the Institute. But while giving the permission, the CA Institute had imposed a condition. The condition is that you are not allowed to carry out your attest function. What is meant by attest function? Attestation means putting signature, making signature is called as attestation, and you are not allowed to carry out your attest function. That means you cannot sign. You cannot sign on what? Not on checks, not on other papers. You cannot sign, or you are not allowed to sign on dash audit reports. You are allowed to hold valid certificate of practice. You are also allowed to involve in some other activity like becoming a managing director or whole-time director in a company. But in that case, you are not allowed to carry out your attest function. When I say this, certainly some of you should get a doubt. The doubt is, then why the CA Institute is allowing the chartered accountant to hold valid certificate of practice on one hand, and why CA Institute is not allowing the chartered accountant to sign? When you are not allowing the chartered accountant to sign, what is the meaning of holding a valid certificate of practice? There is a logic behind that. You are not able to focus only on practice because you are involved in some other activity. The other activity is, say, you are a whole-time director in a company. You are a managing director in a company. You cannot give your 100% to the profession. You cannot allot all of your time to the profession. Therefore, CA Institute says that you can carry on profession, but you are not allowed to carry out your attest function. Probably most of you people may not know it. When you were appointed as the auditor of a company, then only you are required to sign on the auditor's report. When you are appointed as the auditor of a company, you are supposed to give a report. On that report, you are required to make your signature. However, apart from carrying out audit of companies, chartered accountants are allowed to carry out several other activities. For example, you may file an income tax return. You may file an income tax return on behalf of an employee. On behalf of an employee. Have you ever filed an income tax return on behalf of an employee? While filing the income tax return on behalf of the employee, you will upload the file by using the credentials of the employee, not by using the credentials of the chartered accountant. That means when you are filing an income tax return of an employee, you are not required to put your signature on any paper. You are not required to put your signature on any paper. In other words, for carrying out some activities as an auditor, you are required to sign. For carrying out some other activities as an auditor, you are not required to sign on any paper. You are allowed to carry out such activities which do not require your signature. You are allowed to carry out such activities which do not require your signature. Can you tell me the example of an activity which do not require the signature of the auditor? Filing income tax return. Filing income tax return on behalf of an employee is an activity which do not require dash from dash, which do not require attestation from the auditor. So you can carry out such activities which do not require attestation. You are prohibited from carrying out activities which require attest function. That means you are not carrying out a full-time practice. You are just a part-time practitioner. You are just a part-time practitioner. Why? Because you are holding COP, but unfortunately you are a whole-time director or managing director or full-time employee or part-time employee elsewhere. Therefore, you are prohibited from carrying out your attest function. That means you are not focusing fully either on practice or on employment. That is the reason why it is said that in the given case, the auditor is not a full-time practitioner, he is a part-time practitioner. That is the reason why CA Institute had imposed a condition whereby you are not required to carry out, you are not allowed to carry out your attest function. Are you able to follow me? Done. If you are having any doubts, feel free to ask me. I will try to explain the point again and again until you get clarity about that point. Okay? Done.
Hello everyone, greetings of the day. Now you can purchase CA inter-auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. you will find crystal clear, detailed explanation for every concept in the subject. And you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for cainteraudit Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for cainteraudit Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have three exciting, convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views. And the material will be couriered to you, and at the same time, you can have PDF material on the screen. And option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
So, when chartered accountant is not allowed to carry out a test function, what is the point in holding certificate of practice? By holding a valid certificate of practice, you can carry out some functions which do not require your attestation. What section 141 subsection 4 says? No. The concept of casual vacancy has been discussed. Subsequent disqualification has been discussed. If the auditor is disqualified, even before his appointment, then can that person who has attracted with disqualifications be appointed as the auditor of a company? I am asking the question again. Disqualification to the auditor may occur. Disqualification to the auditor may arise at any point of time. It may be either before appointment of the auditor or even after appointment. If disqualification occurs or arise to the auditor prior to appointment of the auditor, what happens? The auditor is disqualified. To be appointed as the auditor of a company, you must be eligible. To call you as eligible, you must have dash, and you should not suffer with dash. You must have qualifications and you should not suffer with any disqualifications. Already you are suffering with disqualifications. Therefore, you cannot be appointed as the auditor of the company if you suffer with any disqualifications prior to your appointment. I repeat, disqualification to the auditor may occur or may arise at any point of time. It may be either before appointment or even after appointment. If auditor gets a disqualification before his appointment, that person cannot be appointed as the auditor. However, sometimes it may so happen that at the time of appointment of the auditor, you have satisfied that the auditor is qualified. At the time of appointment of the auditor, you have satisfied that the auditor is not suffering with any disqualifications. Since he is qualified and since he is not having any disqualifications, the company is satisfied that the auditor is eligible, and hence that person can be has been appointed as the auditor of the company. But subsequent to his appointment, the auditor gets attracted with some disqualifications. Have you observed the main point under 141 subsection 4? What the section says, what the subsection says, disqualification to the auditor may occur or may arise at any point of time. It may be either before appointment or even after appointment. If the auditor suffers with disqualification before appointment, that person cannot be appointed as the auditor. Now, what happens if disqualification occurs to the auditor after his appointment? After his appointment. For example, you have been appointed as the auditor of a company called as A Limited. At the date of on the date of appointment, you are not holding any securities in the company. But after your appointment, you purchased some shares in the company being audited by you. In that case, what will happen? At the date of appointment of the auditor is not holding any securities in the company. But after his appointment, the auditor purchased some shares in the company. or at the date of appointment, the auditor is not indebted to the company. But after his appointment, the auditor has taken a loan of 10 lakh rupees from the company being audited by him. In that case, it is said that the auditor gets attracted with disqualifications, and the auditor gets attracted with disqualifications not before appointment. If the auditor gets attracted with disqualifications before appointment, that person cannot be appointed as the auditor. In the given case, auditor gets attracted with disqualifications after his appointment. Now the question is, what happens if the auditor gets attracted with disqualifications after his appointment? The answer is so simple. In that case, the auditor had to vacate. It is said by the Companies Act that the auditor had to vacate his office immediately. Auditor cannot continue to be the auditor of that company. He had to vacate his office as the auditor. When the auditor vacates his office, then there would not be any auditor to the company, and hence such a situation is technically called as a casual vacancy. I repeat, according to section 141 subsection 4 of the Companies Act, disqualification to the auditor may occur or may arise at any point of time. It may be either before appointment of the auditor or even after appointment of the auditor. If disqualification occurs before appointment, that person cannot be appointed as the auditor. If disqualification occurs after appointment, it is deemed that the auditor vacated his office immediately, and hence there will arise a vacancy in the office of the auditor called as casual vacancy. In other words, he cannot be considered as the auditor of that company from that moment. That is called as the casual vacancy. I hope you have an understanding of section 141 subsection 4. If you say yes, I want to ask you a question. Now, your father, and another important provision is there in the Companies Act. You have been continuing the previous example. There is a company called as A Limited. You are a chartered accountant. You are not holding any securities in A Limited, but your father is holding some securities in A Limited, having a face value of just 80,000 rupees. Can you be appointed as the auditor of A Limited? Your answer is yes. You have been appointed as the auditor of A Limited. Subsequent to your appointment as the auditor of A Limited, your father had acquired some more shares in A Limited, having a face value of 30,000 rupees. Now, the total value of the shares or total value of the face value of the shares held by your father became 1,10,000. Before your appointment, your father is holding shares in the company having a face value of only 80,000. But after your appointment, some more shares have been acquired by your father having a face value of 30,000, and hence now your father is holding the shares in the company being audited by you having a face value of 1,10,000. In this case, if you strictly need to follow the provisions of section 141 subsection 4, what will happen? If you are required to strictly follow the provisions of section 141 subsection 4, what will happen? The moment your father purchased shares or securities having a face value of another 30,000, the moment your father holds securities in a company being audited by you having a face value of more than 1 lakh rupees, you are disqualified, and this disqualification occurs to you after appointment. And according to section 141 subsection 4 of the Companies Act, if disqualification occurs after appointment, it is deemed that the auditor had vacated his office, and hence there will arise a vacancy in the office of the auditor called as casual vacancy. So in the given case, strictly by following the provisions of the Companies Act, what has to happen? What has to happen if you strictly follow the provisions of the Companies Act? You need to vacate your office immediately, because your father is holding securities in the company having a face value of more than the threshold limit of 1 lakh, and because this disqualification occurs to you after your appointment. But the Companies Act has given a relaxation particularly for this point. The Act says that if your relative acquires some more securities in a company, if your relative acquires some more securities in a company after your appointment, and if such value of the securities held by the relative crosses or exceeds the threshold limit of 1 lakh rupees, the auditor will be given a time of 60 days. Companies Companies Act has given a time of 60 days to the auditor. Within these 60 days, the auditor should try to bring down the value of the securities held by his relative to the threshold limit of 1 lakh. If the auditor is able to do that, he can continue to be the auditor of the company. What is the rule and what is the exception? Have you understood the rule and the exception? What is the rule? If you get attracted with disqualifications after your appointment, you need to vacate your office immediately, and hence there will arise a vacancy in the office of the auditor called as casual vacancy. But in the instant example, your father is holding some securities in a company which are well within the threshold limit of 1 lakh. Hence, you have been appointed as the auditor of the company. After your appointment as the auditor of the company, your father acquired some more shares in the company. Now it is said that your father is holding securities having a face value of more than 1 lakh rupees in the company. That means you get disqualified immediately. When you get disqualified, what section 141 subsection 4 says? You need to vacate your office. But for this particular point, Companies Act has given a relaxation to the auditor. What was the relaxation given by the Act to the auditor? In that case, auditor is not required to vacate his office immediately. A time of how many days has been given by the Companies Act? A time of 60 days has been given by the Companies Act. Within that time, what the auditor should do? The auditor should try to bring down. The auditor should try to bring down the value of the securities held by his relative to the threshold limit of 1 lakh. In that case, the auditor can continue to be the auditor of the company. In the given case, what will you do as an auditor? You will request your father to sell off securities in that company up to having a face value of up to 10,000. In that case, if your father sells securities having a face value of 10,000 rupees, then it is said that your father is holding securities up to a face value of only 1 lakh, which is well within the threshold limit, and hence you can continue to be the auditor of the company. That relaxation has been given particularly for this point. This is about, and another important point. Have you understood this point? If you say yes, I want to ask you some other question. Your father is holding some securities in a company having a face value of 1,20,000. So, can you be appointed as the auditor of that company? No, but you started arguing like this. Please appoint me as your auditor. Please give me a time of 60 days. Within 60 days, I will try to bring down the value of the securities held by my father to the threshold limit of 1 lakh so that I can continue to be the auditor of the company. Will you accept with the contention of the auditor in the given case? No, no. This 60 days time is given only when disqualification occurs after his appointment. It is not applicable for before appointment. This is all about section 141 subsection 3 clause D subclause 1 subclause 2 and subclause 3 of the Companies Act. So what is section 141? 141 deals with qualifications and disqualifications. According to this section, if the auditor is qualified and if the auditor is not suffering with any disqualifications, then it is said that he is eligible to be appointed as the auditor of the company. Therefore, to be appointed as the auditor of a company, you must have qualifications and you should not suffer with any disqualifications. The qualifications that are required were explained in section 141 subsection 1 and 2. The disqualifications with which the auditor should not suffer were given under section 141 subsection 3 and subsection 4. 141 subsection 3 says that the following persons are disqualified from being appointed as the auditors of the company. Class A body corporate other than an LLP. Class B, an officer or an employee of a company cannot be appointed. Class C, a partner or an employee of an officer or employee cannot be appointed. Class D, subclass 1, a person or his relative or his partner is holding any security either in the company or its group companies, that person is disqualified. Subclass 2, if a person or his relative or his partner is indebted to in any one of the group companies, then he is disqualified from being appointed as the auditor. Subclass 3, if you have given any guarantee or security, if you or your relative or your partner has given any guarantee or security in connection with an indebtedness exceeding 1 lakh, either to the company or to its subsidiary company and so on, again you are disqualified from being appointed as the auditor of the company. Particularly, Class B, Class C and Class D have been introduced in the Companies Act merely to safeguard or to protect the independence of the auditors. Now let's have a discussion on section 141 subsection 3 clause E. 141 subsection 3 clause E. This point deals with the concept called as business relationship. This point is somewhat different from the previous one, so be careful while listening to this. According to section 141 subsection 3 clause E of the Companies Act, if a person or firm, if a person or a firm is having any business relationship, either directly or indirectly, I repeat, if a person or a firm is having any business relationship either directly or indirectly, either with the company or with its subsidiary company or with its holding company or with any other subsidiary of such holding company or with its associate company or subsidiary of such associate company. You can observe that the last point is not appearing under clause D. In clause D, only first 5 are covered. In clause E, 6 points are covered. You need to understand the difference between clause D and clause E. What clause D says? In a company which proposes to appoint you as the auditor, or its a subsidiary company, or its a holding company, or any other subsidiary of such holding company, or its associate company. That's it. Whereas in clause E, in clause D, only 5 types of companies are covered. Whereas under clause F, 6 types of companies are covered. Have you observed that point? What is section 141 subsection 3 clause E? If a person or a firm is having a business relationship either directly or indirectly, either with the company which proposes to appoint them as the auditor, or its a subsidiary company, or its holding company, or any other subsidiary of such holding company, or its associate company, or subsidiary of such associate company, then that person is disqualified. Why? The logic is so simple to understand. If you are having a business relationship with a company either directly or indirectly, that means you are having some self-interest in the company. If you are having self-interest in the company, always you will try to protect your self-interest. In the process of protecting your self-interest, or for the sake of protecting your self-interest, there is every chance that you may listen to the words of the management. You may act in accordance with the directions or instructions given by the management. In that case, you cannot be called as independent. So if a person who is having a business relationship is allowed to be appointed as the auditor, because of his self-interest in the company, he may not be able to maintain independence. That is the reason why the Act says that if you are having a business relationship either directly or indirectly, either with the company or with group companies, if you are your firm, the term relative is not covered here. If you are your firm, have you observed that point? Under clause D, the term relative is covered, whereas under clause E, the term relative is not covered. If you or your firm is having any business relationship, either directly or indirectly, either with the company or so and so, then you are disqualified from being appointed as the auditor. The logic is so simple. If you are having a business relationship, it is said that you are having a self-interest. If you are having a self-interest, always you will try to protect your self-interest. For protecting your self-interest, you won't care even you don't care even if it is detrimental to the interests of the shareholders of the company. In that case, what will you do? You will try to act in accordance with the directions or instructions given by the management. In that case, it is said that auditor is not independent, and hence the opinion given by the auditor is not reliable to the users of the financial statements. So by this you need to understand that even this subsection is introduced merely to safeguard or to protect the independence of the auditor. So 141 subsection 3 clause B, 141 subsection 3 clause C, clause D subclause 1, 2, 3, clause E, all these provisions are introduced only to protect or to safeguard the independence of the auditor or to keep the auditor independent. Now, the most important question in this is what is meant by a business relationship? That is most important. What is meant by business relationship? The term business relationship has been defined as a transaction entered with a commercial purpose. God. The term business relationship is defined as transactions entered with a commercial purpose. I repeat, 141 subsection 3 clause E deals with the concept of business relationship. What is business relationship? Business relationship is defined as transactions entered with a commercial purpose. If you enter any transaction with a commercial purpose, it is said that you are having a business relationship. I repeat, if the auditor or audit firm, either directly or indirectly has entered into any transaction with a commercial purpose, it is said that the auditor and the company with whom the auditor has entered into a transaction with a commercial purpose are having a business relationship. In that business relationship, auditor will always try to protect his self-interest, and hence, obviously, the auditor may fail to maintain independence. That is the reason why this provision says that such persons are disqualified from being appointed as the auditors of the company. Now, you may get a doubt. What is meant by transaction entered with a commercial purpose? The term business relationship has been defined as transactions entered into with a commercial purpose. Then what is meant by transaction entered with a commercial purpose? Unfortunately, Companies Act has not defined the term what is transaction entered with a commercial purpose. But the Companies Act has given two exceptions. Companies Act has given two exceptions for the term transactions entered with a commercial purpose. Those exceptions are very important for you, and you must have to understand those two exceptions to have a broader view about section 141 subsection 3 clause E of the Companies Act. I repeat, under 141 subsection 3 clause E, the term relative is not used. Although it is not specifically used, it also includes the term relative. Why? Because the term dash or dash has been used. Either directly or indirectly has been used. Such indirect business relationship includes a relationship of your relative with the company. Now, coming to the original point, what is transaction entered with a commercial purpose? Nowhere in the Companies Act it has been defined. However, Companies Act has given two exceptions to this rule. The exceptions are like this. You know very well that a chartered accountant in practice can be used by the company for the purpose of conducting audit. In other words, a chartered accountant in practice can be appointed by a company for the purpose of audit. Not only that, the services of a chartered accountant may be utilized by a company in many number of ways, not only for the purpose of audit. Auditor's services will be utilized by a company in many number of ways. The following are some of the ways in which a company can make use of the services of a practicing chartered accountant. Let us assume that there is a company called as A Limited. The company is required to prepare and file its income tax return once in a year. The company is also required to prepare and file GST returns at periodical intervals. Unfortunately, the company do not know how to prepare income tax returns and GST returns and how to file the same with respective authorities. Therefore, the company engaged a practicing chartered accountant. Therefore, the company engaged a practicing chartered accountant. In the given case, the company engaged a practicing chartered accountant not for the sake of audit, but for the sake of providing services in the areas relating to preparation and submission of income tax returns and GST returns on behalf of the company. Have you understood this point or not? Generally speaking, dash will be appointed only for dash. Generally speaking, a chartered accountant may be appointed by a company only for the sake of conducting audit. But a chartered accountant can provide many other services to a company. This is the best example of the other service that a chartered accountant can provide to the company other than conducting audit. The chartered accountants may provide services to the company in the area of taxation. In the area of taxation. What is meant by providing services in the area of taxation? Auditors do help the companies in preparation of income tax returns and GST returns and in filing the same with respective authorities. In such case, it is said that auditor is providing services to the company in relation to taxation matters. By now, you should be able to understand that a practicing chartered accountant can be appointed by the company either for the purpose of conducting audit or for the purpose of providing some services relating to dash matters, relating to taxation matters. Similarly, you know very well that every company is required to prepare and submit annual return with concerned register of companies. Section 92 of the Companies Act deals with the concept of annual return. According to Section 92 of the Companies Act, every company is under obligation to prepare and to file a return with register of companies on an annual basis called as annual return. The company do not know how to prepare an annual return and how to file an annual return with ROC. Hence, the company appointed a practicing chartered accountant. Remember, in the given case, the company appointed chartered accountant not for the sake of getting services relating to audit, but for the purpose of getting some services from such chartered accountant relating to company law matters. What is that? Relating to company law matters. If the chartered accountant is offering some services relating to taxation, they are called as taxation matters. If the auditor is providing some services relating to company law, then it is said that you are getting services of the chartered accountant in relation to company law matters. And for several other services, the company may appoint a chartered accountant. By this, every one of you must be able to understand that the services of a chartered accountant can be utilized by the company not only for the purpose of audit, but for some other purposes like getting services relating to the areas of taxation, company law matters, etc. Now, the correct point, the most important point that you need to understand from this entire discussion is about what is a transaction entered with a commercial purpose. As already said to you, it has not been defined in the Companies Act, but Companies Act has given two exceptions. I am going to explain you those two exceptions now. Please try to understand them. There is a company called as A Limited. There is a person called as X. X is a chartered accountant holding a valid certificate of practice, practicing individually. Now, A Limited appointed Mr. X for the sake of providing some taxation related services to the company. For the sake of providing some taxation related services to the company. Remember, in the given case, the company has not appointed X for the purpose of conducting audit. They want to get some services from the auditor relating to the area of taxation. For that, A Limited appointed Mr. X as the X for the purpose of getting taxation related services. Every year, the auditor is preparing income tax returns, GST returns. The same are being filed with the respective authorities concerned, for which A Limited is making a payment of say 3 lakh rupees per annum to the auditor concerned. Let us assume the amount of remuneration paid by A Limited to the auditor per annum is 3 lakh rupees. Remember, in the given case, the auditor is not providing any audit related services to the company. The auditor is providing services relating to taxation matters to the company. And this has been continued for a period of 3 years. Now the company satisfies with the quality of the services being provided by X. Therefore, the company wants to appoint that X as their auditor in the ensuing annual general meeting. In the ensuing annual general meeting, in the coming annual general meeting, the company wants to appoint Mr. X as their statutory auditor or company auditor. Remember, he is not the statutory auditor till now. He is just providing dash services to the company, taxation services to the company. Now the company is proposing to appoint him as their auditor. Meanwhile, one of the shareholders of the company raised an objection for this. The argument of the shareholder is like this. Already you are availing the services of that chartered accountant for taxation matters. You are making a payment of 3 lakh rupees per annum. So you are getting services from the chartered accountant, and for the same you are making a payment. Therefore, it is said that already there exists a transaction between the company and the auditor, which shall be considered as a transaction entered for a commercial purpose. Company is making payment, auditor is providing services. That means it is said that there is a transaction between the company and the auditor, which is said to be a commercial transaction. Since there is a commercial transaction between the company and the auditor, it is said that the chartered accountant, it is said that there is a business relationship between the company and that chartered accountant. What the act says, if you are having any business relationship, you are disqualified from being appointed as the auditor. Therefore, the shareholder contended that since some payment is being made by the company to the chartered accountant, and since the chartered accountant is offering some services to the company, so it is said that there is a transaction between the company and the auditor, which is to be considered as a commercial transaction. When it is a commercial transaction, it is said that there is a business relationship. When there is a business relationship, that person cannot be appointed as the auditor. Therefore, the shareholder strongly believes that Mr. X in the given case cannot be appointed as the auditor of the company. Do you agree with the contention of the shareholder? The answer is no. Why? Because the Companies Act had clearly specified that this type of transaction shall not be construed as a transaction entered with a commercial purpose. This type of transaction shall not be construed as a transaction entered with a commercial purpose. Therefore, in the given case, you cannot say that there is a dash transaction between dash and dash. You cannot say that there is a commercial transaction between the company and that particular chartered accountant. Since there is no commercial transaction, there is no business relationship. Since there is no business relationship, auditor is not disqualified, and hence in the coming annual general meeting, certainly the company can appoint Mr. X as their auditor. Have you followed this point or not? 5 consecutive years. Tenure in respect of a partnership firm is 2 terms of 5 consecutive years. The tenure is different, but the cooling period is applicable for both the individual and partnership firm is one and the same. It is for a period of 5 years. After waiting for a period of 5 years, the partnership firm can be appointed as the auditor of the company for a further period of 2 terms of 5 consecutive years. Now there is one more point that is required to be discussed here. This X Limited, in their first annual general meeting, this X Limited appointed AB and Company as its partnership, as its auditor, a partnership firm, in its first AGM. The resolution that has been passed in the first AGM is like this: resolved that AB and Company a partnership firm of chartered accountants having firm registration number so and so has been appointed as the auditors of our company to hold office from the conclusion of the first annual general meeting till the conclusion of the 11th annual general meeting. Till the conclusion of the 11th annual general meeting at a remuneration of so and so. This is the content of the resolution passed by the company in its first annual general meeting. Do you accept for this type of resolution? Is there anything wrong in this resolution? Yes. The company can appoint a partnership firm initially for a period of one term of 5 consecutive years. Later on, the company has been given an authority to reappoint the same partnership firm for a further period of another 5 years. You cannot straight away appoint the partnership firm as our auditor for a consecutive period of 10 years at a time. That appointment for a consecutive period of 10 years, that is appointment for 2 terms of 5 consecutive years is not valid. Initially, you need to appoint for 1 term. Later on, after completion of the term, you may reappoint the same partnership firm as your auditor for another term of 5 consecutive years. Appointment of a partnership firm straight away for a period of 10 years is not an acceptable way of appointing a partnership firm. This is briefly about rotation of auditors. For individual, the maximum term is 1 term of 5 consecutive years. Later on, he cannot be reappointed as the auditor of the same company for a period of 5 years. For a partnership firm, the maximum term for which they can be appointed as the auditors is 2 terms of 5 consecutive years. After that, they cannot be reappointed as the auditor of the same company for a period of 5 years. After a gap of 5 years, they can be appointed as the auditor of the same company. Actually, this is sufficient for you. But there is a point which is very difficult to understand, which is given under section 139 subsection 2, which is like this. Companies, at the time of introduction of the Companies Act is introduced in the year 2013. But all the sections of the Companies Act were not introduced in the year of introduction of the Companies Act. Sections in the Companies Act are made applicable in a phased manner. And what the Act says is, provisions relating to section 139 subsection 2 are required to be complied with by a company only after a period of 3 years. Only after a period of 3 years from the date of commencement of the Companies Act. Let us assume that commencement of the Companies Act date is 1/4/2014. Several sections, almost if I remember it correctly, 89 sections have been introduced on 1/4/2014. Let us assume the date as 1/4/2014. What the Act says, 139 subsection 2 provisions are not made applicable immediately to the then existing companies. They are made applicable only after a period of 3 years. That 3 years period has been called in Companies Act, very good, in Companies Act as a transition period. That concept of transition period is very, very important for you. And in order to explain the concept of transition period, a big table has been given in the rules also. I will try to explain that table briefly now so that you can understand the importance of transition period, the impact of transition period, and the meaning of transition period in detail. What is transition period and what is its impact? As already explained to you, the date from which the Companies Act is made applicable is assumed as say 1/4/2014, and transition period given is for a period of 3 years. So 1/4/2017. Actually, this is also not correct, but if you are able to understand this, it will be easier for you to understand the actual position in the Companies Act. So 1/4/2014 is the date on which the Companies Act came into existence. But companies which are covered under section 139 subsection 2 are not required to follow the provisions of section 139 subsection 2 from 1/4/2014. It is sufficient if they follow the requirements from 1/4/2017. The gap between 14 and 17 is 3 years. That 3 years period has been called as a transition period. Yes or no? Now, let us assume that there is a company called as X Limited, for which rotation is made applicable. Rotation is made applicable. Today's date is 1/4/2014. Today's date is 1/4/2014. Prior to 1/4/2014, this X Limited appointed Mr. A. This X Limited appointed Mr. A, an individually practicing chartered accountants as its auditor, and this A is being appointed as the auditor of X Limited for the past 15 years. Let us assume the same person is being appointed as the auditor of X Limited for the past 15 years before commencement of the new Companies Act. Now, X Limited still want to appoint Mr. A as its auditor. For how many more years X Limited can appoint Mr. A as its auditors? Remember, for X Limited, dash is made applicable. Rotation is made applicable. For how many more years this X Limited can reappoint their auditor Mr. A as their auditor? For a period of 3 years. Because in the Act itself it is said that these provisions are made applicable not immediately, only after a period of 3 years. That 3 years period is called as dash, transition period. During that transition period, the same auditor can be continued. So same A can be appointed by X Limited as on 1/4/2014 for a further period of how many years? For a further period of 3 years. In that case, the total period served by A in the company will become how many years? 18 years. Now today's date is 1/4/2017. What is today's date? I started with 1/4/2014 and I said that he has been appointed as the auditor for a period of 3 years. Therefore, today's date is 1/4/2017. On this date, Mr. A was the auditor of the company for a period of how many years? 18 years. Now, today, company wants to reappoint Mr. A as its auditor again. The question is it possible for the company to appoint Mr. A as its auditor? From which date the provisions of 139 subsection 2 are made applicable? From 1/4/2017. For the sake of clarity, let us assume like that. Date is to be assumed as 1/4/2017. Today's date is 1/4/2017. By this day, A is the auditor of the company for the past 18 years. A is an individual. A is an individual. For how many years an individual can be appointed as an auditor? One term of 5 consecutive years. He has been the auditor of the company for the past 18 years. Can still he be reappointed as the auditor of that company as on 1/4/2017? Yes or no? No. Very good. Now, I want to change my example. Today's date is 1/4/2014. As on this date, Mr. A was the auditor of the company for the past 10 years. For how many more years he can be appointed as the auditor? 3. For the past 9 years. Today's date is 1/4/2014. Mr. A has been the auditor of the company for the past 9 years. For how many more years the same person can be appointed as the auditor of the same company? 8 years, 7 years, 6 years, 5 years, 4 years, 3 years, 2 years, 3, 1 year. That's it. So, if he has been the auditor of the company for the past 10 years, you can appoint him for a period of another 3 years. Past 9 years, 3. Past 8 years, 3. Transition period is always applicable. Therefore, past 5 years, 3. Past 4 years, 3. Past 3 years, 3. Past 2 years, 3. So that the total period will become 5. Past 1 year, This is most important. Before commencement of audit, he held office for how many years? 1 year. After commencement of audit, he can be appointed for a period of a maximum of for a period of 3 years, transition period. He has been appointed as the auditor for a period of 3 years in the transition period. After completion of 3 years, the total period for which he held office as the auditor becomes 4. For how many more years? The date on that is 1/4/2017. For how many more years he can be appointed as the auditor? 1 year, so that he will complete a period of 5 years. Then he cannot be reappointed as the auditor for a period of 5 years. What you need to understand from this is, for calculating this period of 5 years, you are considering the period held by the auditor before commencement of audit, during the transition period, as well as after commencement of audit. So for calculation of 5 years period, you must consider dash, dash and dash. Period held by the auditor before commencement of audit, transition period, as well as period after transition period. This is the way in which the term is required to be calculated in respect of an individual. If you are still confusing with this, I will give you another example, this time relating to partnership firm. As said earlier, dash is applicable to all. Transition period is applicable to all, whether it be an individual or it be a partnership firm. Now, today's date is 1/4/2014. A company has appointed the same a partnership firm as its auditor for the past 10 years. A company is appointing a partnership firm as its auditor for the past 10 years as on 1/4/2014. For how many more years this company can appoint the same firm as its auditor? Why? Because it is a transition period. It is made applicable to both dash and dash, both individual as well as a partnership firm. So they can be appointed as the auditors for another period of 3 years. This partnership firm has been the auditor of the company for the past 9 years as on 1/4/2014. For how many more years they can be appointed as the auditors? For the past 8 years. Excellent. For the past 7 years. For the past 6 years. For the past 5 years. For the past 4 years. 6 years. For the past 4 years, they are the auditors, and they can hold office for 2 terms of 5 consecutive years. 2 terms of 5 consecutive years means 10 years, out of which they completed only 4 years. So they can be appointed as the auditor for another 6 years. 3 years transition period, another 3 years period after the transition period. Are you following or not? As on 1/4/2014, a partnership firm has been the auditor of the company for a period of past 3 years. For how many more years they can be appointed? 7 years. Out of 7, 3 is transition period. Remaining 4 is other than transition period. For the past 2 years, they were the auditors. For how many more years they can be appointed? 8 years. For the past 1 year, they were the auditors. For how many more years they can be appointed? For past 0 years, they were the auditors. You can appoint them for a period of 10 years. That's it. This is about the concept of transition period, the impact of transition period on the term of office of the auditor. And the last point is this. There are 2 more points left in this discussion. The first one is, for what type of companies or for what classes of companies rotation is made applicable. And the second one is some other few important points are required to be discussed under the heading rotation. I'll do one thing. I will go through the material. so that no point in the material will be missed in discussion, because this point is very important point in examination point of view. 139 subsection 2 is very important in examination point of view. Students gets confused while reading and understanding section 139 subsection 2. This is not applicable. 139 subsection 2 is not made applicable to OSD. What is that? OSD. O means one person. Previously, under the heading ceiling or number of audits, I said it as OPSD. Now P is removed. OSD, one person company, small company and dormant company, the provisions of 139 subsection 2 are not made applicable. So the only thing, another important one, there is a partnership firm called as XY and Co. There is a company called as A Limited. This A Limited appointed XY and Co as its auditors in its first AGM. They held office till the conclusion of 6th AGM. They were reappointed as the auditors and till the conclusion of 11th AGM. They held office till 11th AGM. It is not at all possible for A Limited to reappoint XY and company as their auditors in the 11th AGM, because dash is made applicable to them, because rotation is made applicable to them. Now, the company wants to appoint some other partnership firm. The name of the other partnership firm which the company proposed to appoint is, say, YZ, is, say, ABX and Co. ABX and Co. There are three partners in ABX and Co. A, B and X. Unfortunately, this X, who is a partner in ABX and Co, and this X, who is a partner in XY and Co, they both are one and the same. The same person is the partner in both dash as well as dash. The same person is a partner in both XY and company and ABX and company. What is XY and company in this example? XY and company in this example may be technically called as outgoing auditor, otherwise called as retiring auditor. Actually, you need to call them as outgoing auditors, not retiring auditors, but sometimes those two terms are used interchangeably. So, in the given example, XY and Co, a partnership firm, is to be called as outgoing auditor or retiring auditor. Then, who is ABX and Co? ABX and company is the proposed auditor, is the proposed auditor or incoming auditor. So in place of XY and company, the company is proposing to appoint ABX and company. Now the point is, there is a common partner. There is a common partner in both dash and dash. Outgoing partnership firm and proposed or incoming partnership firm. The act says like this: if there is a common partner, if there is a common partner or common partners in both the outgoing partnership firm and proposed audit firm, the proposed audit firm shall also be disqualified along with outgoing audit firm for a period of 5 years. In the given example, XY and company had to follow a cooling period of 5 years. Since dash and dash are having a common partner or common partners, since outgoing firm of chartered accountants, that is XY and company, and proposed firm of chartered accountants or incoming firm of chartered accountants, ABX and company, is having same partner or same partners, now ABX and Co is also deemed to be disqualified. They cannot be appointed as the auditors of A Limited for a period of 5 years along with XY and company. So when there are common partner or common partners, the proposed audit firm will also get disqualified for a period of 5 years. That is what you need to understand from this discussion. Understood or not? Now, one more point is there. By this, everything is covered which is given in our material. XY and company has been appointed as an auditor. They served as the auditors of the company for a period of 10 years. 10 years. They completed their tenure. They cannot be reappointed as the auditors. Somebody else should have to be reappointed. Meanwhile, X, the signing partner. What is that? X is the signing partner. That means he carried out the audit. He made his signature on the auditor's report. X signing partner retired. X the signing partner retired from dash X, Y and Co. and joined another firm called as AB and Co. Thereafter, the name of AB and Co. has been changed to ABX and Co. Now, the company wants to appoint this ABX and Company, a partnership firm of chartered accountants, as their auditors. Is it possible for the company to do so? No, a big no, which is given in the Companies Act itself. This point is given in the Companies Act and rules itself. So, when the signing partner resigned and joined as a partner in another partnership firm, the partnership firm in which the signing partner joined is also disqualified from being appointed as the auditor of that company for a period of 5 years. This is all about section 139 subsection 2. I dealt with all the points under section 139 subsection 2 excepting the point called as applicability. What is that? Accepting applicability. Now read what is given in the material under section 139 subsection 2. What is the page number in which 139 subsection 2 is appearing? 9. Okay, done. Right. Question number 11. Explain the provisions relating to rotation of auditors. Explain the provisions relating to rotation of auditors. Applicability of rotation of auditors, I don't want to explain them. I want to just read them. That is the reason why I opened the material. It is applicable to all listed companies. It is applicable to unlisted public companies having a paid up capital of 10 crores or more, having borrowings from banks and public financial institutions and in the form of deposits of 50 crores or more. All private limited companies having a paid up capital of 50 crores or more, borrowings of 50 crores or more. For these types of companies, rotation is made applicable. If you still need some explanation for this, I am willing, I am ready to explain this. In case of a listed company, without checking any other parameters, for a listed company, 139 subsection 2 is made applicable. For sometimes, even for unlisted public companies, 139 subsection 2 should be made applicable when such an unlisted company satisfies any one of the following two conditions. If the unlisted public company's paid up share capital is 10 crores or more, rotation is made compulsorily applicable. If such unlisted public company is having borrowings from banks, public financial institutions, public deposits, in the form of deposits aggregating 50 crores or more, then such unlisted public companies under obligation to rotate their auditors. Actually, I don't want to explain these things, but I know very well that some of you people may not understand these things by reading them. That is the reason why I am trying to explain it briefly. All private limited companies. So you can compare point number 1 and point number 1 here, point number 2 and point number 2 here. Here it is 10 crores or more, here it is 50 crores or more. B2 and C2 is one and the same. Originally, in the rules, this is not mentioned like this. In the rules, it was mentioned like this. 139 subsection 2 is applicable to the following types of companies. 1. All listed companies. 2. Unlisted public companies having a paid up share capital of 50 crores or more. 3. 10 crores or more. 3. Private limited companies having a paid up capital of 50 crores or more. Point number 4. Companies which do not fall either under point number 2 or under point. This is the original act. What the original act says, 139 subsection 2 is made applicable to the following types of companies. 1. All listed companies. 2. Unlisted public companies having a paid up capital of 10 crores or more. 3. Private limited companies having a paid up capital of 50 crores or more. 4. Companies which do not fall either under point 2 are under point 3. What is point 2? Unlisted public companies. There is an unlisted public company, but the paid up capital of that unlisted public company is less than 10 crores. There is a private limited company. The paid up capital of that private limited company is less than 50 crores. They do not fall either under point number 2 or under point number 3. But they are having borrowings from banks, financial institutions and deposits. Although the term R is used, you need to take the aggregate, and deposits of 50 crores or more. So the point relating to borrowings is applicable for both dash and dash. Is applicable both for unlisted public companies as well as private limited companies. That is the reason why here they have divided the unlisted public companies and private companies into two different categories. In the original act, that division is not made. This is made for the sake of your convenience. So, if these conditions are satisfied, the company is under obligation to rotate their auditors. Next, the provision shall not apply to one-person company, small company. Rotation shall not apply to government companies. Manner of rotation. Every company to which why the term rotation is not applicable to government companies is used. Actually, Companies Act has not mentioned that rotation is not applicable to government companies. They are saying that rotation is not applicable to government companies. Why? That point is right. Why? Because in case of government companies, the first auditor of a government company is required to be appointed by Comptroller and Auditor General. He will hold office up to the conclusion of the first annual general meeting. Who should appoint the subsequent auditor of a government company? Only by Comptroller and Auditor General. What is the tenure of office? What is the tenure of office of the auditor? Till the conclusion of AGM. Till the conclusion of AGM. That's it. So it is only year to year. Appointment of auditors in case of government companies is not for a period of 5 years. Therefore, there is no point of rotation at all. Every year the auditor gets rotated. That is the reason why probably they may have written like that. So in the Act it was not there. In the Act it was not there. It is not applicable to one-person companies, small companies and dormant companies. This is what is mentioned in the Act. Manner of rotation. Every company to which the concept of rotation is applicable shall not appoint or reappoint an individual as auditor for more than one term of 5 consecutive years and a firm as auditors for more than 2 terms of 5 consecutive years. An individual auditor or an audit firm has completed the respective term, namely 5 years or 10 years, shall not be eligible for reappointment as auditor in the same company for a period of 5 years from the completion of their respective term. Next point, for the sake of convenience, retiring auditor is referred to as outgoing auditor, new auditor is referred to as incoming auditor. If there is a common partner or common partners in incoming and outgoing audit firms, then such incoming auditor is not eligible for appointment under rotation. Also, if the incoming auditor and outgoing auditor belongs to same network, this point is not yet explained. I will try to explain it in the tomorrow's class by explaining what is network. Time is not sufficient for me to explain this point as of now. If a partner who is in charge of an audit firm and also certifies the financial statements of the company retires from the said firm and joins another firm of chartered accountants, such other firm shall also be ineligible to be appointed as the auditor for a period of 5 years. So there are few more points left for a discussion in relation to section 139 subsection 2. In tomorrow's session, I am going to explain you those 2 points. It may take another 10 minutes or so to complete 139 subsection 2. Later on, I will try to complete the other sections. But in the time that is now available, short time that is now available, I will try to complete 139 subsection 3. What is section 139 subsection 3? If you really want to understand 139 subsection 3, you should be able to recollect that a company, even by passing an unanimous resolution, cannot impose any limitations or restrictions either on the rights of the auditor or on the duties of the auditor. Yes or no? Now, what is section 139 subsection 3? This section is applicable only when a partnership firm is appointed as an auditor. This section is applicable only when a partnership firm is appointed as an auditor. Okay? Just a minute. Only when a partnership firm is appointed as an auditor. There are, say, 4 partners in a partnership firm. Now, the shareholders of the company passed a resolution like this. At least 2 out of 4 partners, at least 2 out of 4 partners must present for conducting audit. So, one partner cannot conduct audit. A minimum of 2 partners must have to carry out the audit. That is the thing that has been mentioned by dash and dash. By dash and dash. By the shareholders in a resolution. That means shareholders are imposing a restriction. Shareholders are imposing a restriction on a partnership firm, saying that at least 2 partners must attend for conducting audit. Can such type of restriction be imposed by the shareholders on the auditors of the company? The answer is yes, which is given under section 139 subsection 3. Company cannot impose any restrictions on the rights of the auditor. The company cannot impose any limitations or restrictions on the duties of the auditor.
Hello everyone, greetings of the day. Now you can purchase CA inter-auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have 3 exciting convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views, and the material will be couriered to you, and at the same time you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Important section and somewhat difficult for the student to understand. 140 subsection 4 of the Companies Act. What is 140 subsection 4? If you really want to have a good understanding of 140 subsection 4, first of all, you must be able to recollect what we discussed under section 139 subsection 2. There is a relationship between 140 subsection 4 and 139 subsection 2. First of all, I will try to explain the provisions of section 140 subsection 4 without referring to section 139 subsection 2. After completion of the discussion on 140 subsection 4, I will try to correlate these 2 sections. So let us first have a discussion only about the provisions that were contained under section 140 subsection 4. The actual heading of 140 subsection 4 is maybe like this. There is no heading at all in the Companies Act. If you go through the bare act, you won't find any headings in the Companies Act. These are all the headings that have been devised by us to ensure that we are able to remember them and to recollect them. That's it. Appointment of a person, appointment of an auditor other than the retiring auditor. Appointment of auditor other than the retiring auditor. Repeat, appointment of an auditor other than the retiring auditor. This can be better understandable with the help of an example. There is a company called as A Limited. A Limited, in its first annual general meeting, appointed Mr. X as their auditor. X is an individually practicing chartered accountant. He had to hold office up to 6th annual general meeting. Let us assume that X held office up to 6th annual general meeting. He completed his term of office. And let us also assume that for this company, rotation of auditors is not made applicable. For this company, rotation of auditors is not made applicable. So, let us assume, when for a company, rotation of auditors is not made applicable, then the same person can be reappointed as the auditor of the company for any number of times, yes or no. So, in the given example, A Limited is not getting attracted with the provisions of section 139 subsection 2. They appointed a person called as X in its first AGM. That auditor held office up to 6th annual general meeting. Now, is it possible for the company to reappoint the same person as their auditor? Is it possible for the company to reappoint the same person as its auditor in the 6th annual general meeting to held office till the conclusion of the 11th annual general meeting? Remember, for this company, dash is not made applicable. Rotation is not made applicable. I am repeating my question. I am expecting an answer from you. Is it possible for this company to reappoint Mr. X as their auditor in their 6th annual general meeting? Yes or no? Yes or no? Yes. Why? For this company, rotation is not made applicable. If rotation is made applicable to this company, since that auditor is an individual, since that auditor has already completed one term of 5 consecutive years, he cannot be reappointed as the auditor of the same company by following the provisions of section 139 subsection 2. I made it clear to you that for this company, dash is not applicable. Rotation is not applicable. So same person can be repeated or reappointed as the auditor of the same company for another term of 5 consecutive years. So certainly, in the given example, dash can reappoint dash to hold up to dash. A Limited can reappoint their existing auditor, Mr. X, to hold office till the conclusion of the 11th annual general meeting. However, the A Limited is having an intention to reappoint their auditor. The auditor is also having an intention to be reappointed. Both are having an intention. One is having an intention to reappoint, the other one is having an intention to be reappointed. But unfortunately, some of the shareholders of the company do not like to appoint the same person as the auditor. In other words, some of the shareholders of the company do not want to reappoint the auditor. So, a shareholder of the company, of course, how many shareholders must have to give a notice? Special notice is given to you 1/10. Having a minimum capital of 5 lakhs can give a special notice. So I don't want to go into the details of the provisions of the Companies Act. One of the so company is having an intention to continue with Mr. X. The company wants to reappoint Mr. X as its auditor in the coming 6th annual general meeting. Meanwhile, one of the shareholders of the company has given a special notice to the company. One of the shareholders of the company has given a special notice to the company. In that special notice, the shareholder made a request. In that special notice, the shareholder made a request to the company that some other person must be appointed in place of the retiring auditor. Who is the retiring auditor in the given example? X is the retiring auditor. He has to retire as the auditor of the company in the 6th AGM. If he is reappointed, he can continue. So in the given example, X is the retiring auditor. one of the shareholders of the company do not like to continue with the existing auditor. They want to appoint some other person. They want to appoint some other person in place of the retiring auditor. Let us assume that shareholder wants to appoint Mr. Y as the auditor of the company. They don't want to continue with the existing auditor. They want to appoint a new auditor called as Y. Or shareholder can make a request to the company not to reappoint the retiring auditor. These two are different, but they mean one and the same. Either of these two requests may be made. Either of these two requests may be made by a shareholder to the company by giving dash to the company. A shareholder may give a special notice to the company. Generally, notice is a term that is applicable to the company. When the company holds any meeting, either board meeting or meetings of shareholders like AGM or EGM, notice is required to be served by the company on the shareholders. This is a reverse case wherein shareholder is expected to serve a notice on the company. That notice to be given by the shareholder to the company must be a special notice. Must be a special notice. In that notice, shareholder may either request the company to appoint some other person, in place of the retiring auditor. Let us assume that I am the retiring auditor. She is the shareholder and she made a proposal to the company. She requested the company to appoint Mr. Y as the auditor of the company in place of Mr. X. Or else you could request the company not to reappoint the existing auditor. You can make either of these two requests. You may ask the company to appoint somebody else in place of the retiring auditor, or else you could ask the company not to reappoint the retiring auditor. In both the cases, the effect is one and the same. Yes or no? If the company appoints some other person in my place, I cannot continue to be the auditor. If the company decides not to reappoint me, I cannot be reappointed as the auditor. Ultimate point is I cannot be reappointed as the auditor. That is the opinion of whom? Shareholder. Now, if any shareholder of the company wants to appoint some other person in place of the retiring auditor, or where the shareholder of the company do not want to reappoint the auditor, then the shareholder had to give a special notice to the company requesting the company to appoint some other person in place of the retiring auditor, or not to reappoint the retiring auditor. After receipt of such a special notice, I am the existing auditor. My name is X. I am the retiring auditor also. I am the existing auditor. I am going to retire from my office by the conclusion of the 6th annual general meeting. So X in the given example is called as retiring auditor. The proposed auditor is Y. So a shareholder wants to appoint Y in place of the retiring auditor Mr. X. Therefore, shareholder has given a special notice to the company requesting the company to appoint some other person in place of the retiring auditor. Now what the company should do? The company has to do two things after receipt of such special notice. First one is the company should intimate about receipt of such special notice to all other shareholders. Dear shareholders, some of the shareholders have given us a notice asking us to appoint some other person in place of the retiring auditor. This is for your intimation. That should be intimated by the company to all other shareholders, and that should also be intimated by the company to the retiring auditor. Sorry sir, we have received a special notice from some of our shareholders. In that notice, they requested us to appoint some other person in your place. This is the content of the special notice that we received from the shareholder. So the company had to send an intimation both to dash as well as to dash about receipt of such special notice, both to the shareholders as well as to the retiring auditor. After receipt of such a notice from the company, the retiring auditor came to know that some of the shareholders of the company wants to appoint some other person in his place. In that case, retiring auditor has been given a right. Retiring auditor has been given a right to make a written representation. retiring auditor has been given a right to make a written representation in this behalf, not exceeding a reasonable length. Not exceeding a reasonable length. So, retiring auditor has been given a right to make a written representation. That means the company is giving an opportunity to the retiring auditor to be heard. Yes or no? Right. So, retiring auditor has been given a right to make a written representation in this behalf. In this behalf means now retiring auditor came to know that some of the shareholders of the company wants to appoint some other person in his place. In that case, retiring auditor should be given an opportunity of being heard. That is the reason why Companies Act has given a right to the retiring auditor to make a written representation in this behalf, not exceeding a reasonable length. Once the retiring auditor makes a written representation, then the retiring auditor may send this representation to the company, asking the company to circulate the copies of such written representation to all the shareholders, along with the notice of annual general meeting. In the given example, the annual general meeting going to be conducted by the company is 6th annual general meeting. To hold AGM, the company should have to give a notice. Along with that notice, the company is under obligation to attach copy of written representation. So once the retiring auditor makes a written representation, it becomes a duty on the part of the company to circulate the copies of such written representation to all the shareholders along with the notice of annual general meeting. Sometimes the retiring auditor may have made this written representation, but by the time he made and sent this written representation to the company would have already circulated the notices of AGM to the shareholders. In that case, what is the right given to the retiring auditor? The retiring auditor may ask the company to read the representation before shareholders in the AGM. To read the representation before the shareholders in the AGM. Are you following my discussion or not? So where any shareholder of the company wants to appoint some other person in place of the retiring auditor, or where any shareholder of the company do not want to reappoint the retiring auditor, such a shareholder had to give a special notice to the company, requesting the company either to appoint some other person in place of the retiring auditor or not to reappoint the retiring auditor. After receipt of such a special notice, the company is having two responsibilities. One, the company should circulate copies of such special notice to all other shareholders. Two, the company should also send a copy of the special notice to the retiring auditor. After receipt of such a copy of the special notice from the company, the retiring auditor is having a right to make a written representation in this behalf, not exceeding a reasonable length. Once the retiring auditor makes a written representation, the retiring auditor may send the representation to the company, asking the company to circulate copies of the written representation to all the shareholders along with the notice of annual general meeting. In that case, the company is bound to send copies of such written representation to all the shareholders along with the notice. But unfortunately, by the time the retiring auditor made a written representation, the company had already sent notices of AGM to the shareholders. In that case, the retiring auditor has a right to ask the company to read the representation before the shareholders in the annual general meeting. Then the company is under obligation to read the written representation made by the retiring auditor before the shareholders in the annual general meeting. Assume that the retiring auditor made a written representation. Assume that retiring auditor made a request to the company asked the company to circulate copies of such written representation to the shareholders. But by going through the written representation, the company is of the opinion that the retiring auditor had misused his power of making written representation. The feeling of the company, by going through the written representation given by the retiring auditor, the company felt that the retiring auditor had misused his power of making written representation, or had used his power in a derogatory manner to get needless publicity. The written representation is purely a publicity stunt. No facts are there. This is the feeling of the company. So company do not want to circulate the copies of the written representation to the shareholders. On one hand, the auditor is asking the company to circulate his written representation to all the shareholders. On the other hand, the company is of the opinion that the retiring auditor had misused his power of making written representation, or has used his power in a derogatory manner to get needless publicity. In that case, what the company could do? The company can make an application to the tribunal. In this discussion, there are several parties. Have you observed that? I am the retiring auditor, X. He is the proposed auditor, Y. She is the shareholder who has given a notice to the company. She is the company. You are all the shareholders of the company. Now, she is a company law tribunal. The company do not want to circulate copies of written representations to the shareholders because the company is of the opinion that the retiring auditor had abused or misused his power of making a written representation. Therefore, the company makes an application to the tribunal. The tribunal is also of the opinion that, yes, what you said is correct. The retiring auditor had misused his power of making written representation. Therefore, it is not necessary for you to circulate copies of written representation to the shareholders. This may be a direction given by dash to dash. This may be a direction given by dash to dash, given by tribunal to the company. In that case, company is not under obligation to circulate copies of written representation to the shareholders. This is what is mentioned under section 140 subsection 4. There are few more points left under this discussion. While explaining 140 subsection 4, I said to you initially that let us assume that for this company, dash is not made applicable. Rotation of auditor is not made applicable. Now let us assume that for a company, rotation is made applicable. For a company, rotation is made applicable. That company appointed Mr. X, an individually practicing chartered accountants, as its auditor in the first annual general meeting. Now he held office up to 6th annual general meeting. The question is it possible for this company? Is it possible for this company where dash is made applicable to it, where rotation is made applicable to it, to reappoint the same person as its auditor? Can the company reappoint Mr. X as its auditor to hold office from 6th AGM to 11th AGM? Yes or no? Why? For the company, rotation is made applicable. He is an individual. An individual can hold office only for one term of 5 consecutive years. He had already held office for one term of 5 consecutive years. Therefore, he cannot be reappointed as the auditor of the same company for a period of another 5 years, which is being called by as a cooling period. So, in the given case, there is no possibility for the company to reappoint Mr. X as their auditor. Therefore, the company wants to appoint Mr. Y as its auditor in place of dash. In place of X. Now X started arguing that since the company wanted to appoint some other person in his place, the company had to follow the requirements of section 140 subsection 4. Is he right in his contention? Is it necessary for the company to follow all the procedures that we discussed till now to appoint Y in place of X? No. Why? Why? Because company cannot reappoint X. Company had to appoint some other person. It is a mandatory requirement. In that case, there is no need on the part of the company to follow the procedures that were mentioned till now under section 140 subsection 4. Followed or not? Now, for a company dash is made applicable. 139 subsection 2 is made applicable. The company appointed XY and Co. a partnership firm as their auditor in its first annual general meeting. They held office up to 6th AGM. In the 6th AGM, they were reappointed as the auditors. They held office up to 11th AGM. Now, is it possible for the company to appoint the same firm as its auditor in the 11th AGM? Yes or no? Why? The firm completed 2 terms of 5 consecutive years. So, they cannot be reappointed. So, company had to appoint some other individual or some other firm in place of dash. In place of XY and Co. In that case, is it necessary for the company to follow the provisions of section 140 subsection 4? No, because it is mandatory on the part of the company to rotate the auditors. It is mandatory on the part of the company to appoint some other person mentioned by the act itself. Therefore, for that purpose, there is no need for the company to follow dash. 140 subsection 4. By this, what you need to understand is 140, the procedure that is given under section 140 subsection 4 of the Companies Act is required to be followed only by dash companies. Only by those companies for which rotation is not made applicable. If the company has appointed an individual and if that individual completed 1 term of 5 consecutive years, there is no need on the part of the company to follow the procedure under section 140 subsection 4. If the company appointed a firm as its auditor and if the firm completed 2 terms of 5 consecutive years, since they cannot be reappointed, the company is not required to follow the procedure mentioned under section 140 subsection 4. There is a unique case. XY company, a partnership firm, has been appointed as the auditor in its first AGM. They held office up to 6th AGM. Now they can be reappointed. Because they completed only 1 term of 5 consecutive years. They can be appointed as the auditor for another term of 5 consecutive years. However, the company do not want to reappoint them. The company do not want to reappoint XY company as their auditors from 6th AGM to 11th AGM. That means the company wants to appoint some other person. The company wants to appoint some other person in place of the retiring auditor. In that case, should the company follow the provisions of section 140 subsection 4? Yes. So if an individual completed 1 term or if a firm completed 2 terms, there is no need to follow 140 subsection 4. But in case of a firm where it completes only 1 term of 5 consecutive years, but the company do not want to reappoint the firm, company wants to appoint some other person in place of the retiring auditor, then the company had to follow what is mentioned under section 140 subsection 4. And the final point before giving a break. This is the meeting of the shareholders, the 6th annual general meeting, and she is the chairperson of the meeting. She started reading a proposed resolution. You need to vote either in favor of the resolution or against the resolution. After all, you are all the shareholders. You are the persons who can decide who should be the auditor of the company and who should not be the auditor of the company. The chairman started reading the proposed resolution like this. It is proposed to appoint Mr. Y. It is proposed to appoint Mr. Y as the auditor of our company in place of the retiring auditor, Mr. X. What do you say? It is proposed to appoint Mr. Y as the auditor of our company at a remuneration of so and so in place of the retiring auditor, Mr. X. What do you say? Either you need to say yes or you need to say no. But you know very well about the provisions of the Companies Act. According to the provisions of the Companies Act, voting is to be done initially by show of hands. So you need to show your hands. You need to raise your hands if you want to appoint some other person in place of the retiring auditor. Don't try to raise both the hands. You need to raise only one hand, because in a show of hands, in a voting through show of hands, one shareholder is having only one vote, not two votes. So there are let us assume that there are 100 shareholders. There are 100 shareholders. Out of 100, 51 shareholders raised their hands in support of the proposed resolution. No. Out of 100 shareholders, 99 shareholders raised their hands in support of the proposed resolution. Now what happens? The proposed resolution is passed. The proposed resolution is passed. When the proposed resolution is passed, X is removed as the auditor of the company, and Y is appointed in his place. Now X is not the auditor of the company, Y is the auditor of the company. This happens when dash is passed. I am not saying that resolution either as an ordinary resolution or as a special resolution, because that point was not covered under 140 subsection 4. It was covered under section 139 subsection 9. Therefore, the next section that I am going to discuss after completion of 140 subsection 4 is 139 subsection 9. 139 subsection 9 says that to appoint some other person in place of the retiring auditor, company had to follow a special resolution. That point was not mentioned in 140 subsection 4. It was mentioned under section 139 subsection 9. That is the reason why I said that out of 100, 99 has voted in favor of the proposal. Right? Situation number 2. Chairman read the proposed resolution. It is proposed to appoint Mr. X, Mr. Y as the auditor of the company in place of Mr. X. And only one person raised her hand. You are the only person who raised the hand, because you are the person who made an application to the company requesting the company to appoint some other person in place of the retiring auditor. Therefore, out of 100 shareholders, only one shareholder is in acceptance of that proposal. Every other shareholder rejected the proposal. Now, in the given case, it is said that the proposed resolution is not passed. What is the difference between point number 1 and point number 2? In point number 1, the proposed resolution is passed. Therefore, Y is appointed as the auditor, X is to be removed as the auditor of the company. X has to vacate his office. In case of second situation, the proposed resolution is not passed. That means Y cannot be appointed as the auditor. Then X started arguing like this. Since Y is not the auditor of the company, I will continue to be the auditor of the company. My appointment as the auditor of the company is automatic. No. For that, the company had to pass an ordinary resolution. For my continuation, for why I am being continued? Because dash is not passed. Proposed resolution is not passed. Therefore, I can continue to be the auditor, for which the company is required to pass an ordinary resolution. Even if it is not passed, I will continue to be the auditor. That I will explain you under section 139 subsection 10. Okay, done. The last one. ఇంకో 10 సార్లు అనే లోపల అయిపోతుంది చెప్పటం. లాస్ట్ వన్. ది చైర్మన్ స్టార్టెడ్ expressing the proposed resolution. It is proposed to appoint Mr. Y as the auditor of our company at a remuneration of so and so in place of. The chairman has not completed the proposed resolution. Meanwhile, company secretary came to the chairman and stated that the proposed auditor died in a plane crash. The proposed auditor died in a plane crash. when the proposed auditor Mr. Y died in a plane crash, is it possible for the company to continue with the proposed resolution? No. So the proposed resolution has not been proceeded with. The proposed resolution has not been proceeded with due to death, incapacity or disqualification of that other person. Now the existing auditor started arguing that since the proposed auditor died, I will be the auditor of the company. No doubt I can be continued as the auditor of the company provided an ordinary resolution is passed. That's it. This is the end of the discussion on section 140 subsection 4. Generally speaking, the auditor of the company is entitled to get his remuneration only after completion of the entire audit assignment as well as after submission of auditor's report. I repeat, auditor is entitled to get his remuneration only after completion of the entire audit assignment and after submission of the auditor's report. However, sometimes in the resolution appointing the auditor, it may be mentioned by the company that the auditor can recover his remuneration on a progressive basis. Sometimes it may be mentioned in the resolution appointing the auditor that the auditor can recover his fees on a progressive basis. What is meant by progressive basis? As and when certain part of the work is completed, fees or remuneration relatable to that part of the work which is completed can be taken by the auditor. That is called as recovery of fees on a progressive basis. This is a rule and this is an exception to that rule. What is the rule? Generally, auditor is entitled to get his remuneration from the company only after completion of the entire audit assignment and after submission of the auditor's report. That is the rule. However, sometimes the resolution appointing the auditor may specifically mention that the auditor can recover his fees on a progressive basis. That is, as and when certain part of the work is completed, the fees relatable to that part of the work can be recovered by the auditor. That is called as recovery of fees on a progressive basis. When resolution so specifies, in other words, when the terms of appointment so specifies, obviously terms of appointment will be there in the resolution. So when the terms of appointment so specifies, an auditor can recover his fees on a progressive basis. If anybody of you is not having an idea about what exactly is the recovery of fees on a progressive basis, I will try to provide you an example. Listen to the example carefully. There is a company called as A Limited. The company is having a head office and the company is also having two branches, that is branch 1 and branch 2. You have been appointed not only as the auditor of head office of A Limited, but also the auditors of branch 1 and branch 2 at a total remuneration of 18 lakh rupees. At a total remuneration of 18 lakh rupees, 6 lakhs for conducting audit of head office and 6 lakhs each for conducting audit of branch 1 and branch 2. The total remuneration payable by the company to the auditor is 18 lakh rupees. Let us assume that in the resolution appointing the auditor, it was clearly mentioned by A Limited that the auditor can recover his fees on a progressive basis. That is, as and when certain part of the work is completed, the auditor can recover fees relating to that part of the work. Assume that the auditor started conducting audit of branch 1. It has been completed. Since some part of the work is completed, since resolution allowed the auditor to recover fees on a progressive basis, the auditor recovered this amount of 6 lakh rupees from the company being audited by him. After recovery of this amount of 6 lakhs by the auditor from the company, one of the shareholders of the company had raised an objection to this. The shareholder says like this: generally, auditor is entitled to get his remuneration only after completion of the entire audit assignment. in the given case, the entire audit is not yet completed. Auditor completed only audit of branch 1 but recovered fees amounting to 6 lakhs. Therefore, that amount of 6 lakh rupees shall not be considered as fees, but it should be considered as a loan taken by the auditor from the company. This is the contention of the shareholder. What the shareholder is saying, since the entire audit is not yet completed, but the auditor has recovered some amount, it should be considered as a loan. And hence, it is said that now the auditor is indebted to the company for an amount exceeding 5 lakhs. Therefore, the auditor gets attracted with the disqualification specified under section 141, subsection 3, class D, subclass 2. And since this disqualification occurs after appointment, the auditor need to vacate office immediately as per section 141 subsection 4, and there arise a casual vacancy which shall have to be filled up in accordance with the provisions of section 139 subsection 8. This is the contention of the shareholder. Do you agree with the contention of the shareholder? The simple answer is no. Why? Why? Because it has been allowed. The company itself allowed the auditor to recover their fees on a progressive basis. That is, as and when certain part of the work is completed. In fact, that condition has been clearly written by the company in the resolution also. Therefore, in the given case, since the auditor is permitted to recover his fees on a progressive basis, since the auditor completed some portion of the work and recovered the fees relating to that portion of the work, it is said that the auditor is not indebted to the company. Hence, it is said that there is no casual vacancy at all. The auditor can continue to hold the office of the auditor. The auditor can complete audit of head office as well as branch office and can recover such fees on a progressive basis. This is all about recovery of fees on a progressive basis. In fact, we had a discussion about 4 points under section 142. Point number 1. The term auditor's remuneration not only includes fees payable to the auditor, but it also includes any expenditure reimbursed by the company to the auditor or any facility extended by the company to the auditor. Point number 2, remuneration of the auditor shall be fixed by the company in its general meeting or as determined by the company in its general meeting. Point number 3, there is no rule that auditor's remuneration shall have to be fixed in the same meeting in which the auditor is appointed. It may be fixed either in the same meeting in which the auditor is appointed or it may be fixed in a different meeting. Merely because the remuneration of the auditor has been fixed in a different meeting, you cannot deem that appointment as an invalid appointment. Still the appointment is valid. And point number 4, usually auditor can recover his fees only after completion of the entire audit assignment and after submission of the auditor's report. However, where the terms of appointment so specifies, that means if the appointment letter or the resolution appointing the auditor mentions that the auditor can recover his fees on a progressive basis, that is, as and when certain part of the work is completed, the auditor can certainly recover his fees on a progressive basis. Nothing wrong in that. And in that case, auditor cannot be considered as indebted to the company for an amount exceeding 5 lakh rupees. This is the end of the discussion on section 142. Now, there is a related point which is to be discussed, which was left from our discussion previously, that is right of auditor's lien. Right of lien. While explaining you the rights of the auditor, I explained only 4 rights relating to the auditor. 2 rights were given under section 143 subsection 1. One right is given under section 146 and another right is given under section 143 subsection 8. What are the rights given to the auditor under 143 subsection 1? Right to access to books, right to obtain information and explanations. What is the right given under 146 of the Companies Act? Right to receive the notices of the meetings of the shareholders and to attend such meetings. What is the right given under section 143 subsection 8? If somebody else has been appointed as the branch auditor and if you were the head office auditor will always have a right to visit the branch, right to verify the books and other related records maintained therein, right to obtain information and explanations either from the company, either from the branch or from any officer of the branch. this right is given to the head office auditor, particularly when a person other than head office auditor has been appointed as the branch auditor under section 143 subsection 8. At that time, I said to you that there is another right given to the auditor of the company. That right given to the auditor of the company is a general right. There is no specific section which mentions about that right available to the auditor. That right is right of lien. What is right of lien? You know very well that lien means withholding a property, one's property, for non-payment of fees. Withholding one's property for non-payment of fees. In the given case, say you were appointed as the auditor of A Limited. You completed your audit. You submitted your report. Since the audit is completed, report is submitted. Now the auditor is entitled to get his remuneration from the company. Auditor in fact submitted a bill to the company, asking the company to make the payment of auditor's remuneration. Unfortunately, the company failed to make the payment of auditor's remuneration. In that case, the auditor is entitled to get remuneration, but the company failed to make the payment of remuneration to the auditor. In order to recover such fees, what is the right given to the auditor? That right given to the auditor, which is a general right, is right of lien. In other words, until the company makes payment of fees to the auditor, there is no need on the part of the company to return the books and other related records of the company. The auditor can retain the books and other related records of the company in his possession, since the company made the payment of fees to the auditor. But in fact, in reality, exercising right of lien is not as that much easy as it is appearing. By listening to this, now you may be able to understand that, okay, if we conduct audit, we submit our report, we are entitled to get our remuneration. Unfortunately, the company may fail to make the payment of remuneration. In that case, we can retain the books and other related records of the company till the company made the payment of auditor's remuneration. But practically, this is not easy for the auditor. Why? Why? Because for the reasons already explained to you, company A Limited is having its registered office in Hyderabad, and the auditor's location is Guntur. Now, the auditor asked company to provide all the books and other related records, to send all the books and other related records to the auditor's office so that auditor can conduct and conclude the audit. The company said that, sorry sir, we are a company form of organization. We need to maintain our books at the registered office. Since the registered office of the company is in Hyderabad, please come to Hyderabad. We will provide you facilities for the purpose of your stay and for the purpose of conducting audit at Hyderabad. Later, the auditor went to Hyderabad, completed audit, submitted his report, came back to Guntur, made a bill on the company, but the company failed to make the payment of fees to the auditor. In that case, what the auditor could do, the only option available for the auditor when the company fails to make the payment of auditor's remuneration is to withhold the property of the company in the form of books and other related records. Unfortunately, in the given example, the auditor is not having any books and other related records of the company with him, because all the books are held by the company at its registered office. You went there, you carried out audit, you come back to your original place, but you are not holding any books of account of the company. When the auditor is not having in possession of the books of account of the company, how it is possible for the auditor to exercise right of lien? Right of lien is nothing but withholding one's property. Property is not with you. When the property is not with you, how do you withhold it? So practically, it is quite difficult for the auditor to withhold the books and other related records of the company when the company fails to make the payment of auditor's remuneration. So this is only a right which is given on paper, which cannot be exercised by the auditor generally. And more importantly, where the auditor wants to exercise right of lien, some conditions were attached for exercising the right of lien, and all such conditions are required to be complied with by the auditor when the auditor wants to exercise right of lien. I repeat, if you were the auditor, if you want to exercise right of lien, then you must have to comply with all the following 4 conditions. Only after complying with these 4 conditions, the auditor can exercise right of lien. Condition number 1, 2 are very simple to understand. Some fees should be due. Some fees should be due to the auditor in respect of the work carried out by him. That is condition number 1, without which you cannot exercise right of lien. So precondition for exercising right of lien is that some fees must be due from dash to dash. Some fees must be due from the company to the auditor on which the auditor worked. That is point number 1 or condition number 1. Condition number 2, such right of lien can be exercised by the auditor only in respect of books and other related records on which the auditor has carried out some work. Only on those books of account on which the auditor has carried some work. Condition number 3, those books on which the auditor wants to exercise right of lien should have come to the possession of the auditor, only through legal means, only through legal means and not through illegal means. This point is very, very crucial for you. So be careful while listening to it. What is point number 3? What is first condition? Some fees must be due from the company. What is second condition? Some work should have been carried out by the auditor on such books of account or documents on which the auditor wants to exercise right of lien. Condition number 3, such books on which the auditor wants to exercise right of lien should come to the possession of the auditor only through legal means and not through illegal means. What is meant by legal means? The board of directors of the company could have passed a resolution specifying that they are moving their books out of their registered office. A copy of the same could have been filed by the board of directors with ROC, and if books are moved later, then it is said that the books have been legally moved from registered office of the company to the auditor's office. In such case, the books will be in the possession of the auditor. So when the books are in the possession of the auditor and such books have been received by the auditor through legal means, then the auditor can exercise right of lien on those books on which have come to the possession of the auditor legally. In other words, any other means through which the auditor can obtain books is illegal. So only the legal point is that board of directors of the company should have passed a resolution. A copy of the resolution should have been filed with ROC. Then the company would have given the possession of the books and other related records to the auditor. That is called as legal way of getting books and other related records. You can exercise your right of lien only on those books which have come to your possession through legal means and not through illegal means. And the last one is such lien can be exercised only on the books of account of the company which fails to make the payment of fees to the auditor. It cannot be exercised by the auditor on the books of account of others like directors of the company, like promoter, etc. This point is very difficult to understand. Please try to understand this point with the help of an example. You have been appointed as the auditor of A Limited. You conducted audit, completed audit, submitted the report of A Limited, audit report of A Limited. A Limited failed to make the payment of fees to the auditor. There is a director in A Limited. The name of the director is B. Apart from being a director in A Limited, B is having a sole proprietary business for which you were the auditor. So in the given case, assume that Mr. X, a chartered accountant in practice, has been appointed as the auditor of A Limited. He conducted audit, he completed audit, submitted the report. A Limited failed to make the payment of remuneration to the auditor. Unfortunately, the books and other related records are with the company only. They are not with the auditor. If they were with the auditor could have exercised right of lien. But because they were with the company, the auditor is unable to exercise right of lien. There is a person called as B. That B is acting as a director in A Limited. B is having a sole proprietary business for which the same person is the auditor. So X is the auditor not only for A Limited but also the auditor of a sole proprietary business of B, a director of A Limited. X asks B to send books and other related records to his office. Since B is carrying out only a sole proprietary business, since there is no condition with regard to moving books from B's place, B has provided all the books and other related records in X's office. Now X started saying like this: since the company in which you are acting as a director, since the company in which you are acting as a director fails to make the payment of remuneration to me, I want to exercise right of lien on the books of account of the sole proprietary concern. The sole proprietary concern. Who is the proprietor of the proprietary concern? B. Who is B? Who is B? B is already acting as a director. So instead of exercising right of lien on the books of account of A Limited, the auditor wants to exercise right of lien on the books of account of the director of the company. Is it possible or not? It is not at all possible. These four are the conditions that are required to be complied with by the auditor when the auditor wants to exercise right of lien. Can you please list down those four conditions? If you are able to repeat them, over, it's over. What are the conditions that are required to be fulfilled by the auditor or that are required to be complied with by the auditor whenever the auditor wants to exercise right of lien? 1. Some fees must be due from the company to the auditor. 2. Some work must have been done by the auditor on such books of account and other related records on which the auditor wants to exercise right of lien. Condition number 3. Such books should have come to the possession of the auditor only through legal means and not through illegal means. Condition number 4. The auditor can exercise right of lien only on those books of account of the company which fail to make the payment of remuneration to the auditor, not on the others books like books of account of the directors of the company, promoters of the company, etc. If these four conditions are satisfied, as an auditor, you can exercise right of lien. That means you can withhold the books, other related records, including any other document relating to the company till the company makes the payment of fees to you. This is all about section 128 of the Companies Act, right of lien. By this you can say that there are five rights given to the auditors of the company. 1. Right to access. 2. Right to obtain information explanations. 3. Right to receive notice. 4. Right to visit branch. And the 5th one is right of exercising lien. By this I completed discussion on right of lien also. Now let us focus on section 138 first. Later on, I will try to discuss section 148. And I am sure before break, I am going to explain you both 138 as well as 148. Let us put a target like that so that we would be able to complete 138 and 148 even before the break. What is 138? This is very well known to you. First of all, I will try to explain you the objectives behind appointment of an internal auditor. Objectives behind appointment of internal auditor. These are very, very important, and I suggest you to remember these objectives throughout the period of your coaching, because in several places these objectives will be repeated in future. Every time I don't want to explain the objectives in detail. Therefore, this is the first and last time I am going to have a detailed discussion on the objectives behind appointment of an internal auditor. Section 138 of the Companies Act contains provisions. Section 138 of the Companies Act contains provisions relating to appointment of internal auditors. Relating to appointment of internal auditors. You know very well that auditors of a company can be classified broadly into two categories. The first one is external auditor. The second one is internal auditor. Usually, this external auditor is nothing but the statutory auditor, otherwise called as company auditor. Statutory auditor or company auditor is external to the company, and hence they are technically called as external auditors. So concept relating to external audit is well known to you. In fact, we had a discussion about the way in which external auditors are required to be appointed till now under 139 subsection 7, 5, 6 and 1. And the next type of auditors is internal auditors. Who is an internal auditor? and most importantly, what are the objectives with which an internal auditor is to be appointed. If you fail to understand the objectives, you will fail to understand the difference between an external auditor and an internal auditor. Therefore, you will also fail to understand SA 610 in future. SA 610 in future. So this discussion is having a link with a standard on auditing, SA 610, using the work of an internal auditor. The name of SA 610 is using the work of an internal auditor. Unless you understand who is internal auditor, it is quite impossible for you to understand the importance of SA 610. So what are the objectives behind appointment of internal auditors? It is point number 1 is very difficult to understand. Be careful. You know very well that if you want to take a decision,
Recording
you need
in
some
progress.
information. Yes or no? If you want to take any decision, you need some. కొంచెం సౌండ్ సెట్టింగ్ కూడా ఏదో కొంచెం ఒకటేదో తేడా ఉంది, మాట క్లియర్గా రావట్లా. సో if you want to take any decision, you need some information. If you want to take any decision, in order to take decision, you need some information. Without information, it is quite difficult for you to take a decision. In fact, this has been proved even while I am giving you a lecture relating to introduction of auditing, wherein I said that you are a prospective investor. You are a prospective investor. You are having a surplus money of 1 lakh rupees. With this surplus money, you want to purchase some shares in a company. You haven't decided about the company in which shares are required to be purchased. Therefore, initially you have selected 4 companies and you started obtaining information relating to those 4 companies, like what is the year of establishment of the company, what is the line of business of the company, who are the directors of the company, what are their qualifications, what is their experience, whether the company is getting profits or suffering with losses, whether the company has declared any dividend in the past, whether the company has given any bonus shares in the past. All this information is required by you for taking a decision about whether to invest in the shares of the company or not to invest in the shares of the company. At least by now you should be able to understand that if you want to take a decision, you need some information, and correctness or otherwise of a decision taken by you is purely dependent upon the correctness or otherwise of the information that you make use of for taking such a decision. If information used by you is accurate, valid and reliable, I repeat, if information used by you is accurate, valid and reliable, then obviously the decision taken by you may prove to be correct. If information used by you for the purpose of taking a decision is inaccurate, invalid or unreliable, then obviously the decision taken by you would also prove to be false. So simply speaking, whether the decisions taken by you are right or wrong is purely dependent upon the information, that is being used by you. So before taking any decision, any person should first of all try to check. Before taking any decision, you need to use some information. Before using information, you need to check whether that information to be used by you is accurate, valid and reliable. If it is accurate, valid and reliable, then only decisions made by you will prove to be appropriate. Otherwise, your decisions will prove to be inappropriate or wrong. Now coming to the point, management will make several decisions. During the course of performance of the business, management will try to take different types of decisions. In order to take decisions by management need some information. In other words, in order to take decisions, management make use of some information. If the information that is being used by the management for the purpose of taking different types of decisions is accurate, valid and reliable, then the decisions taken by the management would prove to be correct. If information itself is wrong, decisions taken by the management would also prove to be wrong. So if you were the management, if you want to make use of any information for the purpose of taking decisions, what should you do? What you are expected to do? Before making use of any information, it is necessary for the management to check dash and dash and dash of dash, to check the accuracy, validity and reliability of information. Management may be competent to do that, but management may not have adequate time to do that. Because of lack of time available to the management, although management knows very well that correctness or otherwise of the decisions to be taken by them would depend upon the correctness or otherwise of information, although management knows that they need to check the accuracy, validity and reliability of information before making use of it for the purpose of their decision making. Since management is not having adequate time to do all these things, it may be quite difficult for them to check the accuracy, validity and reliability. Therefore, generally this task of checking the accuracy, validity and reliability of information may be delegated by the management to a person called as internal auditor. So if you were appointed as an internal auditor, what is your main duty? If you were appointed as an internal auditor of a company, what is your main duty? You need to check the accuracy, validity and reliability of information that is going to be used by management for the purpose of making different types of decisions. You need to provide an assurance. Being an internal auditor, you need to provide an assurance to dash. Being an internal auditor, you need to provide assurance to dash to the management. About what? About the accuracy, validity and reliability of information. That is the basic reason why internal auditors are appointed. If you are still confused to understand this point, I'll give you an example. Supposing that there is a company called as A Limited. Just now, the accounts department of the company prepared a draft set of financial statements. Just now, the accounts department of the company has prepared a draft set of financial statements. The financial statements were not yet audited. But before audit, A Limited, the company or the management of the company wants to make use of such a draft set of financial statements for the purpose of taking some key managerial decisions. The wording is very important. You should be careful. There is a company called as A Limited. A Limited is having an accounts department. Accounts department just now prepared a draft set of financial statements. Management of A Limited wants to make use of draft set of financial statements for the purpose of taking some key managerial decisions. Before making decisions, they need to check the accuracy, validity and reliability of information. What information is going to be used by the management for the purpose of taking decisions? Financial statements is the information that is being used by the management for the purpose of taking decisions. So before using financial statements, what the management should do? The management should try to verify the accuracy, validity and reliability of such a draft set of financial statements. That management could not do because of lack of time. Hence, A Limited appointed you as its internal auditor. If you were the internal auditor of A Limited, now what is your duty? You need to thoroughly check dash prepared by dash. You need to thoroughly check dash prepared by dash. The draft financial statements prepared by the accounts department of A Limited. By checking the draft financial statements thoroughly, you need to provide an assurance. Internal auditor is required to provide an assurance to the top level management that the data, the internal auditor should provide an assurance to the top level management that the data on which management is relying upon, the data on which management is relying upon to take key managerial decisions, to take key managerial decisions is accurate, valid, and reliable. That is what you are expected. So if you were the internal auditor, what is your main duty? You need to provide an assurance to the top level management that the data on which management is relying upon, to take key managerial decisions is accurate, valid, and reliable. How do you do that? This is a question for you. It's not for me, it's for you. If you were the internal auditor, what is your main duty? You need to check the accuracy, validity, and reliability. In the given example, what is your duty as an internal auditor? You need to check the accuracy, validity, and reliability of the draft set of financial statements prepared by the accounts department. If you were the internal auditor, if you are made responsible to verify the accuracy, validity, and reliability of the draft set of financial statements prepared by the accounts department, what will you do? And how will you give an assurance to the top level management? You know very well that the correctness or otherwise of financial statements would depend upon the correctness or otherwise of trial balance. The correctness or otherwise of trial balance would depend upon the correctness or otherwise of ledger. The correctness or otherwise of ledger would depend upon the correctness or otherwise of journal. That means even if you were the internal auditor, in order to check the correctness of draft financial statements, what should you do? You need to first of all focus on the correctness of journal. For that, you are required to carry out a technique called as watching. Then you need to verify whether entry in the journal has correctly been posted to ledger. That is called as posting. You need to perform castings, what not. Everything is required to be performed by the internal auditor, which is generally performed by the statutory auditor. So, I want to give you a statement. Please listen to the statement carefully. If you are able to understand it, I don't want to elaborate it. If you fail to understand, I will give an elaboration for that statement. The statement is very difficult and most important for you. The statement is like this. Although the objectives behind appointment of internal auditor and the statutory auditor are quite dissimilar in nature. The objective behind appointment of the statutory auditor is different. The objective behind appointment of the internal auditor is different. Objectives behind appointment of statutory auditor and internal auditor are dissimilar in nature. Although the objectives are dissimilar in nature, the means of achieving those objectives are quite similar in nature. Objectives behind appointment of the auditors may be different, but the way, the means, the procedures, the techniques that are followed by both the auditors, that is dash and dash, internal auditor and statutory auditors, are one and the same. Statutory auditors perform techniques like watching, posting, casting, etc. Internal auditors are also expected to perform the same techniques. That is the reason why I said to you that although the objectives behind appointment of statutory auditor and internal auditor are quite dissimilar in nature, the means of achieving those objectives are quite similar in nature. What is the basic objective behind appointment of the statutory auditor? Forming and expressing an opinion on the financial statements is the objective behind appointment of the statutory auditor. What is the objective with which internal auditor is appointed? To provide, not to form and express an opinion, but to provide an assurance to the top level management that the data on which management is relying upon to take key managerial decisions is accurate, valid, and reliable. Objectives may be different, but in order to achieve those objectives, the means followed by them, the ways followed by them, the process followed by them is one and the same. That means what is to be done by the statutory auditor would have already been done by dash. What is to be done by the statutory auditor would have already been done by dash, internal auditor. When there is an internal auditor, the procedures that you are expected to follow as a statutory auditor, the techniques that you are expected to follow as a statutory auditor would have already been followed by the internal auditor. When all the techniques and procedures that are required to be followed by the statutory auditor have already been followed by the internal auditor, there is nothing to repeat. Even if the statutory auditor repeats the same, it is a mere waste of time. That is the reason why the CA Institute says that most of the procedures, most of the techniques that are expected to be followed by the statutory auditor would have already been followed by the internal auditor. If the statutory auditor again wants to follow the same, it is nothing but a repetition of work. It is nothing but it results in loss of time. So instead of repeating the same work again and again, what the statutory auditor could do, instead of repeating the work, the statutory auditor may try to place reliance on the work performed by the internal auditor. If you try to rely on the work performed by the internal auditor, you can save some time, and the time thus saved by the statutory auditor can be used to focus on other important aspects of audit or other important areas of audit. Are you following my discussion or not? So what is the most important point here you need to understand? Although the objectives of statutory auditor and internal auditor are quite dissimilar in nature, the means of achieving those objectives are quite similar in nature. The procedures, the techniques, other things that are required to be followed by the statutory auditor would have already been followed by the internal auditor. If the statutory auditor repeats the same procedures that were already followed by the internal auditor, it is a mere waste of time. Instead of duplicating the work, you can save some time, and the time thus saved by you can be used for the purpose of focusing on some other important aspects of audit. In order to save the time, what the statutory auditor could do, the statutory auditor can try to place reliance on the work performed by the internal auditor. If you do that blindly, then for the faults done by the internal auditor, statutory auditor would be held responsible. For the faults done by the internal auditor, statutory auditor would be held responsible. That is the reason why, no doubt, being a statutory auditor, you can place reliance on the work performed by the internal auditor, not blindly. Then what the statutory auditor is expected to do when the statutory auditor wants to rely on the work performed by the internal auditor? You need to evaluate. Being a statutory auditor, you need to evaluate. Evaluate what? Statutory auditor is required to evaluate what? The work carried out by the internal auditor. And after evaluation of the work carried out by the internal auditor, if the statutory auditor finds it reliable, then the statutory auditor can place reliance on the work performed by the internal auditor. I repeat, statutory auditor cannot blindly rely on the work performed by the internal auditor. What happens when the statutory auditor relies blindly on the work performed by the internal auditor? Statutory auditor would be held responsible or liable even for the faults done by the internal auditor. That is the reason why you cannot place reliance on the work carried out by the internal auditor blindly. Then how to rely on the work performed by the internal auditor? If you really want to rely on the work of the internal auditor, you need to evaluate the work performed by the internal auditor. After evaluation of the work, if you satisfy that the internal auditor had performed his work well and with quality, you can safely rely on the work performed by the internal auditor. How do you know that? You need to evaluate the work of the internal auditor. How do you evaluate the work of the internal auditor? Some audit procedures that are required to be followed by the statutory auditor. Audit procedures that are required to be followed by the statutory auditor while evaluating the work carried out by the internal auditor. I repeat, audit procedures that are required to be followed by the statutory auditor when the statutory auditor is evaluating the work of the internal auditor have been given in a standard on auditing called SA 610. Therefore, if you were the statutory auditor, if you want to rely on the work of the internal auditor, first of all, you need to evaluate the work carried out by the internal auditor. How do you evaluate the work carried out by the internal auditor? By following, very good, by following audit procedures that were mentioned by the CA Institute in SA 610. So you need to follow the audit procedures that were given in SA 610. After following such audit procedures, you would be able to determine whether the work carried out by the internal auditor is reliable or not. Then you need to take a decision whether to rely on the work carried out by the internal auditor or not to rely on the work carried out by the internal auditor. There is no compulsion on your part to rely on the work of the internal auditor. It is at the discretion of the statutory auditor. The statutory auditor may decide to carry out the entire work independent of the internal auditor, or else the statutory auditor may decide to use the work of the internal auditor. Nowhere the CA Institute mentioned that it is an obligation on the part of the statutory auditor to rely on the work of the internal auditor. So you are not forced to rely on the work of the internal auditor. If you really want to rely on the work of the internal auditor, you can do that. Otherwise, you can carry out the entire work independent of the internal auditor. So when SA 610 will be made applicable? When SA 610 is made applicable, where you were appointed as the statutory auditor of an entity, and where there is an internal auditor to the entity, and where if you want to rely on the work performed by the internal auditor, you need to evaluate the work performed by the internal auditor. For evaluating the work performed by the internal auditor, you are expected to follow some audit procedures. The audit procedures that are required to be followed by the statutory auditor for evaluating the work of the internal auditor were given in SA 610. Therefore, you are required to follow SA 610. Then you need to decide whether to rely or not to rely. If you want to rely on the work of the internal auditor, do that. If you do not want to rely on the work of the internal auditor, perform everything independent of internal auditor. Repeat everything that has already been carried out by the internal auditor. The most important point is you are not forced to use the work of the internal auditor. It is not mandatory on your part to make use of the work of the internal auditor. It purely depends upon the discretion of the auditor, the professional judgment of the statutory auditor. If you want to make use of the work, you can do that. If you do not want to make use of the work, you can do that. It is up to you to decide.
Hello everyone, greetings of the day. Now you can purchase CA Inter-Auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA Inter-Auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA Inter-Auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have three exciting convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views, and the material will be couriered to you, and at the same time you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, for 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3,000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
Similar point has already been explained to you. when I am having a discussion on section 143 subsection 8, I refer to SA 600, yes or no? Now I am referring to SA 610, yes or no? What is the significance of SA 610? Can you please tell me what is the significance of SA 610? It is nothing but it deals with relying on the work of the internal auditor. SA 600 deals with what? Relying on the work or using the work of the other auditor. Using the work of other auditor, that is SA 600. Using the work of internal auditor, that is SA 610. Both are one and the same. The concept is one and the same. As the statutory auditor of the company, you are going to make use of the work of branch auditor under SA 600. As the statutory auditor of the company, you are going to make use of the work of the internal auditor, for which you are required to follow SA 610. In both the occasions, the work is not being performed by dash. Statutory auditor. Statutory auditor wants to rely on the work performed by some other person. In that case, you cannot do that blindly. If you do that blindly, you will be made responsible for the faults done by them. That is the reason why you need to evaluate the work. Then you have to decide whether to rely on the work of the branch auditor or not, whether to rely on the work of the internal auditor or not. If you want to rely on the work of the branch auditor or internal auditor, then you can do so. If you do not want to rely on the work of the branch auditor, you can visit the branch. If you do not want to rely on the work of the internal auditor, you can perform every activity independent of the internal auditor. Are you able to follow me or not? So SA 600 and SA 610 are related to one another. Both are required to be followed by you as an auditor whenever you want to rely on dash. Whenever the auditor wants to rely on the work performed by others. There are two more standards. If you are interested in listening this, I will try to explain those standards as well. SA 500. SA 500 contains a particular point called as using the work of an expert. Contains a particular point called as using the work of an expert. Sometimes while preparing financial statements. Sometimes while preparing financial statements, management may make use of the work of an expert. Who is an expert? An expert can be defined as a person having specialized skill, knowledge and experience in the fields other than accounting and auditing. I repeat the definition of expert. An expert can be defined as a person having specialized skill, knowledge and experience in the fields other than accounting and auditing. We auditors do have specialized skill, knowledge and experience in the fields of accounting and auditing. We cannot call ourselves as experts. Therefore, any person having a specialized skill, knowledge and experience in a field other than accounting and auditing will be called as an expert. Of cost auditor under section 148 subsection 2, the exceptions are if the company is operating under a special economic zone. If the company is operating in a special economic zone, then the company is not required to get their books of account audited by a cost accountant. But the company is under obligation to maintain cost accounting records. This exception is given only in respect of appointment of the cost auditor, not in respect of maintenance of cost accounting records. So there is a company which is operating under SCZ. The total turnover of the company is 100 crore rupees or more than 100 crores. And the turnover of table A and B is 35 crores or more. Generally speaking, the company is under obligation to appoint a cost auditor. But since the company is operating in a special economic zone, although the company satisfies those two conditions, it is not necessary for the company to appoint a cost auditor. But remember, it is an obligation on the part of the company to maintain cost account. They are expected to maintain, they are under obligation to maintain cost accounting records. They are not required to appoint their cost auditors because they are operating from dash. Special economic zone. And exception number 2 is if the revenue, if more than 75% of revenue, if more than 75% of the revenue is being generated by the company through exports, and that too in foreign currency. If you are making exports, you will receive the amount in foreign currency, and if the total of such export proceeds is more than 75% of the revenue generated by the company, then that company is not required to appoint a cost writer, but must be required to maintain cost accounting records. To elaborate it further, example, the company is having a turnover of 100 crores. Out of 100 crores, 76 crores is from export. 76 crores are export proceeds. Remaining 24 crores is sale made by the company indigenously. Indigenous sale. Out of 100 crores, local sales are 24 lakhs and sales, export sales are 76 lakhs. In the given case, it is said that more than 75% of the turnover of the company is from export proceeds, that too in foreign currency. Since the company is contributing to the development of the nation, such companies are exempted from the purview of cost audit. Such companies are not required to appoint cost auditors, but they are required to maintain cost accounting records. So what are the companies that were exempted from the cost audit? When the company is operating under a special economic zone where the revenue generated by the company is more than 75% of the total revenue in the form of export proceeds. And the third one is when the company is generating electricity. When the company is generating electricity and the electricity so generated by the company is being captively consumed. The electricity so generated by the company is being captively consumed. What is meant by captive consumption? The production made by you will be utilized by you only. It will not be sold to any other person. It will be used by you as raw material for some other thing. The company is generating electricity. The electricity so generated is being utilized by the company on its own for their production. It is not being sold. In that case, such companies which are generating electricity and which are using such electricity so generated captively. Captive consumption means consumption for own use. Then such companies are also not required to appoint a cost writer. This is about section 148 subsection 2 of the Companies Act. Now we are able to complete only two subsections of section 148. They are 148 subsection 1 and 148 subsection 2. Now let us focus on other important aspects of appointment of the cost writer. As already said to you, who should appoint the cost writer? Who should appoint the cost writer? Generally, appointment of auditors is a natural right given to the shareholders. But in case of appointment of cost writer, the natural right is given to the board of directors. In other words, board of directors of the company are under obligation to appoint a cost writer. It is the obligation on the part of the board of directors to appoint a cost writer. That is point number 1. And point number 2, who can be appointed? Who can be, of course, sometimes the company may be required. This point will be cleared in today's session itself. Sometimes a company may be required to maintain, to constitute a committee called as Audit Committee under section 177 of the Companies Act. I hope every one of you is having some knowledge about section 177. Section 177 of the Companies Act mandates that some companies which were covered under section 177 are required to establish or to constitute a committee called as Audit Committee. When the company is having an audit committee, that audit committee is made responsible for selection of auditors. The audit committee is made responsible for selection of auditors, and the auditors so selected shall be recommended. The auditors so selected shall be recommended by the audit committee to the board of directors. Later on, appointment of auditor will be done. I repeat, where the company is having where a company is having an audit committee, that audit committee is made responsible for selection of auditors. Auditors are required to be not appointed. Selection is different from appointment. Audit committee is made responsible for selecting the auditors. That auditor may be either the statutory auditor or even a cost auditor. So once there is a committee in the company called as audit committee, that audit committee is made responsible for selecting both the statutory auditors as well as the cost auditors. They are also made responsible to fix, to recommend remuneration, of such auditors selected by them. Once auditors are selected by audit committee, the audit committee will recommend the names of auditors so selected by them to the board of directors along with recommended amount of remuneration payable to them. Then the auditor's appointment will take place. If auditor appointment is to be done by the shareholders, it will be done by the shareholders. If the auditor's appointment can be done by the board of directors, it will be done by the board of directors. That means before appointment of the auditor, first of all, the company should receive a dash from dash. The company should receive a recommendation from audit committee. Audit committee is made responsible for selection of auditors and recommending the same to the board. They are also made responsible to recommend remuneration of the auditors so selected to the board of directors. They can only make a recommendation. They cannot appoint. After receipt of such recommendation from the audit committee, either the shareholders or the board of directors will appoint the auditors. For example, if recommendation is with reference to cost auditor, who should appoint the cost auditor? If recommendation has been received with respect to appointment of the cost auditor, who is made responsible to appoint the cost auditor? Board of directors. So on recommendation received from the audit committee, board of directors shall appoint the cost auditor. If auditor is required to be appointed by the shareholders, on recommendation received from the audit committee, shareholders will appoint the auditor. So giving a recommendation, selecting the auditors and giving a recommendation thereof is the responsibility of dash audit committee. As said earlier, all the companies are not required to constitute audit committee. This procedure is applicable only in respect of such companies for which establishment or constitution of audit committee is made mandatory. So this is briefly about audit committee. So who should appoint the cost auditors of a company? Board of directors on a recommendation received from dash. Received from audit committee, there be. Now, what are the qualifications similar to that of the company auditor? To be appointed as the cost auditor of a company, you must have qualifications and you should not suffer with any disqualifications. It is similar to that of appointment of the financial auditor. If you are to be appointed as the company's auditor, you must have qualifications and you should not suffer with any disqualifications. Then only it is said that you are eligible to be appointed as the auditor of a company. Similar to that, if you are required to be appointed as the cost auditor of a company, you must have qualifications. You should not suffer with any disqualifications. Then only you are eligible to be appointed as the cost auditor of a company. Now the question is, what are the qualifications required to become the cost auditor of the company? You must be a cost accountant within the meaning of ICWAI or ICMAI Act, and you must hold a valid certificate of practice. To be appointed as the financial auditor, you must be a chartered accountant and you must hold a valid certificate of practice. To be appointed as the cost auditor, you must be a cost accountant within the meaning of ICMA Act and you must hold a valid certificate of practice. That means only cost accountants in practice. Only cost accountants in practice can be appointed as the auditors of as the cost auditors of a company. None other than a cost accountant can be appointed as the cost auditor of a company. There was a teasing provision in the Erstwhile Companies Act, that is 1956 Act, which reads as follows: if sufficient number of cost accountants are not available, even a chartered accountant having prescribed qualifications can be appointed as the cost auditor. That was the provision which is there in 1956 Act. That means if sufficient number number of cost accountants are not available. Even a chartered accountant can be appointed as the cost writer of the company. But now it has been removed. Only cost accountant in practice can be appointed as the cost writer of the company. No other person can be appointed as the cost writer of the company. That is the only qualification required to become the cost writer of the company. Like in the case of financial writer, even in case of cost writer also, either an individual can be appointed as the cost writer or a partnership firm can be appointed as the cost writer. This is about the qualifications required to become the cost writer of a company. As already said to you, the cost writer should also not suffer with any disqualifications. The question is, what are the disqualifications with which a cost writer shall not suffer? The disqualifications that are made applicable to the company auditor under section 141 subsection 3 are made equally applicable even to the cost writer. That means disqualifications that are applicable to both dash and dash are one and the same. The financial auditor, otherwise called as statutory auditor, otherwise called as company auditor, and the cost auditor are one and the same. To be more precise, the following persons are disqualified from being appointed as the cost writers of a company: a body corporate other than LLP, an officer or employee of the company, a partner or employee of an officer or employee of the company, a person who is holding any security in the company, etc., a person who is indebted to the company for an amount exceeding 5 lakhs, a person who has given any guarantee or security in connection with indebtedness exceeding 1 lakh rupees, a person who is having a direct or indirect business relationship, a person whose relative is working either as a director or as a key managerial personnel. Everything that we discussed under section 141 subsection 3 under the heading disqualifications of the auditor is equally made applicable even in respect of cost auditor. So to be appointed as the cost writers of the company, you must have qualifications. At the same point of time, you should not suffer with any disqualifications. Then only you are eligible to be appointed as the cost writers of the company. This is about qualifications and disqualifications. There is an interesting point with regard to qualifications and disqualifications. I said to you about 141 subsection 4. That 141 subsection 4 is equally applicable even to the cost auditor. What is 141 subsection 4? According to that section, disqualification to the auditor may occur or may arise at any point of time. It may be either before appointment or after appointment. Actually, the term before appointment was not used in 141 subsection 4. For your clarity, I am saying like that. So, disqualification to the auditor may occur either before appointment or after appointment. If it is occurred before appointment, he cannot be appointed as the auditor. If it occurs after appointment, the appointed auditor shall be deemed to vacate his office immediately, and hence there will arise a vacancy in the office of the auditor called as casual vacancy. The same is applicable for the cost auditor also. That means at the time of appointment of the cost auditor, he may be having qualifications. He may not be suffering with any disqualifications. After his appointment as the cost auditor of the company, he may get attracted with some disqualifications. In that case, what will happen? What will happen in case of statutory auditor will also happen in the case of cost auditor. That means from that moment onwards, that person will not be considered as the cost auditor of the company. He has to vacate his office immediately, and there will arise a dash even in the office of dash. There will arise a casual vacancy even in case of the cost auditor. So there may be a casual vacancy in the office of the financial auditor, and there may be a casual vacancy even in case of the cost auditor. That is the point that you need to understand. And another important point is CMA Institute has given a notification. In that notification, CMA Institute specifies that the statutory auditor of the company, who is that? The statutory auditor of the company cannot simultaneously be appointed as the cost auditor of the company. The same person cannot be appointed both as dash as well as dash, both as the statutory auditor as well as the cost auditor simultaneously. Subsequently, CA Institute had given a notification saying that cost auditor of the company cannot simultaneously be appointed as the statutory auditor of the company. By this, what you need to understand is statutory auditor cannot simultaneously be appointed as the cost auditor. Cost auditor cannot simultaneously be appointed as the financial auditor. ICAI Institute has also said that statutory auditor's partner. What is that? Statutory auditor's partner or statutory auditor's employee cannot be appointed as the cost auditor. Similarly, CA Institute had given a notification saying that cost auditor's partner or cost auditor's employee cannot be appointed as the statutory auditor. By this, what you need to understand is like this. Statutory auditor cannot simultaneously be appointed as the cost auditor. Cost auditor cannot simultaneously be appointed as statutory auditor. Statutory auditor's partner or statutory auditor's employee cannot be appointed as the cost auditor. Cost auditor's partner or cost auditor's employee cannot be appointed as the statutory auditor. These are all further disqualifications. These are all further disqualifications that were mentioned by CMA Institute through a notification. This is all about who should appoint the cost auditor. Board of directors had to appoint the cost auditor. Now the question is, what is the time limit? What is the time limit within which cost auditor is to be appointed? Cost auditor is required to be appointed by the board of directors within 180 days. Cost auditor is required to be appointed by the board of directors within 180 days from the date of commencement of relevant financial year. I repeat, within 180 days from the date of commencement of relevant financial year, board of directors had to appoint the cost auditor. Immediately by listening to this, at least a few people out of you may be able to recognize that what is mentioned in section 139 subsection 5 of the Companies Act is repeated here. What is section 139 subsection 5? Appointment of a subsequent auditor of a government company. That should be done within 180 days from the date of commencement of the relevant financial year. The same provision is applied here also. So cost auditor is required to be appointed within a maximum of 180 days from the date of commencement of the relevant financial year. By whom? By the board of directors on a recommendation made by whom? On a recommendation made by audit committee. Okay. Once an auditor is appointed, once a cost auditor is appointed, it is the responsibility. It is the responsibility on the part of the board of directors to intimate. It is the responsibility on the part of the board of directors to intimate about the appointment to the appointed auditor, about the appointment to the appointed auditor, and the same shall also be intimated by the company to the central government. To the in case of company auditor, it is required to be intimated to ROC. In case of cost auditor, it is required to be intimated to central government. You cannot directly intimate to Narendra Modi or President of India. There may be some authorities designated for that purpose. To such authorities, you need to make an intimation. So once a cost auditor is appointed, then the same must be intimated by the company both to the appointed auditor as well as to the central government. That intimation shall be given by the company within 30 days. Of course, there is some point which is to be explained elaboratively at this point of time. Such an intimation is required to be given by the company to the auditor as well as to the central government within 30 days. Within 30 days from the date of appointment. Within 30 days from the date of appointment, or within 180 days from the commencement of the relevant financial year, whichever is earlier. Whichever is earlier. This is a little bit confusing. I will try to repeat it again, try to understand it on your own. If not, I will give you an example so that it will be better understandable. What is the time within which this intimation to the auditor and to central government should be done? Either within 30 days from the date of appointment or within 180 days from the date of commencement of the relevant financial year, whichever is earlier. What is the meaning of that? For example, the relevant financial year has been taken as 2022 and 2023. Relevant financial year is 2022-23. What is the date of commencement of the relevant financial year? 1/4/2023. What is the maximum time, what is the maximum time within which cost auditor is required to be appointed by the board of directors within 180 days from the date of commencement of the relevant financial year. 180 days means almost 6 months. That means let us assume the cutoff date for appointment of the cost auditor is 30th September 2023. Are you following this point or not? Right. Now, on 10th April 2023, on 10th April 2023, the board of directors of the company appointed Mr. X, a cost auditor, a cost accountant holding a valid certificate of practice as the cost auditor of the company. So, company is having a time up to 30th September, but the company appointed the cost auditor on 10th April 2023. As said earlier, once the auditor is appointed, it is necessary for the company to intimate not only to the appointed auditor but also to the central government. Such an intimation should be given by the company within how many days? Within 30 days from the date of appointment, or within 180 days from the date of commencement of the relevant financial year, whichever is earlier. So, in the given case, whichever is earlier means 30 days from 10th April means what is the date? On or before 9th May 2023. You cannot wait till 30th September 2023 to intimate the same. And let us assume, this is scenario number 1, 30 days is earlier. 30 days is earlier than 180 days. Therefore, in the given case, the company is required to intimate about the appointment both to the appointed auditor as well as to the central government on or before 9th May 2023. You can calculate 30 days. It is around 9th May. Now, let us assume that the company's cutoff date is 30th September. The company appointed the auditor on the same day. On the same day, 30th September 2023. Now, within how many days this company should intimate the same to the central government? Either within 30 days from the date of appointment or within 180 days from the date of commencement of the relevant financial year, whichever is earlier. That means if you appoint the auditor on the last day, that is the last day on which you need to make an intimation to the central government and to the appointed auditor. That is the logic behind that point. If you are able to understand the logic, you will enjoy it. Otherwise, also no problem. You can read it like this. Once the cost auditor is appointed, it is the duty on the part of the company to intimate about the appointment not only to the appointed auditor but also to the central government within 30 days from the date of appointment or within 180 days from the date of commencement of the relevant financial year, whichever is earlier. And such an intimation is required to be given by the company in a form called as form number CRA2. In form number CRA2. When I say CRA2, you should be able to recollect ADT1. So ADT1 is a form that is used by the company to intimate about the appointment of the auditor, both to the auditor as well as to notify the same to the register of companies, whereas CRA2 is the form used for the purpose of intimating about the appointment of the cost auditor. There a time period of 15 days is given. Here a time period of 30 days is given. 30 days or 180 days, whichever is earlier, is given. This is about CRA2. So CRA1 is the form in which the company is required to maintain cost accounting records. CRA2 is the form that will be used by the company to intimate about the appointment to the appointed auditor as well as to the central government. Remember, when there occurs a casual vacancy, when there occurs a casual vacancy in the office of the cost auditor, then such a vacancy shall also be filled up by the board of directors. Within how many days? Again, within 30 days from the date of occurrence of such a vacancy. When there arises a casual vacancy in the office of the cost auditor due to any reason, it may be either because of dash or dash or dash or dash. You are supposed to fill in these blanks. either because of death or disqualification or dissolution or resignation, whatever may be the cause, whatever may be the reason, if there arise a casual vacancy in the office of the cost writer, such a vacancy shall have to be filled up by the board of directors within 30 days from the date of occurrence of such a vacancy. Once the vacancy has been filled within 30 days from the date of filling of such within 30 days from the date of filling of such vacancy, the same must be communicated by the board of directors to the auditor as well as to the central government through filing form number CRA 2. By this, what you need to understand is CRA 2 is required to be filed every time the cost auditor is appointed, whether it be original appointment or it be an appointment of the cost auditor in place of the auditor, in place of a casual vacancy or to fill a casual vacancy. Once you appoint an auditor, it is your duty to communicate the same to the central government as well as to the appointed auditor through filing a form called as CRA 2. This is about the who can be appointed as the auditor, who should appoint the auditor, what is the time limit within which cost auditor is required to be appointed, what is the time limit within which casual vacancy arising in the office of the cost auditor is required to be filled. Now, what are the rights given to the cost auditor? Fortunately, the same rights that are enjoyed by the statutory auditor were also given to the cost auditor. Rights that were enjoyed by the statutory auditor under section 143 subsection 1 of the under section 143 subsection 1 of the Companies Act were also given to the cost auditor. In other words, cost auditor will enjoy the following rights. Right number 1, right to access to books, vouchers and other relevant records. Right number 2, right to obtain information and explanations either from the company or from any officer of the company. That's it. This is about rights of the cost auditor. Then what about the duty of the cost auditor? The main duty of the cost auditor is to make a report to the company. The main duty of the cost auditor is to make a report to the company. To make a report to the company. You need to conduct audit. You need to form an opinion about costing statements drawn by the company on the basis of cost accounting records are reflecting a true and fair view or not, and the opinions so formed shall have to be expressed by the cost auditor in the form of a report. That report is called as a cost audit report. Till now, I haven't explained you the types of auditors reports. Till now, I haven't explained you the types of auditors reports. I will try to explain these types in detail. Actually, these will appear in SA 705. When you are going to have a discussion on SA 705, these things are required to be explained. But for my sake, I am explaining these points here itself so that it will be applicable to both statutory auditor as well as for the cost auditor. We are more concerned with SA 705 as a statutory auditor. Please tell me, what is audit report? Audit report is nothing but an end product. Audit report is nothing but an end product of audit. What is the basic purpose for which you are appointed as an auditor? Forming and expressing an opinion. Such an opinion cannot be expressed by you orally. It is required to be written, given in writing. So to provide your opinion in writing, you are required to prepare a report. That report prepared by the auditor is technically called as auditor's report. So always auditor's report auditor's report contains dash auditor's opinion. Such report to be given by an auditor can be classified broadly into 4 categories. You are in a position to explain me what are the types of the auditor's report that the auditor can provide at the end of the audit. Please specify the types of the reports that an auditor can give. The first one is clean report. I can't give you much time for your answer. I will tell you the types of the reports. The first one is clean report. The second one is called as a qualified report. The third one is called as a adverse report, otherwise called as a negative report. and the fourth one is called as disclaimer of opinion. The last three things are technically called as modified opinions, and hence the first one is called as unmodified opinion. So clean report can also be called as unmodified opinion or unqualified opinion. You can call it either way, clean report or unmodified opinion or unqualified opinion. Modified opinions are of three types. The first one is qualified opinion, the second one is adverse opinion, the third one is disclaimer of opinion. Now let us have a discussion about when should the auditor issue a clean report. When should the auditor issue a clean report? Where the auditor after obtaining sufficient appropriate audit evidence. In other words, in the given case, the auditor is able, the auditor is, I don't want to explain you what is audit evidence or what is sufficient appropriate audit evidence. That is well known to you, that we will discuss later. So when the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes, when the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes that financial statements, auditor concludes that financial statements are free. Auditor concludes that financial statements are free from material misstatements. Material misstatements. Fortunately, you know about what are financial statements. You know about what is a misstatement. In fact, I have given you two explanations with regard to misstatement. Initially, I said to you that misstatements are the results of either fraud or error. It may be either because of omission or because of a wrong statement. Misstatement in the చిన్నప్పుడు గాలిపటాలు ఎగలేసిన ఎక్స్పీరియన్స్ ఇప్పుడు ఉపయోగపడుతుందా? మిస్స్టేట్మెంట్స్ ఇన్ ద ఫైనాన్షియల్ స్టేట్మెంట్స్ ఆర్ ఎయిదర్ బికాస్ ఆఫ్ ఫ్రాడ్ ఆర్ బికాస్ ఆఫ్ ఎర్రర్. This cannot be proved again and again. Misstatement is the result of either fraud or the result of an error. This was proved in the introductory part itself. If you require, I will try to prove it again. Fraud is of two types. The first one is employee fraud. The second one is management fraud. Employees may involve in fraud in different ways. The first one is through defalcation of cash. The second one is through misappropriation of assets. Cash can be defalcated by the employee by following any one of the following four ways. The first one is suppression of cash receipts. The second one is inflation of cash payments. The third one is including fictitious payments. And the fourth one is by adopting a technique called as steaming and lading. Under the heading suppression of cash receipts, I have given you an example. Actual value of sale made by the employee. Actual value of sale made by the employee is 100. It has been suppressed by the employee and recorded the same in the books of account as 50. How much sale will be reflected in the trading account? How much sale is reflected in the trading account? 50. What is the actual value of sale? 100. What is the value recorded in the books of account? 50. What is the value reflected in the financial statements? 50. Can you now say that trading account is correctly prepared? No. Why? Why? Because it contains a mistake. It contains a misstatement. What is the misstatement in the trading account in the given case? Instead of reporting a turnover of 100 rupees, they reported the turnover as only 50. So that is a mistake or a misstatement. Turnover is misstated, wrongly stated. And hence, this misstatement is the result of what? The misstatement is the result of what? The result of involvement of an employee in fraud through defalcation of cash, but through dash. suppression of cash receipts. So when employee involves in fraud, financial statements are materially or misstated. Sometimes such misstatements may be material also. Yes or no? What is the example that I have given for inflation of cash payments? Actual amount paid by the employee 50, amount reported 100, amount recorded in the books of account 100, amount debited to profit and loss account 100. Now can you say that this amount of 100 rupees debited to profit and loss account is correct amount or misstated? Why P&L account is misstated? Because employee of the organization was involved in fraud through inflation of cash payments. At least by now, you should be in a position to understand that misstatements are the results of dash fraud. It may be either employee fraud or even management fraud. The third one, including fictitious payments. Actual payment made by the employee 0. Payment recorded in the books of account 100. Payment reflected in the profit and loss account 100. Can you now say that P&L account is correctly prepared? Why? Why? Because it contains mistake or it contains misstatement to the tune of 100. That mistake or misstatement is the result of what? Inflation of including fictitious payment, which is done by whom? By the employee. That means employee of the organization was involved in fraud. Because of that, financial statements got misstated. Like this, every time I proved that only because of the existence of fraud or because of the existence of error, financial statements gets misstated. Even in case of management fraud, actual profit earned by the organization is 10 lakhs. But the management reported a profit of only 1 lakh rupees. For this, management had inflated salaries by 9 lakh rupees. Inflated salaries by 9 lakh rupees. So an extra amount of salary of 9 lakh rupees is debited to profit and loss account. That means we can say that P&L account contains, particularly salary amount contains misstatement. Why this misstatement happens? Because of the existence of management fraud. At least by now, every one of you must be able to understand that misstatements are the results of either fraud or error. So every time if a lecturer says misstatement, you should be able to understand that those misstatements are the results of either frauds or errors. If such misstatements are very, very small, you can simply ignore them. But if such misstatements are able to influence your economic decisions, then such misstatements are technically called as material misstatements. If financial statements contains material misstatements, then they will not reflect a true and fair view. If financial statements contains misstatements, but if they are not material, I have given you an example for this in the introductory part. You have been appointed as the auditor of an entity. You have identified a mistake or misstatement of just 1 rupee in the financial statements. In that case, can you say that the financial statements are reflecting a true and fair view? If I were the auditor, I will say that financial statements are reflecting a true and fair view. No doubt, there is a mistake. There is a misstatement. But the misstatement identified by the auditor is not so material. If it is not material, you can simply ignore it. If it is not material, you can simply ignore it. And you can still conclude that financial statements are reflecting a true and fair view. So now, by now at least, you should be able to understand the term material misstatement. What is meant by free from material misstatements? There are misstatements in the financial statements, but those misstatements are not material. There may be some dash misstatements in the financial statements. Immaterial misstatements would be there in the financial statements, but the misstatements in the financial statements are not material. When the financial statements are free, free from material misstatements, obviously such financial statements will reflect a true and fair view. When the financial statements are reflecting a true and fair view, what type of opinion should the auditor express? Auditor shall have to issue a clean opinion otherwise called as unmodified opinion. Now you can just go through point number 1 once again so that you will have a better understanding of this. So when should the auditor issue a clean report? When the auditor is able to obtain sufficient appropriate audit evidence. Because you are able to obtain sufficient appropriate audit evidence, you concluded that financial statements provided to you are free from material misstatements resulting either from fraud or from error. And hence, you are of the opinion that such financial statements are reflecting a true and fair view. In such case, what type of opinion or report should the auditor give? A clean report. Are you able to follow this or not? Done. The next one is qualified report. What is that? Qualified report. Qualified report is required to be given by the auditor under two different situations. This is very important and I need your attention while listening to this point. This is very, very important for you, which will help you a lot in understanding SS705. Everything I am explaining to you is being explained to you, keeping in view the fact that we are going to have a discussion on standards on auditing. They are better understandable to you only when you are having knowledge of this. Okay, there are two situations in which qualified opinion can be given by the auditor. The situation number 1, when the auditor is able to obtain sufficient appropriate audit evidence, and situation number 2, when the auditor is unable to obtain sufficient appropriate audit evidence. Out of these two, the first one is easy to understand. The second one is very difficult to understand. What is situation number 1? Remember, here also I used the term able. Here also I am using the term able. So the auditor is able to obtain sufficient appropriate audit evidence, and the auditor concludes. The auditor concludes that financial statements contains material misstatements. The auditor concludes that financial statements contains material misstatements. In the previous case, you have concluded that financial statements are free from material misstatements. Now the auditor concluded that financial statements contains material misstatements. But fortunately, those material misstatements are not pervasive. What is meant by pervasive? Not as a whole to the financial statements. They are limited to a particular area. Problem is limited only to a particular area. If the problem is as a whole, it is said to be pervasive. For example, a person is not having hair. Out of 2 ears, only 1 ear is working. Out of 2 eyes, only 1 eye is working. Out of 4 valves, only 1 valve is working. Out of 2 kidneys, only 1 kidney is working. Out of liver, 50% is working. Out of 2 legs, only 1 leg is working. Where the problem lies? Everywhere. As a whole to the body. If it is as a whole, then it is technically called as pervasive. So the auditor, fortunately, there are some material misstatements in the financial statements, but such misstatements are limited, are restricted only restricted to a particular area. They are not pervasive as a whole to the financial statements. So if they are not pervasive, not as a whole to the financial statements, if the impact of such material misstatement is limited to a particular area, then the auditor had to issue a qualified report. Remember, if you are giving a qualified report, particularly in this case, you are saying that financial statements are reflecting a true and fair view, accepting so and so. Accepting that financial statements are reflecting a true and fair view. What is that? Accepting those material misstatements that are there in a particular area. Accepting that area, everything is fine, and hence our financial statements are reflecting a true and fair view. Accepting that area. If the auditor says that your financial statements are reflecting a true and fair view, it is called as clean report. If the auditor says that your financial statements are reflecting a true and fair view, excepting so and so, it is called as dash. Qualified opinion. Are you able to follow me or not? So what is the situation? First situation in which auditor can issue a qualified report when the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes that financial statements contains material misstatements, but fortunately they are not as a whole to the financial statements. Their impact is limited or restricted to a particular area. In that case, accepting that area, you can say that accepting that area, everything is fine. That is called as a qualified report. Now, this is the most important one. Usually, students are of the opinion that when the auditor is unable to obtain sufficient appropriate audit evidence, he needs to issue a disclaimer of opinion. That conception is a misconception. If the auditor is unable to obtain sufficient appropriate audit evidence, that means the auditor is unable to get required information. In that case, auditor may either have to issue a qualified report or even disclaimer of opinion. Let us limit our discussion only to qualified opinion as of now. I will give you a break only after completion of this topic. Don't expect any break before completion of this. Okay? Done. The auditor is unable to obtain sufficient appropriate audit evidence. Unable to obtain sufficient appropriate audit evidence. But the auditor concludes that the possible effects of undetected, very good, the possible effects of undetected misstatements, possible effect of undetected misstatements could be material, very good, but not pervasive. This is the point students face difficulty in understanding. I repeat, I will try to explain each and every word of that in detail. First of all, try to listen to that. When the auditor is unable to obtain sufficient appropriate audit evidence, and when the auditor concludes that the possible, why the term possible is used? Because you failed to obtain information. Because you failed to obtain information, you started expecting it. Because you are expecting it, the term dash has been used. Possible has been used. If you are able to obtain sufficient appropriate audit evidence, you would have been in a position to assess the impact or effect on your own. But here you are unable to obtain sufficient appropriate audit evidence. That is the reason why you are anticipating, you are expecting. Hence the term dash is used. Possible is used. So where the auditor is unable to obtain sufficient appropriate audit evidence, and where the auditor concludes that the possible effects of undetected misstatements. Why the term undetected has been used? You failed to detect misstatements. Why? You failed to obtain sufficient. So because you are unable to obtain sufficient appropriate audit evidence, you would have failed in detecting some misstatements which could have been there. But because of lack of evidence, you may have failed in detecting such misstatements. So there may be some undetected. What is undetected? Failure on the part of the auditor to detect a misstatement is called as a undetected misstatement. Why the auditor failed to detect a misstatement? Because the auditor is unable to obtain sufficient appropriate audit evidence. In that case, if the auditor is anticipating that the possible effect of undetected misstatements on the financial statements could be material. There may be some material, there may be, why the term maybe is being used? Because the auditor is unable to obtain sufficient appropriate audit evidence. There may be some material misstatements in the financial statements, but they may not be This is purely an expectation of the auditor. They may not be pervasive. In that case also, the auditor should have to give a dash opinion, a qualified opinion. Are you able to follow this or not? And the remaining two are very easy. When to issue an adverse opinion? When the auditor is able to obtain sufficient appropriate audit evidence. When the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes that financial statements are reflecting a true and fair view. Sorry. I'm very sorry. When the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes that financial statements contains material misstatements contains misstatements which are both material as well as pervasive, I repeat, where the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes that financial statements contains misstatements, and such misstatements are both material as well as pervasive. Those misstatements are as a whole to the financial statements. They are not limited to a particular area. If they are limited to a particular area, you would have given a dash opinion, a qualified opinion. Accepting that area, everything is fine. So you would have given a qualified opinion. Here, there are material misstatements. They are pervasive in nature. So financial statements are not reflecting a true and fair view. In that case, you need to issue dash opinion, adverse opinion, and finally, disclaimer of opinion. When the auditor is unable to obtain sufficient appropriate audit evidence, and when the auditor concludes that you can just go through this point to understand this point. Unable to obtain sufficient appropriate audit evidence, and the auditor concludes that the possible effects of undetected misstatements could be material and pervasive. If it is material but not pervasive, you need to issue a dash opinion, qualified opinion. If it is material and pervasive, you need to issue a dash opinion. Why you are giving a disclaimer? Disclaimer means you are declaring that I am unable to form an opinion. Disclaimer means you are declaring that I am unable to form an opinion. Why the auditor is unable to form an opinion? I'll give you a best example for this. With this, I am giving you a break. You have been appointed as the auditor of a company called as A Limited. When you go for an audit, financial statements prepared by the financial statements prepared by the entity were provided to you. You asked the company to provide books and other related records. The company has given a reply saying that, sorry sir, books and other related records are not available with us. Then the auditor made an inquiry with the management. Management said that all the books and other related records have been destroyed by fire, sir. That is the reason why books are not available. Then the immediate question the auditor posed to the management is, when the books are lost by fire accident, when the books are not available, how you have prepared these financial statements? And you need to see me. The management has given an answer like this. Just like sir. Just like that, sir. What is that? How do you prepare your financial statements without having any books of account? Just like that. Now, if you were the auditor, can you say that the financial statements are reflecting a true and fair view? We don't know, because dash are not available. The basis for preparation of financial statements is books. Books are not available. When the base is not available, is it possible for you to form an opinion? No. When you are unable to form an opinion, you need to issue a dash, a disclaimer of opinion. This is all about the types of the auditor's report, certain specialized services. That means if you were already appointed as the auditor of a company, you cannot be appointed for the same company for providing any one or more of the following services, or you cannot be appointed as the auditor of its holding company, or you cannot be appointed as the auditor of its you cannot provide such services to the holding company or to the subsidiary company. I repeat, you are already appointed as the auditor of a company called as A Limited, and the services that were mentioned under section 144 of the Companies Act cannot be provided by you to A Limited because you were the auditor of A Limited. So the statutory auditor of the company cannot provide any one or more of the following services to the company or to its holding company or to its subsidiary company. First of all, let's have a discussion on what are the prohibited services. Once you understand the term prohibited services, then you can easily understand this point, if not understandable earlier. If you were the auditor of a company, you are disqualified from providing the following services to the company simultaneously. You were already appointed as the auditor. You cannot provide any one of the following services to the company simultaneously. Point number 1, accounting and bookkeeping services. For every point, I will try to provide you with a logic. If you understand the point with a logic, you will remember the point for a long period of time. Otherwise, it is quite difficult for you to remember these points. You must be able to remember at least 5 to 6 points out of 9 points given in the question. Therefore, try to understand each and every point with a logic so that it is more understandable, and more importantly, you can remember that for a long period of time. Let us assume that you have been appointed as the auditor of a company. When you go for an audit, the entity is required to provide you with the draft set of financial statements. The entity has not provided you with any draft set of financial statements. Then you made an inquiry with the company. Why you have not provided us a draft set of financial statements? How we can conduct audit without providing a draft set of financial statements? That was the question posed by you on the company. Then the company has given a reply like this: sorry sir, we have not yet prepared our financial statements because our books are not updated, because our accountant had left the job few months back.
Recording stopped.
The accountant of the company had left the job few months back, and no other person has been appointed in his place. There is no accountant to the company. So books and other related records of the company were not updated. Trial balance has not been prepared. Financial statements are not prepared. That is the reason why we are unable to provide you with financial statements. That was the reply given by the company to you. Apart from that, the company started asking you to update the books and other related records. The company asking you to prepare financial statements and to conduct audit of such financial statements prepared by you. What the company is asking the auditor? You have been appointed as the auditor not only for conducting audit, you are also made responsible to update all the books and other related records of the company. You need to prepare trial balance out of such books of account. If such trial balance agrees, you need to prepare our financial statements as well. The financial statements so prepared by you should be audited by you, and you need to form and express an opinion on such financial statements. This was the contention of the company. Do you agree with this contention of the company? No. If the same person who had prepared the financial statements is also made responsible to form an opinion, will he express his opinion objectively? If your answer paper has been given to you for evaluation, how many marks would you get? If I were made responsible to evaluate my own answer sheet, I will get 105 marks. Baga chadivanu anna. I will get 105 out of 100, because in that case I cannot be said to be objective. In that case, I cannot said to be objective, because I am having self-interest in that. So if you are having some self-interest in any work, obviously you will not be objective. The best example is if you are having a business relationship with a company, either directly or indirectly, and if you are allowed to be appointed as the auditor of that company, can you maintain independence? Can you maintain objectivity? No. Why? Why? Because you are having a self-interest in that company. Because of your self-interest, you may not be objective. You may take decisions to your own advantage, not to the advantage of the shareholders. In that case, the work carried out by the, when you are having self-interest, you will take decisions to meet your self-interest, to your self-interest only, not to the interest of the shareholders. In that case, when decisions are being made by the auditor to meet his own self-interest and not keeping in view the interests of the shareholders, obviously the opinion given by the auditor cannot be said to be objective. It is subjected to self-interest of the auditor. If the opinion given by the auditor is subjected to the self-interest of the auditor, it is said that the opinion is not reliable. Therefore, if you are having self-interest in a company, then you cannot work objectively. Hence, your work is subjected to your self-interest. Hence, your work is not reliable to the users of the financial statements. So, in the given case, if you are made responsible to update the accounts as well as you are made responsible to prepare financial statements and to express an opinion thereon, you will have self-interest in that and you will review your own work. You will review your own work. That is called as self-review. The auditor is made responsible to review his own work. When you are made responsible to review your own work, you cannot maintain objectivity. Therefore, if you were appointed as the statutory auditor of a company, you will not involve, you should not be involved in accounting and bookkeeping services to that company. You cannot be appointed to that company for providing accounting and bookkeeping services. That means the same person cannot act both as the auditor of the company and cannot provide accounting and bookkeeping services to the company simultaneously. You may be appointed as an auditor. In that case, you should not provide accounting and bookkeeping services to the company. You may be providing accounting and bookkeeping services to the company. In that case, you cannot be appointed as an auditor. Only one activity should be carried out at one time. You cannot perform both the activities simultaneously. So, where you are already appointed as the statutory auditor of a company, you cannot provide accounting and bookkeeping services either to that company or to its holding company or to its subsidiary company. In the given example, you were appointed as the auditor of A Limited. You cannot provide accounting and bookkeeping services either to A Limited or to its holding company or to its subsidiary company. That's it. Only three are mentioned in section 144. What are they? To the company, to its holding company, and to its subsidiary company. Can you repeat the wording of section 144? 144 deals with auditor not to render certain specialized services. If you were appointed as the auditor of a company, you are not allowed to carry out any one of the following activities simultaneously. One, accounting and bookkeeping services. The second one is internal audit. What is that? Internal audit. The same person cannot simultaneously be appointed both as the statutory auditor of the company as well as the internal auditor of the company. Why? There should be some logic behind it, without which there is no point in reading it. What is the logic? If the same person is appointed both as the statutory auditor as well as the internal auditor, you know very well that statutory auditor should always be independent. Should not lose independence. Whereas internal auditor may be independent or may not be independent. Why? Because while having a discussion under section 138 of the Companies Act, I said to you that internal auditor may be either employed by the entity or engaged by the entity. Internal auditor may be either employed by the entity or engaged by the entity. If internal auditors were employed by the entity, then there will be an employer and employee relationship between the entity and the internal auditor. In that case, can you say that internal auditor is able to maintain independence? Certainly not. So, on one hand, being a statutory auditor, you must always be independent. If the same person is appointed as the internal auditor also, he may not be able to maintain independence. Is it practically possible for the same person to be independent sometimes and not to be independent some other times? No. That is the reason why the same person cannot simultaneously be appointed both as the statutory auditor as well as the internal auditor. If you are already working or acting as the statutory auditor of the company, you cannot simultaneously be appointed as the internal auditor of that company or its holding company or its subsidiary company. Now, what is section 144? According to section 144, the auditor of the company is prohibited. According to section 144, the auditor of the company is prohibited to provide the following services simultaneously. 1. Accounting and bookkeeping services. 2. Internal audit services. So, I completed point number 1 and point number 2. Now, let us focus on investment advisory services. What are investment advisory services and why the statutory auditor of the company has not been allowed or is prohibited from providing investment advisory services to the company? There is a big logic behind this. I will try to explain you the logic behind this briefly so that you will have a better understanding of that. What is the thing that we are going to discuss? Investment advisory service. The statutory auditor of the company cannot provide investment advisory service to the company simultaneously. You may be appointed as the statutory auditor or you can provide investment advisory services. You cannot perform both the functions of statutory audit and investment advisory services simultaneously. What is meant by investment advisory service and why the statutory auditor is prohibited from providing investment advisory services, that I will explain you with the help of an example. This example is a very good example. This is the first and the last time you are listening to it. In your lifetime, you won't listen to this reason behind why an auditor cannot be appointed as to provide investment advisory services. There is a company called as A Limited. A Limited is having an investable fund of 1 crore rupees. With this money, they want to purchase. With this money, they want to purchase some investments, and they are clueless about in which company this amount should be invested. Remember, the objective behind making investment by A Limited was a short-term objective. So A Limited is a company which is having a surplus money of 1 crore. They want to invest this 1 crore rupees in the shares of some other company, and the objective behind investment is a short-term objective. They don't know where to invest. Therefore, A Limited has taken an advice. A Limited has taken, let us assume, A Limited has taken an advice from their statutory auditors. Mr. X is acting as the statutory auditors of A Limited. So A Limited has taken an advice from X. Sir, we are having a surplus money of 1 crore rupees. They wrote a letter to the auditor asking the auditor to suggest a name of a company in which they can make an investment of up to 1 crore rupees for a short period of time. Then X suggested that B Limited is a good company to invest. B Limited is a good company to invest. Upon the advice received from the statutory auditor of the company, A Limited made investment of this 1 crore rupees in B Limited. This investment was made on 30th March 2023. Last but one date of the reporting period, end date of the reporting period. Okay, so this investment decision has been made by the company on the basis of dash given by dash, on the basis of advice given by the statutory auditor of the company. And on 31st March, they started preparing their financial statements. A Limited started preparing their financial statements on 31st March. By 31st March, they haven't sold investments held by them in B Limited. Only 2 days elapsed since purchase of the investments. So they haven't sold investments on 31st March. They held investments as on 31st March. Now they need to value such investments to show the value in their balance sheet. Remember, in the given case, what was the objective behind purchase of investments? When the objective is a short-term objective, such investment shall have to be classified by A Limited as current investments, and those investments are required to be valued either at cost or at fair market value, whichever is lower. What is the cost of investment? 1 crore. Let us assume it as 1 crore including brokerage, etc., etc. and the fair market value of the investment on 31st March is 1000 rupees. Is 1000. Let us assume it as 1 lakh for the sake of simplicity. So the fair market value of the investment is only 1 lakh rupees. You purchased investment worth rupees 1 crore on 30th March. By 31st March, the value of your investment falls to 1 lakh rupees. This is all is based on dash given by dash to dash, and an advice given by the statutory auditor of the company to the company. Following the advice given by the statutory auditor, company made the investment. Now the company suffered with a loss of 99 lakh rupees within a span of just 2 days or say 1 day. Now what is the value to be reflected against that investment by the company in their balance sheet? It is only 1 lakh. What about remaining 99 lakhs? It is a loss which is required to be debited to the profit and loss account of the company. If the company debits this 99 lakh rupees to its profit and loss account, the company would suffer with a huge loss of 98 lakh rupees. Presently, the company is in profit, but if this loss is debited to the profit and loss account, the company will suffer with a loss of 98 lakh rupees. So the entire financial position of the company gets disrupted. Therefore, the company made a request to their statutory auditor. Sir, all this happens because of your advice only. Please cooperate with us, sir. If we recognize this loss of 99 lakh rupees and debit the same to our profit and loss account, we will suffer with a loss of 98 lakh rupees, sir. Actually, we got some profit because of your very good advice. We are slipping into losses. Please cooperate with us, sir. Although we suffered with a loss of 98 lakhs, we don't want to reflect this 99 lakh rupees loss in our P&L account. Instead, we value our investment not at 1 lakh rupees but at 1 crore rupees. It is wrong. We know it. You also know it because it is all done on your advice. Please give an opinion that the financial statements are reflecting a true and fair view. And if you were the statutory auditor of the company, if all these things happens on your advice, would you try to cooperate with the company or not? Obviously, yes. That means auditor is getting compromised with dash, his independence. Why the auditor is compromising with his independence? For the simple reason that he is allowed to provide an advice to the company. So in that case, auditor cannot be said to be independent. When the auditor is not independent, the purpose for which the auditor is appointed gets defeated. That is the reason why, thinking all these points, Companies Act suggested that if you are the statutory auditor of the company, you are prohibited from providing dash services to the company. You are prohibited from providing investment advisory services to the company. Investment advisory services to the company. So, what are the prohibited activities for a chartered accountant under section 144 of the Companies Act? Accounting and bookkeeping services, internal audit, investment advisory services. The next one is actuarial services, otherwise called as valuation services. Actuarial services, otherwise called as valuation services. This is also very simple to understand if you have really understood the concept of self-review. If you really understood the concept of self-review, this point is very easy to understand. For example, the company is facing problems in valuation of its closing inventory. Company had to prepare financial statements. For preparation of financial statements, it had to identify the value of the closing inventory, but the company is facing some problems in valuing their closing inventory. Therefore, the company, let us assume that the company has taken an advice. The company has taken an advice from their statutory auditor with regard to valuation of closing inventories. The statutory auditor has given an advice saying that this would be the value of your inventory. Based on the advice given by the statutory auditor, the value given by the statutory auditor has been adopted by the company for the purpose of preparation of their financial statements. So in the given case, who valued the inventory? Is it the company or the auditor? Auditor valued the inventory, a suggestion to that effect has been given, an advice to that effect has been given by the auditor to the company concerned, and by listening to the advice given by the auditor of the company incorporated the same amount as the value of their inventory in their balance sheet. Now, after some period of time, the auditor came for conducting audit. What is your duty as an auditor in respect of valuation of inventories? You need to check whether the valuation of inventory done by the management, you need to check just a few minutes more. 10 minutes more. You need to verify whether the value of closing inventory is reasonable or not. So, you mentioned to the company that the value of the closing inventory is 1 crore. Now, you need to verify whether that 1 crore rupees suggested by you to the company is reasonable or not. That means the work carried out by you previously in some other capacity is to be reviewed by you in the capacity of the auditor. Previously, you have given this suggestion of 1 crore in a capacity as an advisor. Now, the same work is required to be reviewed by you as an auditor. So, the work carried out by you in a different capacity is being reviewed by you as the auditor of the company. In that case, will you say that this value is correct, or will you say that this value is wrong? Obviously correct. Although it is wrong, since that has been done by you, you will say that it has been correctly done. That means the auditor is not dash, not objective, independent, not objective. He is subjective because he is reviewing his own work. That is the reason why you are prohibited from providing dash services to the company for which you are already appointed as the auditor. Actuarial services to the company, either to that company or to its subsidiary company or to its holding company. This is another prohibited service. The next one is outsourced financial service. What is that? Outsourced financial service. For example, this is also very easy to understand, but I will provide you a logic for this also so that you have better understanding of the same. For example, APSRTC is giving some franchisees for the purpose of ticket booking, collection and accounting. Ticket booking, collection and accounting. And X, a chartered accountant in practice, is the auditor of APSRTC, and he has taken a franchisee from APSRTC. That means X is now having dash with APSRTC. A business relationship. Business relationship may be held by you either directly or indirectly. If you are having a business relationship directly or indirectly, it certainly affects your self-interest. It's yes or no. If it is affecting your self-interest, can you maintain independence? No. That is the reason why either you can decide to act as the auditor of APSRTC, or you can decide to take the franchisee of APSRTC, only one at a time. You cannot simultaneously be appointed both as the auditor of the company, and you cannot carry out outsourced financial. Ticket sale is a financial service to APSRTC. It is not being carried out by it. It has been given to somebody else. That is called as outsourcing. So, in the given example, ticket booking, money collection, accounting is the best example of an outsourced financial service. If the auditor of the company is allowed to carry out that outsourced financial service, then it is said that the auditor is having some relationship with the company, business relationship. In that case, the auditor's self-interest will get affected. When the auditor's self-interest is getting affected, he cannot be said to be objective. He cannot be said to be independent. That is the reason why the Companies Act prohibited, Section 144 of the Companies Act prohibited the auditor of the company to render the following services, which includes dash outsourced financial services. And the next one is, I don't know why this was included. I cannot give you a logic for this. Investment banking services. Investment banking service. What is investment banking service? If the company is coming up for an IPO or for an FPO, initial public offer or further public offer, the company had to comply with several regulations issued by SEBI in that regard.
and it is quite difficult for the company to comply with all the rules and regulations issued by SEBI while they are coming up either for IPO or for FPO. Some are not even known to the company. Therefore, generally, when the company wants to go for a public issue, they do appoint a practicing chartered accountant. And that practicing chartered accountant will look after everything relating to the IPO or FPO and relating to guidelines issued by SEBI in respect of issuance of securities to the general public, like appointment of bankers, appointment of brokers, appointment of other agents. Everything will be opening a separate bank account, preparation of prospectus, everything will be taken care of by that practicing chartered accountant. So all the things that are required to be carried out by the company will be carried out by the chartered accountant on behalf of the company with respect to issuance of securities to the general public, that may be either through IPO or through FPO. In that case, it is said that those services that are being provided by the chartered accountant to the company are technically called as dash investment banking services. If you are the auditor of the company, you are prohibited from providing those services either to the company for which you were appointed as the auditor or to its holding company or to its subsidiary company. You cannot carry out all these activities simultaneously. That is what section 144 says. And there are two more points on this particular point specifying the same thing in the exam. In the previous exam paper, there was a question. Designing and implementing any financial information system. Designing a financial information system should not be done by whom? Should not be done by the statutory auditor. It should be done by somebody else, or it may be carried out by a chartered accountant, but that person cannot act as the statutory auditor of the company. That is about designing and implementing any financial information system. And finally, management services. I cannot explain this point. I am expressing my inability to explain this point for two reasons. Reason number one, the term management services has not been defined anywhere in the Companies Act. It is used, that's it. It has not been defined anywhere in the Companies Act. Then how to understand the term management services? If you want to really understand the term management services, there is an indirect way to understand it. There is no direct way because it was not defined in the Companies Act. But the same point has been defined by the CA Institute in a heading called as not management services, but in a heading called as management consultancy services. Management consultancy services. I will try to show you the definition also. If you are interested, really interested in knowing that, you can just go through it. Okay.
Hello everyone, greetings of the day. Now you can purchase CA inter-auditing regular batch videos from our Masterminds online classes app. These videos are taught in 100% English by Professor Sharma sir, having 23 years of rich experience in teaching the subject. Here you will find 175 hours of detailed videos covering all the chapters applicable for November 23 attempt recorded as per 2017 scheme. These are all latest recordings which are recorded in the classrooms but not in the recording theaters. You will find crystal clear detailed explanation for every concept in the subject, and you will definitely have a very good experience which you have never experienced earlier with regard to auditing subject. You can get these HD quality audio video lectures from our Masterminds online classes app. If you are an Android user, please install Masterminds online classes app, and in the search you please search for CA inter-auditing in the store section. If you are an iOS user, please install Class Plus app and enter our organization code MJGUN and search for CA inter-auditing in the store section. You can find the links to directly purchase these videos in our comment section. And you have three exciting convenient options to buy this course. Option 1, you will have 175 hours of videos for 6 months at 2 views, and the material will be couriered to you, and at the same time you can have PDF material on the screen, and option 1 is available for 5,000 rupees. And option 2, the same duration, 1 month, 1 view for 1,000 rupees, but PDF material only can be read on the screen. And you have option 3, For 175 hours, 3 months, 2 views, material will be couriered, and you can also have PDF material on the screen available for 3000 rupees. We hope this course will be of great help to you. All the best. Happy learning.
177 of the Companies Act. As already said to you, constitution of an audit committee is not mandatory for all companies. It is made mandatory only for listed companies as well as a public company which is an unlisted company having a paid up capital of 10 crores or more. These are all the things which are not required to be explained at all. You need to remember them, that's it. So, if the company is a listed company, you are under obligation to, the company is under obligation to constitute a committee called as a audit committee. In respect of other public companies which are not listed companies, if such a public company satisfies any one of the following three conditions, such a public company is also under obligation to constitute an audit committee. A public company having a paid up capital of 10 crores or more, a public company having a turnover of 100 crores or more, or a public company having aggregate outstanding loans, borrowings, debentures, deposits. Everything is covered in this heading. Everything is covered under this heading. Loans, borrowings, debentures and deposits worth rupees 50 crores or more. If you are able to recollect what we discussed under section 138, the term debentures is not there under section 138. Can you please try to recollect the conditions that are made applicable in respect of appointment of internal auditor? Internal auditor is required to be appointed by all listed companies. It is required, internal auditor are required to be appointed by unlisted public companies if such an unlisted public company satisfies any one of the following four conditions. Condition number 1, 25 crores or more. Condition number 2, 50 crores or more. Condition number 3, 100 crores or more. Condition number 4, 200 crores or more. Condition number 1, 25 crores or more is related to outstanding deposits. There the term deposits is used. Condition number 50 crores or more, paid up capital. Condition number 100 crores or more, aggregate of loans or borrowings from banks and financial institutions at any point of time during the year. Nowhere in section 138 the term debentures has been used. Similarly, even under rotation of auditors, the term debenture has not been used. It is used only in one place, that is section 177. You need to understand those differences, minute differences. If you fail to understand them, somewhere probably within very few attempts there may be a question on this point which is having minute differences. The terminology is almost one and the same, but there are some minute differences. There is every chance that you may get a question on that. Therefore, you should be very careful while reading the terms like outstanding loans, borrowings, debentures, deposits, etc. Debenture is appearing only in section 177. That's it. Now, how to constitute an audit committee? There should be a minimum 3 members in the audit committee. All the members of the audit committee must be the directors of the company. So, some of the directors of the company will be appointed as the members of audit committee. There should be minimum 3 members in the audit committee. All the members should be directors, and majority of the members of the audit committee. Majority of the members of the audit committee shall be independent directors. And most importantly, majority of the members of the audit committee, including its chairperson. Majority of the members of the audit committee, including its chairperson, shall have an ability to read and to understand financial statements. Why this condition is imposed in section 177 will be known to you when you are able to understand the duties or responsibilities of the audit committee. Once you understand the duties of the audit committee, I will try to establish a link between one of those duties of the audit committee with this point. What is the point? Majority of the members of the audit committee, including its chairperson, majority of the members of the audit committee, including its chairperson, shall have an ability to read and to understand financial statements. This is all about composition of audit committee. In fact, all this is already discussed by me in the previous session, that is about 139 subsection 11, manner and procedure of selection and appointment of auditors. I don't want to read that, you can read it. Composition of audit committee. The audit committee shall consist of minimum 3 directors. Majority of the directors must be independent directors, and majority of the members of the audit committee, including the chairperson, shall be able to read and understand the financial statements. Why this condition is imposed? That condition is relatable to point number C. This condition is relatable to point number C. Functions of, under the heading functions of audit committee, several functions of the audit committee were elaborated. Point number C of functions of audit committee is having a link with this particular condition. So if you are able to understand the functions, you will be able to understand why this condition has been imposed. What is that condition? Majority of the members of the audit committee, including dash. Majority of the members of the audit committee, including chairperson, shall have an ability to read and to understand financial statements. Laymen cannot be appointed as the members of the audit committee. He may be a director in the company, but he may not be having knowledge about financial statements. It's the process of preparation of financial statements, the process of authentication or approval of financial statements. Nothing is known to the director. In that case, the director should not be appointed as the member of an audit committee. Majority of the members of the audit committee, including its chairperson, shall have an ability to read and to understand financial statements. That is about the composition of the audit committee. Now let us try to understand functions of the audit committee. I will try to read them and try to explain it, because they are not very much important in examination point of view, but there is every probability that any time a question may be asked. That is the reason why I am explaining you the functions of the audit committee also. The first one is very well known to you. What is the first one? What is the main duty of the audit committee? Every time I said to you that if there is an audit committee, appointment of auditors will be recommended by whom? Appointment of auditors, whether it be a statutory auditor or it be a cost auditor or even it be a secretarial auditor. Appointment of auditors and related matters will be suggested or recommended by audit committee to the board of directors. Board of directors in turn will make such recommendation to the shareholders. I said to you that selection is the duty of dash, but appointment is the duty of dash. Selection is the duty of the audit committee and appointment is the duty of the shareholders of the company, or sometimes it may be duty of the board of directors as well, right? So functions of audit committee, first function is well known to you. I don't want to explain it. I want to just read it. Audit committee is made responsible to recommend. Audit committee is made responsible to recommend for appointment of auditors of the company. For appointment of the auditors of the company. They can also make recommendations with regard to remuneration of the auditors so recommended and other terms of appointment of auditors. So everything should be done by audit committee in respect of appointment, in respect of selection of auditors. Selection will be done by audit committee. Recommendation will be made by audit committee. Recommendation with regard to remuneration will also be made by audit committee. Recommendation with regard to other terms and conditions of appointment of auditor will also be made by the audit committee. Selection and other recommendations will be made by audit committee. Appointment will be done by shareholders or by board of directors as the case may be. Next, it is the duty of the audit committee to monitor whether the appointed auditors are able to maintain independence or not. Very soon you will have a discussion on SA 200. Standard on Auditing 200, wherein the term independence of the auditor has been explained. And SA 200 also says that there are several threats to the auditor's independence. Because of the following 5 reasons, auditor of a company may not be able to maintain independence. The first one is self-review threat. The second one is self-interest threat. The third one is intimidating threats. The fourth one is familiarity threats. And the fifth one is advocacy threats. Very good. So these are all the threats the auditor may have to face for his independence. That is the reason why every time the auditor should always constantly look up whether he is capable of maintaining independence or not. Even if you get a slightest suspicion that it is not possible for you to maintain independence, it is better for the auditor to discontinue from the audit engagement. Of course, several provisions were introduced in the Companies Act to protect or to safeguard the independence of the auditor. We had a discussion about section 141 subsection 3 clause B, C, clause D, subclause E, clause E, clause F, 140 subsection 1, 139 subsection 2. These are all the sections that were introduced merely to keep the auditor independent, to protect or safeguard the independence of the auditor. So always the auditor is expected to be independent, not only independent in mind but also in independence in appearance. That is the reason why the audit committee shall constantly review and monitor whether the appointed auditors are able to maintain independence or not, or whether there are any factors which are influencing the independence of the appointed auditors. They will take care to ensure that nobody is influencing the independence of the auditors. And they will also evaluate the performance of auditor or effectiveness with which audit process is being carried on. Then this is the most important point. Before giving the auditor's report to the board of directors for their consideration, once the auditor completes his audit and provides his report, then the board of directors will review such report. Before reviewing such auditor's report by the board of directors, such auditor's report and audited financial statements are required to be examined by whom? Before consideration of auditor's report and audited financial statements by the board of directors, such auditor's report and audited financial statements are required to be considered by audit committee. In order to consider the financial statements, the members of the audit committee should have knowledge of the financial reporting process, without which they cannot examine the financial statements and auditor's report thereon. That is the reason why second condition was imposed under the heading composition of audit committee. What is the second condition? What is the second condition? Majority of the members of the audit committee, including its chairperson, shall have an ability to read and to understand financial statements. That is the reason why that condition has been imposed. If members of the audit committee do not have knowledge of financial statements, how can they examine the financial statements and auditor's report thereon before submitting the same to the board of directors? That is the reason why it has been included. So examination of financial statements and auditor's report thereon is said to be another function of audit committee. Then the next one is related parties, that we are going to discuss very soon under the heading CARO. You know very well that when a transaction has been entered by a company with their related parties, such transactions entered by the company with related parties cannot generally be considered as arm's length transactions. Cannot generally be considered as arm's length transactions. I repeat, if a transaction has been entered by a company with a related party, such a transaction entered by the company with its related parties cannot generally be considered as an arm's length transaction. What is an arm's length transaction? Arm's length transaction can be defined as a transaction between a knowledgeable willing buyer and a knowledgeable willing seller. If a transaction is entered between a knowledgeable willing buyer and a knowledgeable willing seller, such a transaction is technically said to be an arm's length transaction. What is meant by knowledgeable willing buyer and knowledgeable willing seller, and why do we call the transaction as an arm's length transaction? in that type of transactions, the price charged for the transaction is reasonable. In those type of transactions, the price charged in respect of such transaction will be reasonable. That is the reason why we'll call them as arm's length transaction. The seller is having knowledge about what to sell, how to sell, at what price it is to be sold. The buyer is also having knowledge about the product. He knows very well about the price at which it is reasonable for him to purchase the product. So both are having very good knowledge about the point. Seller is having knowledge about the product, at what price the product can be reasonably sold. Buyer is also having knowledge about the product, and he is having knowledge about at what price we can purchase the product reasonably. So both are having knowledge about the product. Therefore, in that case, the price agreed upon between those two parties is said to be more reliable and more reasonable. Why? Because both the parties are having knowledge. One party cannot deceive the other party. If only one party is having knowledge and the other party is not having knowledge, the price entered into between them cannot be said to be an arm's length price. For example, seller is having very good knowledge about the item, but the buyer is not having a knowledge about the item. In that case, the item may be sold at a higher price. That is the reason why, if both the parties are having knowledge, the price agreed upon between them, the price arrived upon between them is said to be a fair price. In that case, the transaction is said to be an arm's length transaction. If the price is unreasonable, it cannot be called as an arm's length transaction. In most of the cases, the transactions with related parties may be entered at prices which are not arm's length prices. They may be entered at arm's length price. If related party transaction has been entered at arm's length price, there would not be any problem to the auditor. Yes or no? The entity under your audit has entered into a related party transaction. I repeat, the entity under your audit has entered into a related party transaction, and you find that the price charged in that related party transaction is equivalent to the price charged by the entity in the ordinary course of its business. That means, in that case, it is said that the price charged by the entity is an arm's length price. When the price is arm's length price, there is no problem to the auditor at all. For the others, they are selling it at 10 rupees. For the related parties also, they are selling it at 10 rupees. That means the price at which the item is being sold to the related parties is an ordinary price, which is said to be at arm's length price. And hence, in that case, there would not be any problem to the company, because the company is not losing anything by selling that product. Usual selling price of the product is 10. The product is being sold by the company even to the related party at only 10. In that case, there would not be any loss to the company. In that case, it is said that the transaction entered by the company with the related party is in the ordinary course of business and at arm's length price. For example, the usual selling price is say 10 rupees, but the company sold it to a particular party at only 1 rupee, and that party is a related party. Example, he is my director. I usually sell this item at say 10 lakh rupees, but I sold this item to my director only at 1 lakh rupees. In this case, can you say that the price charged by the entity is reasonable? Why the price charged by the entity is unreasonable? Because the party with whom the company wants to enter into a sale contract is a related party to the company, and the company wants to provide some advantage, some undue advantage to the related party. The company wants to provide some undue advantage. What is that? Undue advantage to the related party. When you want to provide some undue advantage to the related party, what may happen? You will try to provide the product at a lower price to the related party. సో అంటే ఏమన్నా తప్పు చేసినా వెళ్తా అంతే. దీనికన్నా నాకు అది ఇంపార్టెంట్, అందుకని దానికే వెళ్తా. సరే, ఎక్కడున్నావు? What is that? So when the price charged is not reasonable, when the price charged is not reasonable, then it is a loss to the company concerned. The company sold an item worth rupees 10 lakhs to their director at only 1 lakh rupees. In that case, it is a loss to the company as well as loss to the shareholders of the company. That is the reason why, as an auditor, we are required to focus more on transactions entered by the company with related parties. For that only, Accounting Standard 18 has been introduced by the CA Institute, and SA 550 has also been introduced by the CA Institute. Both deals with the concept of related parties. Section 188 of the Companies Act has also been introduced, which also deals with the concept of related parties and related party transactions. That is the importance of related parties and related party transactions. What you need to understand from this entire discussion is that where the company under your audit has entered into a related party transaction, the transaction so entered by the company with the related party may have been entered at the arm's length price. If such transaction has been entered at arm's length price, there would not be any problem to the auditor concerned. However, if the auditor identifies that the transaction has not been entered at arm's length price, then what is the meaning of that? The company is trying to provide some undue advantage to the related party. When the company under your audit is providing some undue advantage to the others, it is detrimental to the interest of the company. When it is detrimental to the interest of the company, it will be detrimental to the interest of the shareholders also. That is the reason why, as an auditor, we are made responsible to focus more on related parties and related party transactions, and a particular duty on the part of the auditor relating to reporting responsibilities of the auditor were also given under CARO relating to related parties. So that is the reason why I am telling you all these things, keeping in view the reporting responsibilities of the auditor under CARO under the heading related parties. So, if the transaction entered by the company with the related party is in the ordinary course of business, there is no problem to the auditor. But if the transaction has been entered by the company with a related party is not at arm's length price, then it is a problem to the auditor. Therefore, as an auditor, we need to consider related parties and related party transactions. Okay, done. And before considering the same by the auditor, they should be considered by audit committee. So whenever any company wants to enter into dash, whenever any company wants to enter into a transaction with related parties, first of all, it should be brought by the company to the attention of the audit committee. The details of the transaction shall be thoroughly verified by the audit committee, and only when the audit committee satisfies, that the price at which the company wants to enter into a transaction with a related party is reasonable, then the audit committee will approve the transaction. Later on, the company can enter into that transaction. So checking whether transactions entered by the company with a related party are at arm's length price or not is the duty of dash audit committee. That is one of the functions of audit committee. Now you can read that, you will have better understanding of that point. Point number D. It is the responsibility of dash audit committee to approve. It is the responsibility of the audit committee to approve transactions of the company with related parties. If some subsequent modifications were made to the transactions with related parties, such modifications to the related party transactions should also be approved by audit committee. Original transaction with the related party, any modified transaction entered by the company with the related party, every transaction entered by the company with the related party is required to be approved by dash by audit committee. Without the approval of the audit committee, company cannot enter into related party transactions. I will try to explain you who are related parties under section 188 while having a discussion on CARO, although I am not required to explain those things to you. Because if you do not understand who is a related party, what is the point in explaining the duties of the auditor under the heading related parties? So although it is a waste of time to you, although you do not know it, I will try to explain the concept of related party and related party transaction in detail under CARO very soon, right? So what are the functions of audit committee? recommending for appointment, remuneration and terms of appointment of auditors of the company is the duty of the audit committee. Reviewing and monitoring auditors' independence and performance and effectiveness of audit process. Examination of financial statements and auditors' report thereon. Approval of related party transactions or approval of subsequent modifications to related party transactions is also said to be the function of an audit committee. The next one is scrutiny of intercorporate loans and investments. That I will explain you under section 186 of the Companies Act under CARO. Sometimes a company wants to take some loans from other companies. A company wants to make investment with other companies. All such transactions shall first be scrutinized by whom? By the audit committee. If the audit committee says yes, then only the company is required to enter into such a transaction. Then the next one is evaluation of internal financial controls. This point is somewhat difficult, but fortunately I explained it to you in the past while explaining section 138 of the Companies Act. Can anybody of you recollect what are the objectives behind appointment of an internal auditor? I said you there are three objectives behind appointment of the internal auditor. What are they? Objective number 1, internal auditor shall provide an assurance to the top level management that the data on which management is relying upon to take key managerial decisions is accurate, valid and reliable. Objective number 2, supervising internal controls. Objective number 3, prevention and detection of non-compliance with the provisions of applicable laws and regulations. While explaining you the term monitoring of internal controls, I said to you that management is made responsible for designing internal controls, implementing internal controls and maintaining internal controls. Maintenance of internal controls is also called as supervising internal controls. You are not only made responsible to establish internal controls or to implement internal controls, you are made responsible also to supervise such internal controls at periodical intervals. If you fail to supervise, internal controls would not operate effectively. You may have designed a very good internal control system. Such a system would have been implemented by you. After all, the system designed and implemented by you is required to be followed by your employees. If your employees are not following the system, although the system that you have established is a very good internal control system, it's of no use. Therefore, it is the responsibility of the management not only to design and implement internal controls, but also the responsibility of the management to check whether employees of the organization are actually following the control established by them. That checking of whether the employees of the organization are actually following the controls established by the management or not is technically called as supervising or monitoring internal controls. Management may not have adequate time to do that, and hence generally this task of supervising internal controls will be delegated by the management to a person called as internal auditor, or else you could delegate the same to dash audit committee. Audit committee, now read it. Evaluation of internal financial controls. You can call it in either way, internal controls or internal financial controls. They both mean one and the same. We are soon going to have a discussion on risk assessment and internal control chapter. Then I will explain you in detail about what is internal control, internal financial control and internal controls over financial reporting. Those two are different, but internal controls can also be called as internal financial controls. Why internal controls can also be called as internal financial controls? Although that is not the matter that we are discussing now, I will try to explain that point also. Internal controls are of two types. The first one is financial controls. The second one is non-financial controls. What is that? Financial controls and non-financial controls. The best example of a non-financial control is quality controls that were established in an organization to check whether the product being manufactured by us is qualitative or not. You may have established some controls. So such controls are technically called as quality controls. They are nothing to do with finance and financial statements. It purely depends. It purely deals with whether the product manufactured by you is qualitative or not. Such controls will not have are not relatable to finance and other allied activities. Therefore, such controls are technically called as dash non-financial controls. The best example of a non-financial control is quality control. These can also be called as administrative controls. So internal controls are of two types: financial controls and non-financial controls. As an auditor, we need to focus more on dash. We are nothing to do with non-financial controls. That is the reason why sometimes internal controls are also called as internal financial controls. They both mean one and the same. You call it either as internal controls or as internal financial controls. Followed or not? That's it. Evaluation of internal controls or internal financial controls and risk management systems is the responsibility of whom? Audit committee. And the next point is very easy to understand. You know it very well. If you do not know it, do not worry. I will try to explain it in detail so that it will be useful for Caro as well. It will be useful for Caro also. Monitoring. Audit committee is made responsible to monitor the end use of funds. The end use of funds raised through public offers and related matters. What is meant by end use of funds? There are two duties to you as an auditor under Caro. The first one deals with end use of term loans, and the second one deals with end use of issue proceeds. The first one deals with the end use of term loans and the second one deals with the end use of issue proceeds. These two are the duties of the auditor under Caro. As said earlier, section 139, section 143, subsection 11. Section 143, subsection 11 deals with Caro. When 143 subsection 11 is made applicable to a company, as an auditor of the company, you are required to make an inquiry into 21 points that were mentioned under Caro. After having an inquiry into those 21 points, if the auditor satisfied with those aspects or has not satisfied with those aspects, the same is required to be reported by you to the shareholders of the company that you have satisfied with the matter or that you have not satisfied with the matter. When I say this, at least some of you people would be able to recollect what we discussed under 143 subsection 1 of the Companies Act. Under section 143 subsection 1 of the Companies Act, as an auditor, you are made responsible to make an inquiry into 6 aspects, that were mentioned in 143 subsection
Recording
1.
stopped.
After having an inquiry into those 6 aspects, if the auditor satisfies with those aspects, there is no further reporting responsibility on the part of the auditor. If the auditor has not satisfied, then there is a reporting responsibility. So if the auditor satisfies, there is no reporting responsibility. If the auditor has not satisfied, then only there is a reporting responsibility to the auditor, and all these things were covered by us under dash. Under 143 subsection 1, similar to 143 subsection 1, when 143 subsection 11, that is Caro, is made applicable to the company, you are required to make an inquiry into 21 matters that were mentioned under Caro. After having an inquiry into those 21 matters, if the auditor is satisfied with the same, make a report to the shareholders that you have satisfied. If the auditor has not satisfied, make a report to the shareholders that you have not satisfied. That means whether you have satisfied with the same or has not satisfied with the same, there is a need to make a report to the shareholders. Have you observed any material difference between the responsibilities of the auditor under 143 subsection 1 and 143 subsection 11? What is the major difference between reporting responsibilities of the auditor under 143.1 and 143.11? Under 1, if you satisfy, there is no need to report. If you have not satisfied, there is a need to report. Under 11, whether you have satisfied or not satisfied, the same is required to be reported to the shareholders. Are you satisfied with my explanation? You have to say either yes or no. If the reporting is under 143 subsection 11. Are you satisfied with my explanation? You have to say only no. If you want to say yes, keep silent. Keep silent. That is requirement under section 143 subsection 11. If you are made responsible to make a report under 143 subsection 1 about whether my discussion is satisfactory to you or not, if you are satisfied with my discussion, keep quiet. If you do not satisfy, make a report. That is 143 subsection 1. Under 143 subsection 11, if you satisfy, report it. If you do not satisfy, report it. That is the difference between the reporting responsibilities of the auditor under 143 subsection 1 and under section 143 subsection 11. Under CARO, there are two duties to the auditor. The first one is end use of term loans, and the second one is end use of issue proceeds. Let us first have a discussion about end use of term loans, which is not related to our section 177 discussion. What is a term loan? That has already been explained to you. I don't want to even repeat it. Term loans are generally taken either for the purpose of purchase of fixed asset or for the purpose of construction of fixed asset. Where the company under your audit has taken a term loan, where the company under your audit has taken a term loan, it is the duty of you as an auditor to check whether the proceeds, of such term loan, have been utilized by the company only for the purpose, for which they were taken. Only for the purpose for which they were taken. I repeat, this point is very easy to understand. Nothing difficult in this point. You can just go through the point, thereby you can understand the point as it is. Where the company under your audit has taken some term loans, it is your duty as an auditor to verify whether the amount of such term loan, otherwise called as the proceeds of such a term loan, have been utilized by the company under your audit only for the purpose for which they were taken. For example, there is a company called as A Limited. You were the auditor of A Limited. A Limited has taken a loan of 12 crore rupees for the purpose of construction of factory building. Now that loan is a term loan. Why I am classifying it as a term loan? Because the loan has been taken by the company for the purpose of construction of factory building. With the proceeds of the loan, the company wants to create a fixed asset. Therefore, such loan taken by the company is nothing but a term loan, otherwise called as a long-term loan. What is your duty as an auditor under CARO in this behalf? You need to check whether this amount of 12 crore rupees granted by the bank to the company for the purpose of construction of the factory building has been used by the company only for the said purpose. If you verify and satisfy that okay, the entire amount of 12 crore rupees has been utilized by the company only for the purpose of construction of factory building, the same is required to be reported by you. If you identify that some portion of the funds have been diverted for some other purpose, if you have identified that some portion of the funds have been diverted by the company for some other purpose, the same should also be reported. For example, if the entire 12 crores is used for construction of factory building, report it. Out of 12 crore rupees, 10 crores only has been utilized for the purpose of construction of the factory building. Another 2 crore rupees has been utilized by the company for the purpose of meeting their working capital requirements, or say for the purpose of making loan repayment, of its subsidiary company. What is the purpose for which the company has taken this term loan? what is the purpose for which the company has taken this term loan? For the purpose of construction of the factory building. What is the purpose for which the funds have been utilized? Either for the purpose of meeting their working capital requirements or for the purpose of making loan repayment of their subsidiaries. The purpose for which they have taken has not been the funds have not been utilized for the purpose for which they were taken. Some portion of the funds have been diverted by the company. Some portion of the funds have been diverted by the company. So, there is every chance that the company may divert some portion of the funds. That is the reason why, as an auditor, we are made responsible under CARO to check whether the company has utilized the entire amount of term loans only for the purpose or purposes for which they were taken. This is technically called as end use of term loans. Have you understood what exactly is the duty of the auditor under the heading end use of term loans? If yes, can you please specify what is the duty of the auditor? What is the duty of the auditor under the heading end use of term loans? It is the duty of the auditor to check whether the proceeds of the term loans have been utilized by the company only for the purpose or purposes for which they were taken. If you observe diversion of funds, report the same to the shareholders. That is the duty of the auditor under the heading end use of term loans. The next one is end use of issue proceeds. What is that? End use of issue proceeds. What is meant by end use of issue proceeds? When the company issues some shares either through IPO or through FPO, the company is required to issue a prospectus. This is well known to you. Yes or no? The company is required to issue you a prospectus. Yes or no? In that prospectus, the company should clearly mention. In that prospectus, the company should clearly mention about the purpose or purposes for which the company is going to make use of the issue proceeds. The company is going to make use of the issue proceeds. What is meant by issue proceeds? Monies that are received. Monies that are received by the company through issue of securities. Monies that are received by the company through issue of securities. That security may be either shares or even debentures. Either shares or even debentures. The purpose for which such issue proceeds are going to be used by the company shall be mentioned by the company in a paper called as a prospectus. For example, the company is issuing securities worth 10 crore rupees. The company is issuing securities worth 10 crore rupees. In the prospectus, the company has to state like this. Out of this 10 crore rupees, we are going to make use of 4 crore rupees for the purpose of construction of factory building. 3 crore rupees are going to be utilized for the purpose of construction of office building. Another 2 crore rupees will be utilized for the purpose of loan repayment. For the purpose of loan repayment. Out of the remaining amount, 60 lakh rupees is to be utilized for the purpose of say redemption of debentures. And another 40 lakh rupees is to be utilized by the company for the purpose of meeting its working capital requirements. So the company has clearly mentioned about the purpose or purposes for which it is going to make use of the issue proceeds. Then what is our duty as an auditor? It is our duty as an auditor to verify whether the company had actually utilized such issue proceeds as per the purpose or purposes that were mentioned in the prospectus. Simply speaking, if you were the auditor, you should start comparing dash with dash. You can take prospectus from the company. Then you can take the statement prepared by the company with respect to actual utilization of issue proceeds. Then start comparing actual utilization of issue proceeds with what is mentioned in the prospectus. if the auditor satisfies that every penny of rupee has been expended by the company for the as per the purpose or purposes mentioned in the prospectus, report the same to the shareholders. If you observe any deviation, again report the same to the shareholders. That is the duty of the auditor under the heading dash, end use of issue proceeds. Why I have explained you 2 points instead of explaining only 1 point, that is end use of issue proceeds. They both are one and the same. The content of those 2 points is one and the same. What is your duty as an auditor in the first case? Verifying whether the proceeds of the term loans have been utilized only for the purpose or purposes for which they have been taken. What is your second duty? Verifying whether the proceeds of the issue of securities have been utilized by the company only for the purpose or purposes for which they were issued. So both the duties of the auditor under both the headings is one and the same. The heading is different, but the duty of the auditor is one and the same. That is the reason why those 2 points have been explained to you simultaneously, although it is not required for me to explain the first point as of now. As of now, there is no need to explain the first point, but because there is a link between these 2 points, 2 points were explained to you. Now go through the functions of the audit committee. Point number A, recommending for appointment. Point number B, reviewing and monitoring auditors' independence and auditors' performance. Point number C, examination of financial statements. Point number D, approval of related party transactions, including subsequent modifications to the related party transactions. Point number E, scrutinizing intercorporate loans and investments to ensure that provisions of the Companies Act have been complied with in respect of taking such loans. Then evaluation of internal financial controls is also said to be the responsibility of audit committee if it is given to them. And the next one is monitoring the end use of funds raised through public offers and related matters. Sometimes the company under your audit may want to acquire the business of some other company. In that case, valuation of undertakings or assets of such companies may be the responsibility of the audit committee. Or else, sometimes the company wants to sell off some portion of its business. In that case, at how much value should the company offer that business? That will be determined by dash, by audit committee. So everything will be carried out by the audit committee first. Later on, the board of directors had to carry out that point. Otherwise, the transactions entered by the company cannot be said to be valid. This is all about section 177 of the Companies Act. The reporting responsibilities of the auditor under paragraph number 3 of CARO 2020. Paragraph number 3 of CARO 2020. What are the matters to be communicated by the auditor as per CARO? The first one is PPE, property, plant and equipment. There are 5 duties to the auditor. How many duties are there to the auditor? There are 5 duties to the auditor under PPE. Let us first discuss about duty number 1. Duty number 1 is the auditor should verify whether the company under your audit has maintained proper records relating to its PPE. I repeat, as an auditor, you need to verify whether the company under your audit has maintained proper records relating to its property, plant and equipment. Although the term proper records has been used in CARO, it has not been defined anywhere in CARO. So the term proper record is used in CARO, but it has not been defined in CARO. Then how the auditor could know what is meant by proper record? Taking its natural meaning. Taking its natural meaning. When the company under your audit, is maintaining a separate register, when the company under your audit is maintaining a separate register, let us call it as PPE register. When the company under your audit is maintaining a separate register called as PPE register, and when the company is recording the details of all of its PPE in such a register continuously, that means if such register is being updated by the company continuously as and when there is a transaction relating to PPE, then as an auditor, you can satisfy that the company is maintaining dash. So you need to ascertain whether the company under your audit is maintaining proper records relating to PPE. In order to ascertain whether the company is maintaining proper records, auditor should ask the company to provide him with the PPE register maintained by the company. If the company is maintaining a PPE register and if the company is updating the details in the PPE register, then you can say as an auditor, you can satisfy as an auditor, since PPE register is being maintained, since all the details of PPE are being recorded in that PPE register, also it is said that the company is maintaining proper records relating to PPE. What details should the company maintain in such PPE register? Several details are generally maintained by the company in PPE register, like serial number of the asset, name of the asset, date of purchase, serial number, name of the asset, date of purchase, quantity, what is that? Quantity, original cost, additions, sales, depreciation, accumulated depreciation, closing balance, and location. What is that? Location. This location and quantity were specifically mentioned under CARO. Remaining details are also generally maintained by companies in a register called as PPE register. So if you are made responsible to maintain, a separate register called as PPE register, what details would you record in that PPE register? Serial number, name of the asset, date of purchase, quantity, original cost, additions, sales, depreciation, accumulated depreciation, closing balance. Most importantly, what is the situation or location of the asset? Location can also be called as a situation of the asset. All these details must have to be maintained by the company in a separate register called as PPE register. Then only as an auditor you can satisfy that the company is maintaining proper records. And most importantly, such a register must contain two columns. They are quantity and situation. Why such PPE register should contain a column called as situation? You know it very well that management of an entity is made primarily responsible. Management of an entity is made primarily responsible for physical verification of any of its assets. It is the primary responsibility of the management to make physical verification of any of their assets, whether it be PPE, property, plant and equipment, or it be investments, or it be current assets like stock, cash, whatever be the asset, whatever be the type of the asset, once the organization is holding some assets, it is the primary responsibility of the organization to make physical verification of such PPE. It is the primary responsibility of the management. It is the primary responsibility of the management to make physical verification of all of its assets. To make physical verification of all of its assets. Assets may include property, plant and equipment. Assets may include investments. Assets may include current assets like stock, cash in hand, etc. Every asset is to be physically verified by the management. It is their primary responsibility. And this physical verification shall have to be carried out by the management at reasonable intervals. So what is the duty of the management? It is the primary responsibility of the management to make physical verification of all of its assets at reasonable intervals. Now, I want to ask you a question. I know very well that nobody is going to provide an answer for this question. What are the objectives? Behind making a physical verification of all types of assets by management? Or why do management is made responsible primarily to make physical verification of all types of their assets at reasonable intervals? In order to achieve two objectives, generally management is required to make physical verification of assets. Objective number one is reconciliation. What is that? Reconciliation between book quantities and actual quantities. Reconciliation between book quantities and actual quantity. What is the actual quantity of the asset? And what is the quantity as appearing in the books of account? Is book quantity and actual quantity are matching or not? This is the point that management should try to ascertain by making physical verification. So in order to reconcile book quantities with actual quantities, management do perform a procedure called as physical verification of all of their assets at periodical or at reasonable intervals. This is said to be objective number one. I will try to elaborate this objective further. Let us assume that Masterminds is a private limited company. Let us also assume that the organization is maintaining a register called as PPE register. In that register, it specified that the organization is having furniture. The quantity of the furniture held by the organization is say 2000 units. Let us assume the total number of chairs held by Masterminds is 2000 units. This is book quantity as appearing in dash register, PPE register. Now they got it out whether these 2000 chairs are really available or not. So they started making a physical verification of all the chairs. After completion of physical verification, they found that only 1800 chairs are available out of a book quantity of 2000 chairs. So they have identified a difference. This difference is technically called as discrepancy. They have identified a difference or discrepancy between book quantity and actual quantity. What is the book quantity in our example? 2000. As per books, 2000 chairs should have been present. But the actual quantity of chairs is only 1800. Therefore, there is a difference or a discrepancy of 200 chairs. Now, when there occurs a difference or a discrepancy, management will try to investigate into the reasons. On investigating into the reasons, management could identify a particular employee who was involved in stealing these 200 units of furniture. When the management identified a particular employee who has stolen these 200 chairs, management will give severe punishment to that employee. When the management gives severe punishment to an employee, it will create dash in the mind of other employees. It will create a fear in the mind of other employees. When the management is able to create a fear, what is the advantage of that? The other employees may not try to involve in the same activity in future. By that, management is able to prevent. The occurrence of frauds. Now, by making physical verification, you have detected a fraud. When you detected a fraud, you made an inquiry. On inquiry, you have identified the culprit. You have taken severe action on that person. So it creates a dash in the mind of other employees. Fear. So the possibility of occurrence of frauds in future is prevented. That means management achieved two things. The first one is they detected the fraud, and the second one is they prevented the further occurrence of fraud. These two things happens only because management has made physical verification of its property, plant and equipment at reasonable intervals and tried to reconcile dash with dash, book quantities with actual quantities. So by this, what you need to understand is, okay, if we were the management, If we perform physical verification, we would be able both to prevent the occurrence of frauds as well as to detect the occurrence of frauds. Therefore, it is generally said that physical verification is a procedure which is considered as a part of dash internal control systems. Physical verification of asset is a part of internal controls. If you make physical verification of your assets, it is said that you are establishing very good systems of internal controls. As a part of internal control systems, physical verification should be made a part of internal control systems so that internal control systems may be said to be more effective. That is objective number 1 behind making physical verification of any asset by the management. The first objective is reconciliation between book quantities and actual quantities. The second objective is already explained to you. The second objective is safeguarding the assets. Safeguarding assets. How do they safeguard assets? By making physical verification, by taking action on those employees who are involved in fraud, by creating a fear in the mind of the employee. The organization would be able to safeguard or protect their employees from stealing, right? So, when the management identified this difference of 200 and when the management failed to detect the person involved, in this fraud, what the management could do. Book quantity is 2000 units. Actual quantity is 1800 units. There is a difference of 200. Management made investigation. Management is unable to identify the employee who was involved in fraud. In that case, what the management is expected to do? Actually, management has already shown the value of 2000 shares in their balance sheet. Each share is having, say, a book value of 100 rupees. So, value of shares shown by the management in their balance sheet is 2 lakh rupees. What is the actual number of shares? 1800. So, what is the book value of each and every share? 100. So, what should be the value of the shares held by the organization? 1,80,000. You are reflecting a value of 2 lakhs as the value of the shares in the balance sheet, whereas the actual value is only 1,80,000. Then what about this 20,000 rupees? This 20,000 rupees is nothing but a loss. This loss should be recognized by the organization in their profit and loss account. This loss of 20,000 is required to be debited to profit and loss account and credited to asset account. Yes or no? Credited to asset account. For your sake, I will try to show you how furniture account appears in the ledger of masterminds after this adjustment. To balance brought down 2 lakhs. By balance carry down 1,80,000. What about the remaining 20,000? It is a loss. It has been debited to profit and loss account and credited to furniture account. So, entire amount of 20,000 has been recognized as loss. Now, the value of the furniture is being reflected in their balance sheet, not at 2 lakh rupees, but at 1,80,000 rupees. This is when the management is unable to identify the person who was involved in stealing physical furniture. Sometimes the management would be able to identify the person who was involved in stealing the furniture. The person has been identified. All the chairs have been recovered. I am taking one chair each every day and I have been identified and all 200 chairs have been recovered. Unfortunately, the chairs are not in working condition. Therefore, the management of the entity has sold the chairs to a scrap dealer, and by selling chairs to the scrap dealer, they are able to get an amount of 1,000 rupees. In that case, if you were the accountant of Masterminds, how do you adjust that amount in the furniture account? What is the balance, opening balance of furniture? 2 lakhs. What should be the closing balance of the furniture? 1,80,000. So what about the remaining 20,000? It is loss. Out of 20,000, you are able to recover an amount of 1,000 rupees by selling the recovered furniture as scrap. So that is required to be credited to furniture account. What about the remaining 19,000? It is nothing but a loss. So that 19,000 will be debited to profit and loss account and credited to furniture account. This is the way in which you need to make adjustments. This is the way in which you need to make adjustments to your books when you identify that there is a difference between book records and actuals, between book quantities and actuals. What happens if these adjustments were not made by the management? What happens if these adjustments are made by the management? The financial statements of the entity will not reflect a true and fair view. That is what you need to understand. Now tell me, what are the objectives behind making a physical verification of different assets by management? Objective number 1 is reconciliation between book records and actuals. On reconciliation between book records and actuals, if the organization identified any difference, that difference shall be properly adjusted or dealt with in the books of account. And on identifying any difference, management would try to investigate into the reasons. Management would be able to identify the person who was involved in fraud, may take severe action on that person. That will create fear in the mind of the other employees. By that, the possibility of employees involving in stealing assets would be very, very less in future. That means you are able to prevent frauds, thereby you are safeguarding your assets. Therefore, these two are generally said to be the objectives behind making physical verification. The first one is reconciliation and making adjustments to the accounting records. And the second one is safeguarding or protecting the assets of the organization. And this physical verification is to be done by the management at reasonable intervals. Although the term reasonable interval is used in CARO, it was not defined in CARO. Taking its natural meaning, generally reasonable interval in relation to any asset is once in a year. Generally reasonable interval in relation to any asset is once in a year. That means at least once in a year, the entity is under obligation to make physical verification of the assets, whether it be property, plant and equipment, or it be investments, or it be current assets like cash, stock, whatever be the asset, every asset is required to be physically verified by the management at least once in a year, because once in a year is technically said to be a dash interval, reasonable interval. However, it may not be practically possible for the management to make physical verification of PPE once in a year, particularly in case of plant and machinery. There may be a very big plant and machinery. 100 plant and machineries may have been concealed in that big plant and machinery. If you want to make a physical verification of those plant and machineries which are concealed in a big plant and machinery, is it possible for you to make physical verification when the machine is running? No. In that case, what should you do? You need to stop the entire production process. Then you need to check the plant and machineries which are hidden in a very big plant and machinery, where it is a loss of production and loss of revenue to the organization. Therefore, keeping in mind those practical problems, it is said in the guidance note that with respect to PPE, reasonable interval may be either once in a year, or once in 2 years, or at least once in 3 years. Therefore, the entity, the company under your audit should have made physical verification of its PPE at least once in a year, if not possible once in 2 years, if not possible at least once in 3 years. Followed or not? Now, let us read what is given in the material. Whether the company is maintaining proper records showing full particulars, including quantitative details and situation of property, plant and equipment. Why situation is to be mentioned? If you want to make physical verification, you should know where the plant and machinery is lying, where the asset is lying. Sometimes the entity is the owner of the asset, but the asset may not be under the control of the entity. For example, you are my managing director. At the time of appointment of the managing director, the company entered into a contract whereby the company said that they will provide accommodation to the managing director and they will provide an AC machine at the residential quarters of the managing director. An AC machine has been purchased by the company which is fitted in the residential quarters of the managing director. Who is the owner of that AC machine? Company. And where it is lying? At the residential quarters of the managing director. If the company wants to make physical verification of that AC machine, what the company should know? Where the machine is lying. That is the reason why the term situation is also required to be maintained in a register called as PPE register. So what you need to verify as an auditor is whether the company under your audit is maintaining proper records with regard to property, plant and equipment. Such proper records shall include full particulars including quantitative details and situation of property, plant and equipment. If you satisfy that the company is maintaining proper records, report the same. If you find that the company is not maintaining proper records, report the same. This proper record is a concept which is made applicable not only with respect to PPE but also with respect to dash intangible assets. So what is your duty as an auditor? What is your first duty as an auditor under the heading PPE? You need to check whether the company under your audit is maintaining proper records both with respect to dash and dash, both with respect to PPE as well as with respect to intangible assets. Such registers should always include details like quantity. Quantity and situation is made applicable only for tangible assets and not for intangible assets. This is duty number 1. Have you understood duty number 1 of the auditor? For some time, ignore intangible assets. What is your duty as an auditor in respect of PPE? You need to verify whether the company under your audit is maintaining proper records relating to PPE. Such records should include all particulars including dash and dash, including quantitative details and situation of fixed assets. I have explained you 11 columns which are to be maintained generally in PPE register. They have given you only 2 columns. What are they? Quantity and situation. Then that is duty number 1 to the auditor, proper records. Now duty number 2, this is B, whether these PPE, this point is applicable only for PPE, not to intangible assets. Whether these PPE have been physically verified by the management at reasonable intervals, whether any material discrepancies were noticed on such a verification, and if so means when there are material discrepancies, whether the same have been properly dealt with in the books of account. In order to ensure that every one of you will have an understanding of the term properly dealt with, I have given you an example wherein I have drawn the furniture account in 2 different situations. In the first case, you treated the entire amount of 20,000 as loss, whereas in the second case, you have treated only 19,000 as loss. Have you understood duty number 2? So what is duty number 1? You need to check whether management has maintained proper records or not. What is duty number 2? You need to verify whether management has made physical verification of their PPE at reasonable intervals, and any material discrepancies arising on such physical verification should have been properly accounted for or dealt with by the management. Whether that has been done by the management or not is the point to be verified and reported by you as an auditor. Okay? Any doubts with regard to duty number 1 and duty number 2 under the heading PPE? What is duty number 1? Proper records. What is duty number 2? Physical verification and adjustment of material differences not by the auditor but by the management. Duty number 3. This is a very good point and a difficult point to understand. Whether if the entity under your audit is having some immovable properties. If the entity under your audit is having some immovable properties, you need to verify the title deeds of such immovable properties. You need to verify the title deeds of such immovable properties. Why should you verify the title deeds of an immovable property? If you check title deeds of the immovable property, you can find the name of the company. You can find the name of the company in the title deeds. If you find the name of the company in the title deeds of the immovable property, you can conclude that the company under our audit is the real owner. The company under our audit is the real owner of that immovable property, which is being reflected in the balance sheet. Which is being reflected in the balance sheet. Let us assume that 10 immovable properties have been reflected. 10 immovable properties have been reflected by the management in their balance sheet. Now, if you were the auditor, what is your duty? You need to verify the title deeds of all the 10 immovable properties. Why should the auditor verify title deeds of all 10 immovable properties? To ascertain whether such property is really held in the name of the company or not. To ascertain whether the company is the owner of that property or not. If the company is not the owner, can the company show that property in their balance sheet? No. So when the properties are reflected in the balance sheet, it is our duty as an auditor to verify whether such properties really belong to dash. Really belongs to the company under audit. For that, you need to verify dash title deeds. If you find that all the 10 properties are in the name of the company, there would not be any problem to the auditor. You can report the matter to the shareholders. However, sometimes it may so happen that the auditor is able to identify that out of 10 immovable properties which were reflected in the balance sheet of the company, the name of the company is appearing only in 9 title deeds. That means company is found to be the owner of only 9 properties. The 10th property is not in the name of the company. Title deeds do not contain the name of the company. But still the company is claiming that they are the owners of the property. Still the company is claiming that they are the owners of the property. Now read the point and you can make a comment on that point after reading it. If you do not make any comment, I will ask you a question and you can provide answer for that question in tomorrow's session. Right? Whether the title of immovable properties are held in the name of the company. If not, provide the following details. So in the given case, what happens is the company is not the owner of 10 properties. It is the owner of only 9 properties. For the 10th property, company is not the owner. Some other person is the owner of the property, but the property is held by the company. That means the company is a benami of the property of some other person. Company is not the owner of the property. Somebody is the owner of the property, but that property is being reflected in the balance sheet of the company and the company is claiming that they are the owners of the property. They are not the real owners of the property. Real owner is different. Company is just showing that they are the owners of the property, but they are not the owners of the property. If you find that, what is your duty as an auditor? In that case, with reference to that property, that single property, you need to report the following. What is the property in respect of which dash is not in the name of the company? Title deeds are not in the name of the company. What is the gross carrying value of the property? And in whose name the property is held? In whose name? The company is not the owner, but the company is reflecting the property in its balance sheet. So in the title deeds, the name of the company is not appearing. In whose name the property is appearing? In whose name the title is appearing? Held in the name of that property is. Are you able to follow me? Or else we could say like this. The company is the owner. The company is the owner. The company has not purchased the property on its own name. the company purchased the property not in his own name, but in the name of some other person. That other person may be any person, including promoter, director, or relative of that promoter or director, or in the name of employee or any other person's name. So company may be the owner, but the property may not have been purchased by the company in its name. It has been purchased by the company in some other's name. So that some other person may include promoter, director, or the relatives of the promoter or director. In such case, whether that person on whose name the property is held is the promoter of the company or the director of the company or the relative of the promoter or director or the employee of the company. The period held and reason. You are claiming that you are the owner of the property, but why the title deeds are not in your name? Why the title deeds of the property are being held, are not being held in the name of the company and being held in the name of some other persons? The reasons for the same should also be reported by the auditor. Now, I will try to conclude this point. Let us have a further discussion on these points in the next session. So where the company is claiming that they are the owners of 10 immovable properties, and where the auditor finds the name of the company in only 9 title deeds, the company is claiming that they are the owners of the 10th property also, but the name of the company is not appearing in the title deeds. Somebody's name is appearing in the title deeds. That means the company is the owner, but the property is not held in the name of the company, but has been held in the name of others. In that case, you need to report things like dash, 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 and dash. The description of the property held by somebody else on behalf of the company, the gross value, carrying value of the property, in whose name the property is held, whether that person is a promoter, director, or relative of a promoter or director or employee, what is the period for which the property is being held by that person, and why the company is claiming it as owner, and why not the name of the name of the company is not being present in the title deeds, why the company purchased the property in the name of some other person. The reasons for the same, all these things are required to be provided by the auditor under CARO. This is about point number C. There is a difference between point number C and point number E. That is the reason why, although I used the term benami initially, I withdrawn that word benami. That benami is applicable more for point number E, not for point number C. So what is point C? Please conclude. The company is the owner, but the property has not been purchased by the company on its own name. It has been purchased by the company in some other's name. In that case, you need to give details of such property for which dash is the owner but not held in the name of dash. Company is the owner, but the property is not held in the name of the company. The details of such property for which the company is the owner but not held in the name of the company is required to be provided by the auditor. This is the third reporting responsibility of the auditor in relation to PPE. What is the first one? Proper records. What is the second one? Physical verification and adjustment of material differences. What is the third one? Title deeds of the immovable property. If not held in the name of the company, inquire on whose name the property is held, and the details of the property held by some other person should be provided by the auditor by way of some reporting responsibility as a part of CARO. Number 9. Under point number 9, the auditor is required to focus on repayment of loans taken by the company. Repayment of loans taken by the company. The company under your audit may have taken loans. Whether the company under your audit made repayment of such loans or not is the point to be focused under point number 9. Under point number 3, the auditor checked whether repayment of principal and payment of interest are regular or not. That we discussed under point number 3, C. What is point 3? What is point 3? Loans granted by the company. What is point number C under point 3? In respect of loans granted by the company, the auditor should verify whether schedule of repayment of principal and payment of interest has been stipulated, and whether repayment or receipts are regular. That means whether the parties who had taken loans from the company started making repayment of the loans regularly or not is the aspect that we looked into in point number 3C. Now in point number 9, the company under your audit may have taken loans. The company under your audit is required to make repayment of such loans. As an auditor, you need to focus on whether the company under your audit which has taken loans has defaulted in repayment of loans or other borrowings or in the payment of interest thereon to any lender. To any lender. The term any lender is very, very important. In CARO 2016, a different terminology has been used and the entire terminology has been changed in CARO 2020. Therefore, you must focus on the term any lender. So, the entity may have borrowed, the company under your audit may have borrowed some amounts from any lender. Under this heading, it is your duty as an auditor to verify whether the company under your audit is making repayment of principal as well as payment of interest to such lenders as per the repayment schedule. So, receipt of repayments has been checked under point 3. Payment is being checked under point 9. Again, read it. Whether the company has defaulted in repayment of loans or other borrowings or in the payment of interest thereon to any lender. If yes, what is the meaning of the term if yes? The company under your audit made some defaults either in repayment of loans or in payment of interest which has been taken by the company from any lenders. In that case, the auditor need to report the period. The auditor need to report the period and the amount of default should be reported by the auditor in the format below. The format is like this. Nature of borrowings, including debt securities. This point is very important. Under this heading, the term loans or borrowings also includes dash debt securities. What is the best example of a debt security? Debenture is the best example of a debt security. By this, you must understand that the company, if the company under your audit has issued some debentures and has made some default either in payment of interest on such debentures or in redemption of such debentures within the due date, that will also be covered by the auditor under this heading. Company has taken loan in the form of debentures from general public. The company made default either in redemption of debentures or in payment of interest on such debentures. Debenture is nothing but a sort of borrowing. So the term borrowings, under this heading also includes dash debentures issued by the company. Therefore, you need to focus on whether the company under your audit made repayment of loans and payment of interest to all the lenders including debenture holders. If there is any default, you need to report the period of the default as well as the amount of the default. So that is the importance of the term debt securities. Nature of borrowing, including debt securities. Name of the lender to whom default is made. Lender-wise details to be provided in case of defaults to banks, financial institutions and to government. This point is very important in my view. Soon you are going to get a question on this. Lender-wise details. Actually, your reporting requirement is to report the period. To report the period and amount of default. This period of default and amount of default is not required to be provided by you lender-wise. However, lender-wise details are required to be given in case defaults were made in respect of loans taken from banks, financial institutions or government. In other words, the company under your audit is A Limited. It has taken loan from another company called as B Limited, which is termed as intercorporate loan, it has taken a loan from a bank, it has taken from 5 banks, it has taken a loan from 2 financial institutions, it has taken some loan even from central government. Unfortunately, the company defaulted in making repayment of all these loans. In that case, the auditor is expected to provide lender-wise details, not in respect of all the loans, but only in respect of loans taken by the company from banks, financial institutions, and the central government. What other details should the auditor report? Amount not paid on the due date, whether it is principal or interest, number of days delay or unpaid, and remarks, if any. So if I were the auditor, instead of providing the lender-wise details only in respect of banks or financial institutions or government, I would prefer giving details in respect of each and every lender. Then only it is easier for the auditor to specify the number of days of delay, are unpaid. Why? For example, in the given case, the company had taken loans from 2 other companies, B Limited and C Limited. For B Limited, the period of default may be only 2 months. And for C Limited, the period of default may be 12 months. Then how it is possible for the auditor to report these things when the auditor is not required to provide lender-wise details? Therefore, although it is mentioned in CARO that lender-wise details are required to be provided only in respect of banks, financial institutions or government, for the sake of clarity, it is always advisable for the auditor to provide lender-wise details in respect of all the borrowings where dash have been made, where defaults have been made. Very good. At least 1 or 2 of you are following. Whether the company has defaulted in repayment of loans or other borrowings or in the payment of interest thereon to any lender. If yes, the period and the amount of default is to be reported by the auditor by following the format that was just now discussed. This is all about duty number A under clause 9. Now clause 10, clause 9B, whether the company is declared as a willful defaulter by any bank or financial institution or other lender. Here also the term other lender is important, but generally banks and financial institutions do declare their borrowers as willful defaulters. What is meant by default and what is meant by willful default? Is there any difference between the terms default and willful default? Default may be made by the borrower either because he is unable to make the repayment or because he is unwilling to make the repayment. Either you are unable to make the repayment or you are unwilling to make the repayment. You are not having an intention to make the repayment. I have taken a loan of 100 rupees from you as a hand loan, and I promised you that I will repay the same within 2 days. Till now, I haven't paid that amount to you. It is not that I am not capable of making repayment of 100. I am not having any intention to make the payment because the amount is so small. So, repayment may not be made either because you are not having an ability to make the repayment or you may not have an intention to make the repayment. When you are not having an ability to make the repayment of the loan, that is somewhat understandable. When you are having ability to make the repayment, but you are not having an intention to make the repayment, then it is more dangerous. Therefore, such cases are termed by banks or financial institutions as willful defaulters. You are having ability to make the repayment, but you fail to make the repayment. Therefore, such parties are technically termed by banks and financial institutions as willful defaulters. In fact, banks do publish the names of willful defaulters in an advertisement in newspapers. If you have carried out any bank audit, then you would have observed that in the loan documentation, a specific declaration will be taken by the banker from the borrower. In that declaration, borrower will say that if he fails to make the repayment willfully, his name will be published in a newspaper, can be published in a newspaper by the bank declaring him as a willful defaulter. So when a person willfully defaults in making repayment of the loan, immediately the banker will give an advertisement in the newspaper saying that so and so party has taken so and so amount of loan from us and failed to make the repayment of the loan. That failure on the part of the party to make the repayment of the loan is not because he is unable to make the repayment, but because he is not willing to make the repayment. He is not having an intention to make the repayment. Therefore, we are declaring him as willful defaulter. I want to ask you one question. What happens if a person has been or if an entity has been declared as a willful defaulter? No other lender will provide any loan to them. Once you are declared as a willful defaulter, you can't get any loan from any other lender. That is the impact of a declaration of a particular party as a willful defaulter. So sometimes the company under your audit may have been declared either by a bank or by a financial institution from whom some loans would have been taken by the company as willful defaulter. If such things happens, then it is your responsibility as an auditor to communicate to the shareholders of the company that your company has been declared by so and so bank or by so and so financial institution as a willful defaulter. Now the question is, how do you identify it? If the auditor goes through the advertisement and the auditor identifies that, okay, this is the company under my audit, this company has been declared as willful defaulter by so and so bank, it is fine. But always it is not possible for the auditor to go through every newspaper to identify whether his client has been declared as a willful defaulter or not. So if you were the willful defaulter, if your client is the willful defaulter, how do you identify whether your client is a willful defaulter or not? Once the client has been declared as a willful defaulter, the same will be advertised by the bank. Not only that, the banker will make a report to CIBIL also. The banker will make a report to CIBIL. Have you ever heard about the term CIBIL? Credit Information Bureau of India Limited. If you consult a bank for getting a loan, the very first thing the banker will do is they will try to evaluate your repayment capability. Assessment of repayment capability is different in olden days. Now it is different. Now bankers are not insisting on providing financial statements by the applicant. Instead, the banker is asking for your phone number, your other details like your date of birth, etc. Then the banker will log into site called as CIBIL site. The phone number and other particulars given by you will be entered in the CIBIL site. Banker will generate a report called as CIBIL report. That CIBIL report will show the repayment capability or creditworthiness of a particular person. If the person gets a minimum credit rating, then that person will be granted a loan. Otherwise, the person will not be granted any loan. So bankers are not going through your financial statements for repayment of your capability of making repayment. Apart from that, bankers are now focusing on CIBIL score also. You can also generate your CIBIL score. Because of the time constraint, I am unable to show you how to generate a CIBIL score. It may take not more than 1 or 2 minutes for generating a CIBIL score. I am having a CIBIL score of around 795 out of 900, not out of 1000. It is out of 900. Anything which is in excess of 600 is said to be an excellent score. Particularly if it is in excess of 750, it is excellent. I have taken almost 11 types of loan till now. For in these 25 years of my practice, I have taken 11 types of loans. Some are personal loans, some are loans against gold, some are housing loans, and so some are loans for open sites, for purchase of open sites, and etc. And all these things have been repaid. Every loan that I have taken from every bank is being reflected in my CIBIL report. Since I repaid all the loans within the time schedules, my score is high. So if I approach a banker for grant of a loan, the banker will simply read my CIBIL score. If it is fine, then the banker will grant me a loan. That is the importance of going through CIBIL report by the banks nowadays. And therefore, when a particular party has been declared by the banker or by the financial institution as a willful defaulter, immediately the bank or financial institution will communicate the same to CIBIL, and CIBIL will tag that particular borrower as a willful defaulter in his report. Once CIBIL tax that borrower as a willful defaulter, that borrower will not get any loan from any other bank or from any other financial institution. So by going through CIBIL site, you can identify whether the entity under your audit has been declared as a willful defaulter. Not only that, by going through general communication or correspondence file, general communication and correspondence file maintained by the company under your audit, sometimes you may be able to identify that your company has been declared as a willful defaulter. When a banker wants to declare you as a willful defaulter, what the banker will do? Banker will send you a notice giving you an opportunity to provide some details or to provide your representations. That notice received by the company from the banker, wherein the banker is asking the company about why the company cannot be declared as a willful defaulter, may have been filed by the company in general communication file. While you are conducting audit of the company, you will certainly go through general communication and correspondence file. If you come across such a notice received by the company either from a bank or financial institution, you can identify that okay, the company made some willful default. That is the reason why the banker has given a notice. In the notice, the banker is asking the company about why they cannot be declared as a willful defaulter. So just by going through the notice received by the company from the banker, you will be able to identify that the company is a willful defaulter. I have explained you two ways through which you can identify whether the company under your audit is a willful defaulter or not. Usually it is very difficult for the auditor to identify whether the company is a willful defaulter or not. That is the reason why I am explaining you some procedures that are required to be followed by you for the purpose of identification of whether the company is a willful defaulter or not. What procedures would you follow as an auditor? Procedure number 1, you can just go through CIBIL site, identify whether the company has been declared as a willful defaulter there or not. Or else the auditor could focus on the general communication or correspondence file. The auditor may find some communication from a bank or a financial institution asking the company about why they cannot be declared as willful defaulter. By that also you can identify whether the company is a willful defaulter or not. Sometimes this aspect may be discussed by the board of directors in their meetings. Therefore, by going through the minutes of the meetings of the board of directors also, sometimes the auditor would be able to identify that the company under his audit has been declared as a willful defaulter. These are all the procedures that are available for you as an auditor to identify whether the company under your audit is a willful defaulter. This point can also be explained within 10 seconds. If the company under your audit has been declared as a willful defaulter, that is required to be reported by you to the shareholders. Over. Whether the company is a declared willful defaulter by a bank, by any bank or financial institution or other lender, that is reporting responsibility B. Next, third one. This point is already covered. This is relating to term loans. Where the company under your audit has taken term loans, it is the responsibility of the auditor to verify whether the proceeds of such term loans have been utilized by the company only for the purpose for which the loans were obtained. That is known to you. The next one is point D. You know very well that fund requirements of a business can be classified broadly into 3 categories. The first one is long-term requirement of funds. Fund requirements of a business can be classified broadly into 3 categories. The first one is long-term requirement of funds. The second one is medium-term requirement of funds. And the third one is short-term requirement of funds. Long-term requirement, medium-term requirement, and short-term requirement of funds. And you know very well that sources of finance can also be classified broadly into 3 categories. The first one is long-term source of finance. The second one is medium-term source of finance. And the third one is short-term source of finance. The principles of financial management. The principles of financial management. suggests that for meeting long-term requirement of funds, an entity must make use of long-term sources of finance. It cannot use either medium-term sources or short-term sources. For meeting your long-term requirement of funds, entity must use long-term source of finance. It cannot use either medium-term sources or short-term sources. However, to meet medium-term requirement of funds, an entity may either use medium-term source of finance or even use long-term source of finance. And to meet short-term requirement of funds, the company can either make use of short-term source or make use of medium-term source or make use of long-term source and not vice versa. That means to meet long-term requirement of funds, you cannot use either medium-term source or short-term source. That is the principle of financial management. You may get a doubt after listening to this. What may happen? What may happen if the company uses medium-term source of finance or short-term source of finance for meeting its long-term requirements? The impact on the entity may be that the entity may have to shut down their business operations. The entity may have to even shut down their business operations for the simple reason that they made use of short-term source of finance for meeting long-term requirements. In order to prove this, I will try to give you an example. The example is a lengthy one, but without understanding the example, it is quite difficult for you to understand your responsibility as an auditor under CARO. So although it is time taking, I decided to give you that example. Careful while listening to this. Your name is A. You are having a factory manufacturing a particular product. You are getting a very good amount of profits in that factory. By running that factory, you are getting a very good amount of profits. Now, adjacent to the factory, there is an open site which is also belonging to you. You are having a factory premises. Adjacent to the factory premises, there is an open site which also belongs to you. Your name is A. That is an open site. And that open site is there in a commercial area. Now you are having a plan to construct a commercial complex. You are having an idea to construct a commercial complex in that open site. And you are expecting the cost of construction to be, say, 2 crore rupees. You are expecting the cost of construction to be 2 crore rupees. So A approached a bank called as State Bank of India, requested the banker to grant him a long-term loan. Of 2 crore rupees. Banker evaluated the repayment capability of A. Banker visited the open site. Banker satisfied that the area in which the site is there is a pure commercial area, and if the person constructs a commercial complex, it will be easier for him to let out the commercial complex and to get income from such commercial complex. Now, you promised SBI that you will pay rental income, you will use rental income for the purpose of payment of this loan of 2 crore rupees, and hence it may take, say, 20 years for you to make the repayment. Are you able to understand the facts of the case? What are the facts of the case? There is a person called as A. He is having a factory and he is getting very good amount of profits in that factory. His business is running very smoothly. The person is also having an open site which is adjacent to the factory. The site is in a good commercial area. This person is having a plan to construct a commercial complex therein. Expected cost of construction to be 2 crores. Approached a banker for the purpose of grant of a loan of 2 crores. Banker evaluated repayment capability. banker satisfied with the same, and banker identified that the open site is in a good commercial area, and hence it is not difficult for A to make the repayment out of rental income. It may take 20 years for making repayment, but certainly rental income can be used by A for making repayment of this loan to State Bank of India. Therefore, State Bank of India had in principle granted you a loan of 2 crores, but they said that disbursement of loan will take another 3 months time. In principle, loan is sanctioned, but it is said that disbursement of loan will take another 3 months. You do not want to waste 3 months time, and hence A approached his friend Mr. B. Mr. B is also doing a business. That business being carried on by B is a seasonal business. Now it is unseason for B. Very soon season will start for B. In order to meet the working capital requirements of his seasonal business, B keep an amount of 2 crore rupees with him for the purpose of meeting his working capital requirements. Season will start in the coming 3 months. Now A approached B. A requested B to provide a loan of 2 crore rupees, and A promised that this amount of 2 crore rupees will be paid to B within a period of a maximum of 3 months. Then how B asked A about how A is able to make a repayment of a loan of 2 crore rupees within a span of just 3 months. Then A explained that a loan of 2 crores has already been granted by State Bank of India, but disbursement of loan will take another 3 months. After disbursement of the loan, the proceeds will be given to you. This is the promise made by A to B. B has given a loan of 2 crore rupees to A, and the repayment period of the loan is only 3 months. Within 3 months, A is able to spend all the expenditure of 2 crores. The construction is not yet completed. A approached State Bank of India, requested State Bank of India to disburse a loan amount of 2 crores. Now SBI says that it may take another 3 months for them to disburse the loan. Now B, the friend of A, started pressurizing A to make the repayment of the loan. In that case, to meet his promise, what A did is, A is having a working capital of 2 crore rupees. That working capital kept by A for his business requirements has been paid to B. Now A is not having any working capital. A had fulfilled his promise to B, but A is not having any working capital. Since there is no working capital, there is no production to A. Since there is no production to A, there is no sale to A. Since there is no sale to A, there is no profit to A. However, A suffered with very huge losses because of this, and because of such huge losses, A is forced to close his factory. A is forced to close his factory. What happens in this story? Initially, I said to you that A is having a factory. He is doing some manufacturing. He is getting very good amount of profits. His business is going on smoothly. Now he needs to close his business. Why this happens? For the simple reason. The reason is he made use of, you won't listen this type of example in your lifetime again. The only reason for this is, the simple reason for this is, A in the given example made use of short-term source of finance. What is the repayment period of finance taken by A from B? It is only 3 months. A made use of short-term source of finance for meeting its long-term requirements. Because of that, ultimately, the going concern assumption made by A becomes wrong or inappropriate. That is the impact of using short-term source of finance for meeting long-term requirements. That is the reason why financial management has given a rule whereby it is said that long-term fund requirements can be met only out of long-term source of finance. They cannot be met out of short-term source of finance. That is the rule of financial management, which is implied, which is included here. Whether funds raised by the company under your audit on short-term basis have been utilized for long-term purposes. Whether the company under your audit utilized short-term source of finance for meeting their long-term requirements. If yes, the nature and amount is to be indicated by the auditor. If you do not understand how using short-term source of finance is detrimental to the interests of the company for meeting long-term requirements, there is no point in reading it. That is the reason why I focused on the importance of using long-term source of finance for meeting long-term requirement of funds and not on the reporting responsibility of the auditor. What is the reporting responsibility of the auditor? If the company under your audit made use of short-term source of finance for meeting their long-term requirements, then the auditor shall report the nature and the amount of such short-term source of funds used for meeting long-term requirements. That's it. This is point D. Now, point E and F are not relatable to the company under your audit. They are relatable to group companies. They are relatable to group companies. Point E says like this: I am the holding company. She is my subsidiary company. She needs to make repayment of a loan taken from a bank. She is not having funds to make the repayment. Now, holding company has borrowed some amount. The amounts so borrowed by the holding company have been transferred by the holding company to its subsidiary company. The funds so transferred by the holding company to its subsidiary company has been utilized by the subsidiary company to meet their obligations. To meet their obligations. If this happens to the company under your audit, you need to make a report to the shareholder saying that your company has taken some loans in order to meet the obligations of dash. Your company has taken loan from so and so person, holding company has taken loan from so and so party in order to meet the obligations of not the holding company but the obligations of its subsidiary company, its associate company, and so on. Now read this. Whether the company, which company? The company under your audit. Whether the company under your audit has taken any funds, or raised any loans, or made any borrowings. Why the company raised loans? Why the company made borrowings? Not for the purpose of meeting its own obligations, but for the purpose of meeting the obligations of their subsidiary companies, associate companies, etc. Whether the company has taken any funds from any entity, or any person for the purpose of or to meet the obligations of its subsidiaries, associates, and joint ventures. If so, details thereof with the nature of such transaction and the amount in each case. How much I borrowed, how much is the amount transferred, how much is the obligation of the subsidiary company. Every detail of the transaction is required to be reported by the auditor to the shareholders. Have you understood this point? Where the company under your audit made some borrowings, but the proceeds of the borrowings were not utilized by them. They have been transferred to their subsidiary company or associate company or joint venture, and such loan proceeds have been utilized by such associate, joint venture, or subsidiary company for the purpose of meeting their obligations. In that case, amount and the nature of the transaction is required to be reported by you. That is point number E. Then what is point number F? You are my auditor. I am the holding company. I am having subsidiary company, associate company, and joint venture company. I have taken some loan from a bank and I need to offer some security in respect of such loans. I offered the shares held by me for the purpose of raising loan. I means holding company, which is the company under your audit, has offered securities held by them in subsidiary companies, associate companies, or joint venture companies to the banker as pledge. So shares relating to subsidiary companies, associate companies, and joint venture companies have been offered by me for the purpose of getting the loan. If the company under your audit got some loan by offering shares through pledge of shares relating to subsidiaries, etc., the fact is also required to be indicated by you to the shareholders of the company, saying that your company has taken loan. For the purpose of taking the loan, your company offered security. The security offered by the company is nothing but shares held by them in subsidiary companies, in associate companies, and in joint venture companies. Read it. Whether the company has raised loans during the year. How the company raised loans? On the pledge of securities. The company pledged some securities and thereby raised some loans. Which company? The company under your audit has raised loans for the sake of providing security. They offered securities in the form of pledge of shares, debentures, etc., held by them in their subsidiaries, joint ventures, or associate companies. If so, give details thereof and also report if the company has defaulted in repayment of such loans raised. So two aspects are required to be covered by you.
We are having a discussion on audit of cooperative societies. Cooperative societies can be classified broadly into several categories. One such category is cooperative consumer stores. The way in which cooperative consumer stores operates and how it provides benefit to the members has already been explained to you in the previous session, wherein I said to you that there is a colony, residential colony. They have formed a cooperative consumer stores. Every member of every family, one representative of every family became a member in the cooperative society by purchasing some shares in the cooperative society. That is nothing but capital to the cooperative society. With that capital, society will carry on its trading business, and every person, every member is expected to purchase the required quantities of provisions from the society itself, consumer stores itself. The society may be able to offer the provisions at a lesser price than the retail price, for the simple reason that the society eliminates the middlemen like retail agencies, wholesalers, etc., because they do purchase the required quantities directly from the farmers. So that is the reason why if it is 150 rupees per kg in retail, society may be able to offer it only for 100 rupees, but still the society is able to get some reasonable amount of profit. The profit so earned by the society shall have to be distributed by way of dividend or bonus to its members. This is all about cooperative consumer stores. Similar to that, there will be some cooperative credit societies also. We had a discussion about cooperative consumer stores in the previous session. Now, the second one is the second way in which cooperative societies may operate is cooperative consumer stores. Cooperative credit societies. The previous one is cooperative consumer stores. Now the present one is cooperative credit societies. What is a cooperative credit society and how a cooperative credit society operates? The best example for a cooperative credit society is Can Bank Cooperative Credit Society. I was the auditor for this society for several years, and hence I am citing that example. Can Bank Cooperative Credit Society. The name of the society is Can Bank Cooperative Credit Society. This society has been established by the employees of Canara Bank. The society has been established by the employees of Canara Bank, and almost all the employees of the Canara Bank became members of Can Bank Cooperative Credit Society.
by becoming members, if anybody wants to make a deposit, they will try to make deposits with the society. And if anybody wants to take loan from the society, they can take loan from the society. That means this society is able to accept deposits from its members and will also lend money to its members. So any member in need of money may take a loan from the cooperative credit society instead of taking the loan from the banker. No doubt, they may get loans even from the bank, but the amount of loans that an employee of the bank may get from the bank is limited or restricted, and hence generally those members will make an application to the cooperative credit society for getting additional amount of loans. So they do accept deposits and they do lend money to their members. Everything will be done only to the members. That is the reason why becoming a member in the cooperative society is essential for getting the services of the cooperative society. That may be either cooperative consumer stores or cooperative credit societies. So I want to give you a broader view about how a cooperative credit society operates. It just like operate like a bank. It accepts deposits from members. It can lend money to its members. That is the major function of a cooperative credit society. And the third one is cooperative housing societies or cooperative banks. The fourth one is cooperative banks. There are several cooperative banks in India. The best example of a cooperative bank which may be known to you is Gandhi Cooperative Bank, which is having its existence both in Vijayawada as well as in Guntur. So Gandhi Cooperative Bank is the best example of a bank which is run by a cooperative society, and hence it is technically called as a cooperative bank. And the next one, the last one is cooperative housing societies. Cooperative housing societies do lend money for the purpose of construction of residential houses, and hence it is technically called as cooperative housing society. Again, in that housing society also, they do accept deposits from their members. They do lend money to their members. But what is the difference between cooperative credit societies and housing societies? Cooperative credit societies may lend money to the members for any reason, for any purpose, whereas cooperative housing societies do lend money to their members only for the sake of construction of residential properties. This is all about the brief introduction relating to cooperative societies. Now let us go through what is given in our material. And first of all, I will try to explain you some provisions of the Cooperative Societies Act. Under the heading Audit of Cooperative Societies, we are going to have a discussion on two things. The first one is audit of a cooperative society. The second one is audit of a multi-state cooperative society. They both were made part of the chapter called as audit of cooperative societies. So we are going to have a discussion on audit of cooperative society, including audit of multi-state cooperative society. What is the major difference between cooperative society and multi-state cooperative society? If the activities of a society are limited or restricted to only one state, then such society is called as a cooperative society. If the activities of a society are being performed in more than one state, it may extend. If the activities of a cooperative society extends to more than one state, then it is technically called as a multi-state cooperative society. In India, there are two types of acts. The first one is Cooperative Societies Act. The second one is Multi-State Cooperative Societies Act. So if it is a cooperative society, it need to comply with the provisions of Cooperative Societies Act. If it is a multi-state cooperative society, it need to comply with the provisions of Multi-State Cooperative Societies Act. And more importantly, most of the state governments also introduced separate act to govern cooperative societies in the state. Such acts are called as state cooperative acts. By this, what you need to understand is there are two types of cooperative societies acts. The first one is Central Cooperative Societies Act, and the second one is State Cooperative Societies Act. If the state government has not introduced any Cooperative Societies Act, then cooperative society need to follow Central Cooperative Societies Act. If the state government had established a separate act, then the cooperative society is expected to follow the relevant state act. I repeat, there are two types of cooperative societies acts. The first one is Central Cooperative Society Act, and the second one is State Cooperative Society Act. If a state government had not established any cooperative society, then cooperative society is expected to follow the provisions of Central Cooperative Societies Act. If the state government has established a separate Societies Act, then the society is under obligation to comply with the State Cooperative Societies Act. This is all about preliminaries relating to cooperative societies. Now let's have a discussion on the introductory part and background of cooperative societies. I will just read it, and if anything remains unexplained, I will try to explain it. A cooperative society is a voluntary association. The main aim of the cooperative society is to provide service to its members. So it is a voluntary association which will try to provide different types of services only to its members. That is the reason why I said to you that to get the services of a cooperative society, one must first become the member of the cooperative society. In order to become member of the cooperative society, you need to invest some capital and you need to purchase some shares in the cooperative society. By purchasing shares in the society only, you can become a member in a cooperative society. So members will get benefit or benefit of service from the cooperative society. A non-member cannot get benefit of the services of a cooperative society. Now read it. A cooperative society is a voluntary association started with the aim of service of its members. It is a form of business where individuals belonging to the same class, that is the reason why the initial example that I have given to you is cooperative consumer stores, wherein members of a persons of residential colony became members of the cooperative society. They are having the same objective. They belong to the same class. Same class here means, say, persons living in a residential colony may be technically said to be, they belong to a same class. So, where individuals belonging to the same class join their hands for the promotion of their common goal. The common goal in case of cooperative consumer stores is to get the provisions at a lesser price. So to achieve common goal, voluntarily some individuals belonging to the same class join their hands, and the society so formed shall have to provide service to its members. This is the introduction, background or meaning of a cooperative society. A cooperative society is a voluntary association started with the aim of providing service to its members. It is a form of business where individuals belonging to the same class join their hands for the promotion of their common goals. The philosophy of formation of cooperative society is all for each and each for all. Now, types of cooperative societies. I have explained you 4 types of cooperative societies. Here they have given only 3 types. The first one that we discussed is cooperative consumer stores. The second one that we discussed is cooperative credit societies. And the third one is cooperative banks. The fourth one is housing cooperatives or cooperative housing societies. In this way, you can divide or classify cooperative societies into different groups based on the activity, or based on the business performed by the cooperative society. The business performed by these societies differ from one another. Cooperative consumer stores will carry out business of sale of provisions. Housing cooperative societies will carry on the business of providing loans only for the sake of construction of houses. Cooperative credit societies do accept deposits from their members and will also lend money to their members for any purpose. In this way, the activities that are performed by different cooperative societies differ, and that is the reason why cooperative societies have been classified into several groups like consumer cooperative societies, housing cooperative societies, cooperative credit societies, etc. And this is the most important point that you need to understand, because you know very well about the importance of SA 250. What is SA 250? Consideration of laws and regulations in an audit of financial statements. What SA 250 says, whenever any law or any regulation is made applicable to a particular entity, the entity is under obligation to comply with that law or regulation. If the entity fails to comply with the law or regulation, the impact on the entity would be in the form of fines, penalties, damages. Sometimes they may have to involve in litigations, and sometimes even the going concern assumption made by the entity may become vitiated or may become wrong or inappropriate. That is the impact of non-compliance with the provisions of applicable laws and regulations. For example, there is a non-banking financial company. The non-banking financial company is required to follow regulations issued by Reserve Bank of India. What happens if NBFC fails to follow regulations issued by Reserve Bank of India? RBI has the authority to cancel certificate of registration granted to NBFC. When NBFC fails to follow the rules and regulations issued by Reserve Bank of India, RBI may cancel certificate of registration. When RBI cancels certificate of registration, NBFC cannot carry on its business of non-banking financial services. In such case, they need to shut down their business. Why the NBFC is shutting down their business? For the simple reason that they lost their certificate of registration. Why certificate of registration has been cancelled? For the simple reason that they violated rules and regulations. Yes or no? So, even the going concern assumption made by the management will become wrong or inappropriate when the entity fails to follow the provisions of applicable laws and regulations. Probably you may have learnt that laws can be classified broadly into two categories under SA 250. The first one is type 1 laws, which are said to be laws which will have a direct bearing or impact on the entity's financial statements. If you violate that law, your financial statements will get adversely affected straight away, because such laws and regulations will focus on the amounts to be reflected in the financial statements or disclosures to be made in the financial statements. If you violate that law, the amount that you have shown in the financial statements will become wrong. If you violate that law, the disclosure that you made in the financial statements will become wrong. When the amounts becomes wrong, when the disclosures becomes wrong, financial statements can never be said to be reflecting a true and fair view. There are some more laws which may not have a direct bearing or impact on the entity's financial statements, but may have an indirect bearing or entity on the financial statements, which were termed in our material as type 2 laws. It is the responsibility of the auditor to check and to satisfy that the entity under audit had complied with all laws and regulations, whether they are having a direct bearing or are having an indirect bearing on the entity's financial statements. That is the reason why SA 250 says that it is your responsibility as an auditor to consider laws and regulations in an audit of financial statements. In fact, the term non-compliance has also been defined in SA 250, where it is defined as like this. Non-compliance can be defined as acts of omission or commission, either done intentionally or unintentionally, where those acts are contrary to the provisions of existing laws and regulations. If you have done any act which is contrary to the provisions of applicable laws and regulations, it is said that you have not complied with the law. So whenever any law is made applicable to any entity, it is the responsibility of the entity to comply with the law. It is the responsibility of the auditor of the entity to check whether such compliance has actually been done or not. Similarly, here also, whenever you are appointed as the auditors of a cooperative society, it is your responsibility as an auditor to check and to ensure that the entity under your audit had complied with relevant laws and regulations. For this sake only, I explained to you that there are two laws affecting cooperative societies. The first one is Central Cooperative Societies Act. The second one is State Cooperative Societies Act, if any. Apart from this, there is another act framed by central government called as Multi-State Cooperative Societies Act. So, as an auditor, you must have knowledge about the provisions of the Cooperative Societies Act, State Cooperative Societies Act, as well as Multi-State Cooperative Societies Act, if you are supposed to carry out audit of cooperative societies. So that is the reason why understanding the legal framework is said to be more important. If you fail to understand what laws are made applicable to the entity going to be audited by you, you will fail in discharging your duties correctly. That is the reason why being an auditor, first of all, it is your responsibility to ascertain, to identify about what laws are made applicable to the entity under your audit. Then you need to check whether such laws have been actually complied with or not. Read it. The Cooperative Societies Act 1912. This has been termed by me as Central Cooperative Societies Act. The Cooperative Societies Act 1912, a central act contains fundamental law regarding the formation of a cooperative society as well as the working of cooperative society in India. However, in many states, namely Maharashtra, West Bengal, Orissa, even in Andhra Pradesh also, there is a separate act established in respect of cooperative societies, which is called as Andhra Pradesh Cooperative Societies Act. So, cooperative societies are governed by specific state acts. That is the reason why I said to you that if there is a specific act established by state government, cooperative society is expected to follow that act. If there is no such specific act, then cooperative society is required to follow the provisions of Central Cooperative Societies Act. That is the reason why I said to you that you must have knowledge of both the acts before commencement of audit of a cooperative society. Just like in the case of a company, if you want to start audit of a company, you must be conversant with the provisions of the Companies Act, without which you cannot carry out your audit. Similar to that, if you want to start audit of a cooperative society, first of all, you must have conversant with the provisions of Cooperative Societies Act. What provisions are to be learnt by the auditor? Cooperative Societies Act, Central, State, and including Multi-State Cooperative Societies Act. Besides the above, Multi-State Cooperative Societies Act 2002 is applicable for multi-state cooperative societies. I explained you the difference between a cooperative society and multi-state cooperative society. For a multi-state cooperative society, a separate act is made applicable. That is Multi-State Cooperative Societies Act 2002. That is a brief introduction or background about audit of cooperative societies, the way in which cooperative society functions. Now, explain the provisions relating to maintenance of books of account by a cooperative society. If you are able to recollect what we learnt under section 128 of the Companies Act, particularly under section 2 subsection 13 of the Companies Act, there is nothing to explain under the heading books of account to be maintained. There is nothing to explain under the heading books of account to be maintained by a cooperative society. What is given under section 2 subsection 13 of the Companies Act has been repeated here also. So, as per section 2 subsection 13 of the Companies Act, every company is under obligation to maintain some books of account which should contain the following minimum details. We should contain the following minimum details. What are they? 1. All sums of money received and expended, all purchase and sales, all liabilities and assets. If the entity is manufacturing some units, then cost accounting records, application of provisions of 148 subsection may be there, 148 subsection 1 may be there. In that case, the entity is also under obligation to maintain some cost accounting records. The same has been repeated here also. Therefore, there is nothing to explain under the heading books, but there is something to explain the term other records. Books is different, other records is different. Read it. Statutory requirement. Under section 43 subsection H of Central Act, a state government can frame rules. A state government can frame rules prescribing books and accounts to be kept by a cooperative society, subject to covering minimum of the following details. So, what are the books that are required to be maintained by a cooperative society are not listed down. They need to maintain books of account. Such books maintained by them shall contain minimum details like the following. All sums of money received and expended by the society, all sales and purchase of goods made by the society. Remember, these details are not required to be maintained by every society. Why? Because if the society is a cooperative consumer stores, there will be some purchase and there will be some sales. Hence, they are required to maintain the books which should contain details of all purchase and sales. If the society is a cooperative credit society or it is a cooperative bank or a housing society, there would not be any purchase and sale. Therefore, there is no need to maintain books containing details of purchase and sales. So all these things are not applicable to all types of societies. Some are made applicable to some societies and some are not made applicable to such societies. Therefore, if it is applicable, if there are some purchase in the society, if there are some sales in the society is under obligation to maintain the details of all such purchase and sales in the books of account being maintained by them. So, under sounds of Central Act, a state government can frame rules prescribing books and accounts to be kept by a cooperative society subject to covering a minimum of the following details: all sums of money received and expended by the society, all sales and purchase of goods by the society, all assets and liabilities of the society. In case where the societies are engaged in manufacturing of goods, then the records pertaining to utilization of material labor. In other words, it is nothing but dash. Cost accounting records. These are all the books that are required to be compulsorily maintained. These are all the books that are required to be maintained compulsorily by the societies. And apart from this, societies having a liberty to maintain some more books of account. The books of account that the society may maintain on its own or voluntarily is purely dependent upon the type of the business that is being carried on by the society, the type of the transactions that are entered by the society. For example, if the society is a credit society, the society may maintain a separate register called as loan register. A separate register called as loan register. If the society is making some investments, it may maintain a separate register called as investment register. If the society is having some property, plant and equipment or other fixed assets, it may maintain a register called as fixed asset register, otherwise now being called as PPE register. Like this, based on the activities that are being performed by the society is having a liberty to maintain some additional books, additional registers or additional records apart from the records that are compulsorily required to be maintained by them under 43H of Central Act. Now, point number 2, maintenance of additional records. The statutory provisions provide a directive, but they are not conclusive. The society is at a liberty to maintain such additional records for providing clarity and detailed explanation of financial transactions and the results in the best possible manner. The only thing that you need to understand in point number 2 is that society has been given a liberty to maintain some additional records. So apart from these records, society is having a liberty to maintain some additional records. Then what are the examples of additional records? I have given you some examples of additional records like fixed asset register, proper investment register, loan register, stock register. If it is a cooperative consumer stores, it need to maintain a register of inventory or stock register. Whatever register you want to maintain, you can do that. You have been given a liberty to maintain additional records to better explain your results and to better explain your transactions. Daily cash sale summary register. A register. This register is very important, but fortunately this is well known to you. I explained you the concept of daily cash sale summary register when we are having a discussion on Audit of cinema. Under the heading Audit of cinema, I said to you that every cinema theater is under obligation to prepare a statement of tickets sold for each and every show. Once statement of tickets sold is prepared for each and every show, then the cinema theater shall try to compare the total of statement of tickets sold for each show with the cash collected and should ensure that these two are in agreement. And at the end of the day, the cinema theater is required to consolidate all the statements of tickets sold, and they need to prepare a statement called as daily statement of tickets sold. This daily statement of tickets sold is prepared from the statement of tickets sold for each and every show. Supposing that there are 4 shows in a cinema hall during a day, 4 statements will be prepared in respect of statement of tickets sold for each show. At the end of the day, all the 4 statements of tickets sold should have to be consolidated, and cinema theater has to prepare a single report called as daily statement of tickets sold. The total of daily statement of tickets sold shall have to be recorded in the cash book as a single entry. Supposing that cinema theater sold 10,000 tickets during a day, is it possible for the theater to record one entry for each and every ticket sold? In that case, you need to record 10,000 entries per day. It is highly impracticable for the cinema theater to record sale transaction whenever cinema theater sold some tickets. That is the reason why the total of daily statement of tickets sold shall have to be recorded by the theater in a cash book. Similar to that, when the number of sales made by you are less, then you can record a transaction. The number of sales, is it working? AC? No. So in the same way, when an organization is making numerous sales, for example, the number of sale transactions entered by an organization during a day are 10,000. It is highly impracticable for the organization to record an entry for each and every sale. Therefore, the organization is expected to maintain a register or a statement called as the daily cash sales summary register. The best example of this type of organizations are automobile spare parts shop. Automobile spare parts shop is the best example of a business wherein number of sale transactions, cash sale transactions took place during a day. Therefore, they do not record each and every cash sale transaction directly into cash book. Instead, they will prepare a separate register called as cash sale summary register. At the end of the day, the total of the cash sale summary register will be posted into cash sale summary cash book will be posted into cash book. This is the importance of the term daily cash sale summary register. బయట వర్షం పడుతుంది కానీ చల్లగా ఎక్కడుందమ్మా ఇల్లు, కనీసం ఆన్ కూడా చేయకుండా వెళ్ళిపోయాడు ఆయన, మళ్ళీ ఎక్కడ ఆన్ చేయమంటానని. సో ఎగ్జాంపుల్స్ ఆఫ్ additional records are daily cash sale summary register. The next one is register of collection from debtors if credit sales are allowed by the bylaws of the society. The third one is register of loans. The fourth one is loan disbursement. ఆ తలపేసేయండి, ఏసీ వేశారు, కాస్త 2 రోజులు ఏసీ వేయమనండి మీ వాళ్ళని, లోపల ఉడికిపోతుంది, ఏసీ లేకుండా నేను చెప్పలేను. అది లోన్ డిస్బర్స్మెంట్ రిజిస్టర్, అంతా కారిపోతుంది లోపల, చూపించుకోలేకపోతున్నా. లోన్ డిస్బర్స్మెంట్ అంటే ఇంకెంతకన్నా నీకు ఎక్కువ మాట్లాడలేకపోతున్నా రికార్డింగ్ కాబట్టి, లేకపోతే ఇంకెక్కువ మాట్లాడతా. లోన్ డిస్బర్స్మెంట్ రిజిస్టర్ ఇన్ కేస్ ఆఫ్ ఏ క్రెడిట్ సొసైటీ. అండ్ ద లిస్ట్ ఆఫ్ అడిషనల్ రికార్డ్స్ as mentioned above are just illustrative but not exhaustive. This is about examples of ఎన్ని కష్టాలు పడుతున్నా మీకోసం. So these are all the additional records that a cooperative society can maintain. This is all about question number 1. By this we completed a discussion on question number 1. Explain the provisions relating to maintenance of books of account by a cooperative society. Now write a short note on appointment of auditor of a cooperative society. Before going through the other questions, let us first of all go through a self-practice question or self-preparation question given to you, without which I cannot explain the audit of cooperative society in detail. This is the most important question which is given to you under the heading additional concepts for self-study. This is not meant for self-study. This should have to be discussed in the classroom, without which you cannot understand what are your exact duties as an auditor of a cooperative society. Therefore, although it is given under the heading self-study, I will try to explain few concepts under the heading Provisions of Cooperative Societies Act. The following are the important provisions of Cooperative Societies Act which will have a direct bearing on the accounts of the cooperative society. Therefore, first of all, auditor should have knowledge about these provisions. Then only you can carry out audit of a cooperative society in an effective manner. The first one is about point number 5, appropriation of profits to reserve fund. Several times a question has been asked on this particular point in the examinations in the past, and hence you must be able to understand this. You must be able to remember this point. At any point you may get a question from this point, appropriation of profits to reserve fund. At least 25%, of the profits earned by a cooperative society must have to be transferred to reserve fund. It is a compulsion. You know very well that in case of a company, there is no compulsion that the company is required to transfer some portion of their profits to reserves. Under 1956 Companies Act, there is a compulsion that some portion of the profits of a company shall have to be transferred to reserves, particularly when the company wants to declare a dividend. In 2013 Act, it has been removed. Therefore, even in case of companies, there is no compulsion to transfer any portion of their profits to any of the reserves. But in case of cooperative societies, there is a compulsion that 25% of the profits earned by a cooperative society are compulsorily required to be transferred to a separate fund called as reserve fund. Only out of the remaining amount, cooperative society can distribute either bonus or dividend to its members. I said to you that even cooperative society will derive some profits. They may not get exorbitant profits, but they may get reasonable profits. Such profits earned by a cooperative society will be ultimately distributed to their members in the form of either bonus or in the form of dividend. But before a distribution of their profits as either bonus or dividend to its members, it is a compulsion on the part of the cooperative society to transfer at least 25% of its profits to reserve fund. In other words, if the society gets a profit of 100 rupees, it needs to transfer an amount of 25 out of 100 to reserve fund. The only remaining 75 only can be distributed to the members of the society either by way of bonus or by way of dividend. This is about appropriation of profits. The only thing that you must remember is about this percentage. What is that percentage? 25%. Read it. Appropriation of profits to reserve fund, section 33. Every society shall, it's a compulsion. Every society shall transfer 25% of the profits to reserve fund before distribution as a dividend or bonus to its members. Over. Now, what the cooperative society should do with this 25%? Or in which way cooperative society is expected to invest this amount of 25% which is transferred to reserve fund? This amount cannot be kept idle by the cooperative society. If you transfer some amount to your reserve fund, you cannot keep that fund idle. You need to invest that reserve fund somewhere else. So cooperative society is also expected to invest this amount of 25% transferred to reserve fund. And where the cooperative society is can invest these funds, that point has been given under point number 4. So you must understand that there is a link between point number 5 and point number 4. Under point number 5, every society shall transfer 25% of its profits to reserve fund. Under point number 4, where the society is expected to invest this 25% of the funds has been given in point number 4. Investment of funds. A society may invest its funds in any one or more of the following: either in central cooperative banks or in state cooperative banks. Even central government established some banks called as cooperative banks. State governments established some banks under cooperative sector called as state cooperative banks. The best example of a state cooperative bank which may be known to you is Andhra Pradesh State Cooperative Bank, popularly known as APCOP. Andhra Pradesh State Cooperative Bank. It has its branches in several places in AP. In Vijayawada itself, they are having 2 branches. Andhra Pradesh State Cooperative Bank, which has been floated by the Andhra Pradesh state government by following the principles of cooperative societies. So, a cooperative society can invest their reserve fund either in central cooperative bank or in state cooperative bank or in any bank other than central or state cooperative bank as approved by the registrar on specified terms and conditions. There is nothing to explain in this point. If there is something to explain, I will try to explain it first, then I will read. If there is nothing to explain, there is no point in explaining it. It is self-explanatory in nature. You need to remember all these things, that's it. Where a cooperative society can invest their funds, either in a central cooperative bank or in a state cooperative bank or in any other bank other than central and state cooperative bank, provided such bank has been approved by registrar on specified terms, registrar of cooperative societies on specified terms and conditions. This is a point which is well known to you. A trust cannot invest its funds anywhere they like. Trust is required to invest their funds only the way in which the way which is specified by the Indian Trust Act under section 20 of the Indian Trust Act. And a trust is generally expected to invest their funds predominantly in government securities. In other words, Indian trust is under obligation to invest their funds in government securities. This aspect has been mentioned in section 20 of the Indian Trust Act. So, a cooperative society may invest their funds in any of the securities specified by section 20 of the Indian Trust Act. What were the securities specified by Indian Trust Act under section 20 of the Indian Trust Act? They were predominantly government securities issued either by central government or by state government. So, you can invest your fund either in central cooperative bank, state cooperative bank, any bank other than central or state cooperative bank approved by the registrar. You can invest under section 20 of Indian Trust Act, or you can invest in the shares, bonds or debentures of any other society. A society can invest in other society having a limited liability. And finally, in any other money manner, it is not money's manner, in any other manner permitted by the central or state government. It is necessary for you to remember at least 4 points out of these 5. The first 4 are to be, you need to remember at least first four and reproduce the same under the heading investment of funds. So can you please list down what are the areas in which a cooperative society can invest its reserve fund? Central cooperative banks, state cooperative banks, any other bank other than central and state cooperative bank, provided it has been approved by the registrar of cooperative societies. It can make investments in the securities mentioned under section 20 of the Indian Trust Act, or a cooperative society can invest its reserve fund in another cooperative society having limited liability. That's it. This is about investment of funds. Not only this, a cooperative society can invest reserve fund in its own business also. These are all investments made by the society outside its business. These are all the investments made by the society outside the business. Instead of doing all these things, simply cooperative society can make use of that 25% fund for the business of the cooperative society that has been mentioned in point number 9. So 4, 5 and 9 are interrelated. 5 is the basic point. What point number 5 says? At least 25% of the profits earned by a cooperative society are required to be transferred to reserve fund. The amounts so transferred to reserve fund may be invested by the cooperative society either outside its business or within its business. If the cooperative society wants to invest that reserve fund outside the business, then where it can invest has been mentioned in point number 4. If the cooperative society decides to invest that money within the business, how to invest that within the business is given under point number 9. So these 3 points are interrelated. Are you able to understand the interrelationship between 5, 4 and 9? Yes, done. Investment of reserve fund can be done by the cooperative society either outside the business. This point is explained in point number 4. Or it can utilize the reserve fund as working capital. It can utilize the reserve fund as working capital for its own business. Some of the state acts provide that a society may use the reserve fund either in the business of the society as working capital. So you can make use of that reserve fund as our working capital, or it may invest as per the provisions of the act. What are the provisions of the act that was given under section 32? Under section 32 of Cooperative Societies Act 1912. Section as per section 32, which is mentioned under point number 4. I repeat, some of the state acts provides that a society may use the reserve fund either in the business of the society as working capital or may invest as per the provisions of the act, and this is somewhat difficult to understand. The amount may be used for some public purposes likely to promote the object of the society. This is very difficult for the student to understand. The reserve fund may be used by the cooperative society for some public purposes likely to promote the object of the society. Have you ever heard about the term PACS, Primary Agricultural Credit Societies? Basically, PACS are established in villages and other rural areas. They were not established in cities, towns, etc. They are established to meet the requirements of farmers, and hence PACS are established or incorporated only in villages or in rural areas, which are technically called as primary. The name itself indicates that the objective of the society is to provide credit to agriculturists. That is the reason why it is called as Primary Agricultural Credit Society. Primary Agricultural Credit Society. They used to provide funds or loans to the farmers in that particular locality. So if a PAC is there in a village, a Primary Agricultural Credit Society is there in a village, Primary Agricultural Credit Society offer loans to the farmers in that particular village. If these packs are not there, then farmers, for the purpose of their capital, seed capital, may have to rely on the money lenders, and money lenders do charge higher rate of interest, which is detrimental to the interest of the farmer. In order to protect the interests of the farmers in India, some societies established primary agricultural credit societies in the form of packs, and they do provide loan to the farmers at reasonable rates of interest ranging between 9% to say a maximum of 12%. If the same amount is to be taken as loan from a money lender, the money lender may charge a rate of interest of 36% from the farmer. So, to save the farmer from money lenders, packs have been established which will provide loans to the farmers at a very reasonable rate of interest ranging from 9 to 12%. Now, the objective of the society, objective of packs in our example is to provide loan facilities to the farmers. And when packs has been established in a village, farmers of the village may not know the reason why this society has been established. When farmers do not know how packs function, farmer may not come forward to take loan from packs. In that case, the very objective for which packs have been established will get defeated. That is the reason why when packs are established in villages, the objective with which they have been established should have to be promoted. Otherwise, the objective becomes vitiated or defeated. That is the reason why, to promote their objectives of the society. What is the objective of primary agricultural credit society? To provide loans to farmers, small and marginal farmers, not to all farmers, to provide loans to small and marginal farmers at a concessional rate of interest ranging from a mere 9 to 12%. To promote their objectives, cooperative society can carry out some activities in that locality, in that vicinity, like providing a bag of urea at free of cost to the farmers. If they start providing a bag of urea at free of cost to the farmers, obviously more and more farmers will come to know that, okay, this society is providing loans to the farmers at a concessional rate of interest. Thereby, the society would be able to promote the objectives of the society for designing and implementing such programs like giving a bag of urea at free of cost to the villagers, etc. Societies need funds. Such funds, the fund requirement of such things can be met by the society out of its reserve fund, if there be any. This is about point number C, which is very important and difficult to understand. That is the reason why I have given an example for that, to have a better understanding. So, a society can invest their reserve fund either outside the business, or it can utilize the reserve fund as working capital. And the last point is, it may be used for some public purposes likely to promote the objects of the society. The auditor should ensure strict compliance with the state act and rules in this regard. That means it is our responsibility as an auditor to check and to satisfy that funds have been invested only as per the rules mentioned under the Cooperative Societies Act. A cooperative society is not having any liberty to invest their funds in the way they want. They need to invest monies only as per the provisions of Cooperative Societies Act, and hence it is our responsibility as an auditor to check and to ensure that funds have been invested by the cooperative society only in the way allowed in the Cooperative Societies Act or respective state Cooperative Societies Act. This is all about point number 5, appropriation of profits to reserve fund. Point number 4, investment of funds. And point number 9, investment of reserve fund outside the business or utilization of it as working capital. Another important point that you may get in the examination is point number 6. Several times a question was asked in the examination on point number 6 also. Cooperative society can contribute some amount for charitable purposes. But the only point that you need to understand under this heading is you can make contributions for charitable purposes. But before making contributions to charitable purposes, first of all, you need to set aside that 25% of your profit and you need to transfer that 25% of profit to reserve fund. Only after transferring 25% to reserve fund, out of the remaining monies, you can contribute some amount for charitable purposes. And there is a cap, there is a limitation in respect of, the contributions that a cooperative society can make to charitable purposes. That amount of contribution shall not exceed 10% of the net profits, not 10% of original net profit, but remaining after the compulsory transfer to reserve fund for any charitable purpose. What does it mean? If a cooperative society get a profit of 100 rupees, out of which 25 out of 100 must have to be transferred to reserve fund. What is the remaining amount? 75. This 10% which you can give as contribution to charitable purpose should have to be calculated not on dash but on dash. Should have to be calculated not on 100 rupees but on 75 rupees. What is the importance of 75 here? 75 is the amount that you derive only after transferring 25% of your profits to reserve fund. This 10% is required to be calculated on 75 rupees and not on 100 rupees. That means in the given example, how much is the money that a cooperative society can contribute to charitable purpose? 7 rupee 50 paisa is said to be the amount that they can contribute to charitable purposes. This provision is given under section 34 of Cooperative Societies Act. Now you can read that point, you can have an understanding of that point. This point is also a very important point in examination point of view. Originally this audit was introduced in CA final audit. Later on it has been shifted from CA final to CA inter. And in the new syllabus, it has been removed. Contribution to charitable purposes. A society may, with the sanction of the registrar, contribute an amount not exceeding 10% of the net profits, which remains after compulsory transfer to reserve fund for any charitable purpose. That's it. And this is a point which is generally known to you. This is just like specific reserves in case of companies. Sometimes the articles of association of a company may have mentioned that the company may have to transfer certain portion of their profits to different types of reserves like dividend equalization reserve, debenture redemption reserve, and other statutory reserves. The best example is a debenture redemption reserve. The company would have issued some debentures and the company may be under obligation to create a reserve called as debenture redemption reserve. Every year some portion of the profits are required to be transferred by the company to a specific reserve called as debenture redemption reserve. And when the company issues debentures, you know very well that the company is required to appoint a trustee and the company is required to establish a deed called as debenture trust deed with that trustee. The debenture trust deed contain terms and conditions on the basis of which debentures have been issued by the company. That trust deed may contain a provision specifying that every year the company is required to transfer some percentage, prescribed percentage of profit to a reserve called as debenture redemption reserve. In that case, because the trust deed is nothing but a contract, to meet contractual obligations, to meet contractual obligations, the company may be required to transfer some portion of the profits to debenture redemption reserve. Similar to that, sometimes rules, regulations, or bylaws of a cooperative society may have specified that before distribution of profits as a dividend or as bonus to the shareholders, cooperative society is also required to transfer some portion of the profits to some reserves that were mentioned under rules, regulations, or bylaws. In that case, society is not only under obligation to transfer 25% of its profits to reserve fund. Apart from this, the transfer of profits should also be there to other reserves mentioned under rules, regulations, and bylaws of society. Only after transferring the profits to such reserves, if anything remains, that amount can be distributed by the society either as dividend or as bonus to the members of the society. Now you can just read it and understand point number 8, which is not at all important but easy to understand. That is the reason why I explained it. Read it. Apart from statutory provisions relating to reserve fund, the auditor may have regard to provisions in bylaws and rules and regulations of the society. The point is not so clear. What I explained to you is more clear than what is given in the material. Sometimes dash or dash or dash may specify that dash is required to transfer dash to dash. Sometimes rules, regulations, and bylaws of the society may have mentioned that before declaration of any dividend or bonus to the members, society is under obligation to transfer some portion of their profits to different types of funds mentioned under rules, regulations, and bylaws. In that case, apart from transferring 25% of the profits compulsorily to reserve fund mentioned under the Cooperative Societies Act, society is also under obligation to transfer such profits to such funds which are mentioned under rules, regulations, and bylaws. And only remaining amount can be distributed either by way of dividend or by way of bonus. That's it. This is about point number 8. So in this, by this I have completed 4, 5, 6, 8, 9.